So I'm very excited to welcome you today, along with our co-hosts at the Milken Institute, to the 2026 Employee Benefit Research and Milken Institute Retirement Symposium. This is the third symposium that we've had and hosted with Milken, so it's been a wonderful relationship and have just so enjoyed our partnership and our relationship. Joining the hundreds plus folks here in the room today, we have over 700 people registered for the live stream. So we have a big live stream audience, and as always, the event will be recorded in case you happen to miss something either in person or online. I'm Barb Marder. I'm the president and CEO of EBRI, and my co-host Cheryl Evans will come up in a moment and give her welcome remarks. Cheryl's the director at Milken Institute's Lifetime Financial Security Program. The missions of EBRI and Milken are very well aligned, and our brands and our research are very complementary. We have a lot of intersections of things that we're working on. And just to remind you, in case you may have forgotten, EBRI's mission is to produce and communicate independent, objective, nonpartisan data and research on all aspects of employee benefits, and that's meant to inform sound policymaking, market innovation, and ultimately drive better employee and employer outcomes for an evolving workforce. We have an amazing lineup of panels and speakers today, and of course, we couldn't have an EBRI event without research discussions, so you'll hear from two EBRI researchers today, Craig Copeland and Leslie Moeller. That'll happen a little later. It's a very packed room and a very packed agenda. We do have some breaks, as you can see, and we gave you a nice long time for lunch. So enjoy and network and enjoy those breaks. So just a few housekeeping items before I call up Cheryl. First of all, the event wouldn't be possible without our sponsors. Thank you so much. And I want to thank Chantal from the U.S. Chamber for kindly sharing their event space with us. We really appreciate it. Wi-Fi is available. If you haven't figured that out yet, there's information on the table. And we will wrap up at 5 o'clock, and there's a lunch break right around noon, just so you have that. We welcome the press that's here both in the room and on the live stream. And today's sessions are all on the record unless someone indicates otherwise by the speaker or panelist. So I'd like to now invite my co-host Cheryl to come up and share her remarks.
Thank you. Oh my gosh, it is bright. Yeah, thank you, Barb. On behalf of the Milken Institute, I'd like to also welcome you. We're excited about this partnership. As Barb mentioned, it's our third year doing this together, and we're really pleased and honored to be working with EBRI. Their research, as I said before, and related intellectual rigor is really unmatched. We wrote our initial report when the program began, started the Lifetime Financials program 4 years ago, and we cited EBRI a lot. We didn't know them well. We were introduced by Nationwide Financial, and we're really impressed with what they do. I call them sort of a small and mighty team because they do amazing things. And I didn't have the Milken Institute mission, but now I feel like I need to pull it up. But as you probably know, we do health, finance, and philanthropy, and I sit in the finance pillar, as we call it. And we're a nonprofit, nonpartisan organization, and we're a think tank. We're a global think tank with offices throughout the world, and we refer to our mission as being designed to accelerate measurable progress on the path to a meaningful life. So that means a number of things. We conduct research, convenings. We're most known for our global conference, as well as outreach, bringing people together, connecting with people on the Hill if we need to, if we feel like we want to make a difference or make a change in that way, and we do a lot of global work. And so I would say that my program is fairly broad. We cover retirement. We cover things like, we're focused on things, I should say, like enhancing access to retirement plans, the Trump accounts, the statements that Trump made were sort of focused on, are there going to be new retirement programs, new plans? We also focus on any kind of, any kind of access issue related to retirement, and we also focus on financial education. I have a women's financial security initiative. I was starting to say we're also focused on the feminization of wealth. Barb's a part of that. We're focusing on global financial health with United Nations, debt management, And recently we got into sort of fraud and scams and what's happening in the global space and more. So we're covering a variety of diverse topics there, as we are today. So you see the agenda. There's so many interesting things here. I'm particularly interested to hear the fintech companies. We always feature those that are new and interesting and sort of see what's out there, as well as Social Security and many other things. So with that in mind, we welcome you and thank you for joining us. And I'd like to introduce, Barb's going to do a chat and sort of cover what's going on in the landscape with Stephanie Du from CNBC. So please welcome them.
When you kind of look at the big picture, what's the headline in retirement security today?
Yeah, John, you want to move to the first slide? So I think it's interesting. You know, I actually, to pull this together, we looked at CNBC articles and things that you're writing about. It's interesting. So what is the state of retirement? Are we seeing kind of the great divide, the K-shaped economy? So I thought I would just pull a couple of things that I thought were interesting. So I know the slides are a little hard to see, so I'll just explain them. But in the upper right, basically you're seeing retirement plan participation. And what that chart shows is that it is somewhat unequal. People who are lower income, people who work for smaller businesses are much less likely to have an employer-provided retirement program, and we know how important those employer plans are. So that's definitely something to watch, and I know we'll talk a little bit later about that. I did also want to see, based on some EBRI research, like how are things tracking? Are we seeing the K? You can see it a little bit. So the slide on the bottom is actually tracking those plan participation numbers over the last 6 years. And they're pretty stable, but you can see for the sort of the middle class, those numbers are dipping a bit. So it is something to watch. And these are stop in 2024, so we'll look at 2025 and see what's going on.
It does feel like the retirement divide, if you will, kind of follows the economic divide, right? Like the haves and the have-nots. And I was asking an economist about the K-shape because it felt like the K-shape was widening, and he called it the jaws of the crocodile, which I thought was more descriptive.
Yeah, that's another way to look at it.
Of what's happening, and maybe rises some of the dangers. Are we making progress in closing the divide, or is it still a problem?
Yeah, I mean, from a lot of our research, it looks like things are kind of status quo. Making progress in some areas, not in others. I think a great indicator is, I'm sure many of you are familiar with EBRI, the EBRI and Greenwald Research Retirement Confidence Survey that we've been running for decades. Year after year, we find the same characteristics of workers who say, I'm not sure I'm going to have enough money to save for retirement. And it's the same factors year after year that are driving that, the same demographics. It's people who are lower income, have high levels of debt, which I know we'll talk about, lower levels of education, poor health, and never had an employer plan. So, and that really hasn't changed over time. So I think it will be interesting. We're just wrapping up the 2026 survey, and with sort of the unsettled kind of the tariffs, unsettled economy and all of that, it'll be interesting to see.
Oil prices.
Yeah, oil prices. It'll be interesting to see what happens with the new numbers.
And you mentioned the savings versus debt. EBRI has research that shows half of workers say that debt is impacting their ability to save. Is that the primary barrier? If we want to call
the next slide.
Is debt the primary barrier to retirement savings?
It's a big barrier for sure, and we'll hear a little bit later about how having emergency savings has helped. We'll hear a lot about that during the panel. But as you can see, in 2025, the number's going up. More retirees and workers are saying that retirement savings is just not a priority for me based on other needs my family have. So that's a number that we prefer not to be going up. We'd like to kind of see that either stable or going down. I mean, the other thing that's really interesting is EBRI, for the last few years, has done research with JP Morgan Asset Management, published a number of really interesting studies, and you'll see one of the findings here is that, the debt that people have, it's often unexpected and sometimes expected. So unexpected, for example, healthcare expenses was one of the biggest drivers of people taking loans out of the 401k plan. Housing, the other one. Now, housing could be kind of expected or unexpected. It sort of depends what you're using it for. We also, though, in last year, we did a study and looked at kind of the interaction of student loan debt and retirement savings behavior, and it's all interconnected for sure. So I do think it's a big driver of what's constraining retirement savings. I did also see a study, it was a Vanguard study that I just saw that said that more people than ever are taking withdrawals from their 401k plan. So, now there may be a lot of reasons.
The good
for
news
that.
is it's still small. It's
It's
still a small number.
Yeah,
but,
it's
but
still
it
small.
is-
I forgot,
it is-
was like 6% or
right,
something.
But it was increasing, which is
Yes.
problematic. And
Yeah.
do you see the debt problem? Is that an income problem or is that a spending problem? I don't know if your data gets at the.
Well, it's interesting. Craig's actually going to share later some research that we've done for the first time. We have a new database that we got from TransUnion, one of the credit bureaus, and we're actually matching up saving and spending data. So it'll be interesting to see, like, you can look at people with certain credit scores and what happens with their 401k savings. So it's kind of, I think there's a lot wrapped up into it, but I think, the need for spending is a big factor, and especially with, inflation, and that seems to drive things as well.
Because we've done some stories on that too, like the higher income showing stress. It's not just the lower.
Yeah.
Well, let's move a little bit because we're going to talk about policy here, and we're seeing a couple of different approaches from the Trump administration. With he mentioned briefly expanding access to maybe a TSP type plan, and he's also pushed the Trump accounts. If you had to pick, which one would you focus on?
Yeah, I hate saying either or, but you want to move to the next slide, John? So we already showed you this one. Let me show you the next one. Can you go to the, yeah. So, I think it's interesting. They're both, I feel like Trump accounts and this potential new proposal from the State of the Union address are both very important and can play a very important role. But I think it's worth remembering that part of, we don't actually know exactly what was in the State of the Union proposal, but part of it is likely to leverage the savers match that was already law, set to go into effect next year. And Craig had done some really interesting work on sizing the savers match. And then, what's the impact? The impact is, significant just for the savers match. And if you incorporate that savers match with broader access, the results could be really substantial. We, yesterday, Craig shared with our board just some numbers on just with very kind of broad assumptions, since we really don't know what it could look like. That proposal with the savers match and the way we're interpreting it, it could actually reduce the overall U.S. retirement income shortfall by 20% for some, kind of middle-aged workers. That's huge. So early saving important, Trump accounts important, early saving important, that compounding of interest is great, but this coverage thing seems really helpful as well.
Mm-hmm. And are the incentives working? Do enough people take the incentive?
So it's interesting. I think the savers match was a recreated savers credit that was, I think people would say, was underutilized. I see Mark shaking his head. Yes. I think it was underutilized. I think the savers match has a better chance of being used because of the way that you report and get the match. And I think interesting with the Trump accounts, I saw an article that, millions of people have already signed up to get the Trump account for their for their children, and it hasn't even gone live yet. So I think that's encouraging.
We're still waiting for the details on how it's going
Exactly.
to work in July. But yeah, people
Right.
are filing it with their.
It's
their
exciting.
taxes.
I mean, people are excited about it.
And as we talk about sort of incentive, we've definitely built a system for long-term savings, but we're seeing people use it for short-term needs. Is that a design flaw, or do we need to kind of build something new?
Yeah, John, if you move to the next slide, it's interesting because this slide talks a bit about intersection of emergency savings and defined contribution plans. We'll hear a lot about that this afternoon. Again, making smart decisions about when to take money out of the plan or not. I think the health savings account is an interesting example because that's an account that if you have the luxury of being able to save and not spend from that, it's triple tax advantaged. So you would think, well, great, why wouldn't everyone take advantage of that? Yet, people view it as a savings account and most people are paying expenses out of it. Well, I mean, first of all, they're connected to high deductible health plans. So people need to use the account to pay down some of those deductibles and other out-of-pockets. But I think it's interesting if, perhaps if the health savings accounts were expanded, more people had access to them and they weren't tied to a specific type of plan, there might be more usage that encourages people to save that money for long-term health expenses, pay down healthcare in retirement.
Is there an education campaign that needs to go around that too, or you think that people have the information? Because people will put the money in, but they don't invest it. But maybe that's because they think they're going to need it in a couple of years.
I agree. I think, and I know Debbie's going to talk a bit about this on the panel about optimizing retirement accounts. I think I'm not going to say misinformation. I think people are not well informed about how health savings accounts work. There was a stat that at our financial well-being symposium, I think it was like 90% more of people who have a health savings account said, I wish I understood it better. And I don't want to steal. I was going to give a quote, Debbie, but I won't. I'll leave it for you. Anyway, you'll hear more about that later.
We're also going to hear from our innovative startup companies, Macruity for Us All, Basic Capital, Savly. They're tackling these type of gaps. What they are looking at overall, is it better tools or changing behavior?
I think it's both. So first of all, I thought it would be fun. These are the 12 startups that we've had over the past 3 years at our symposiums. 4, of course, you'll meet them today. But these startups are very interesting. I haven't tracked all of them, but I believe most of them are still here, thriving, growing, and having an impact. And I think it's very interesting. So some of it is tools. Some of it is the use of artificial intelligence for creating efficiencies. But I think also a lot of participant behavior kind of nudges and personalization coming out of these kinds of solutions. So I think it's so exciting as someone who was involved in innovation in my prior life. I always look to see what startups are doing as a kind of hope for the future, trends for the future. So I think very exciting. And you'll hear from 4 fun startups today as well.
And not to put you on the spot too much, but is there one that you think would be the one to scale?
Oh, I better not. There are like a lot of them are members, so I'm not going to pick one. Yeah, it's like picking a child. I feel very protective of them. No, but it really is fun. I mean, I've seen some of them like, I think even like Candidly and Addition Wealth I've seen at the World Economic Forum. I mean, these are like really, really interesting that they're, making a difference and being seen as truly something unique and innovative.
Now, another innovative idea that gets talked about a lot is putting private assets into 401ks. But now we're seeing signs of stress in private credit, we think, depending on who you ask. Are we introducing complexity and risk into a system that was really built for simplicity?
Yeah, I mean, that's like the $100 question. This is where I say that whatever I say here does not represent EBRI. It's just Barb Marder. We don't take positions on anything. We have a great panel this afternoon that's going to talk about this topic, as well as we have a panel on guaranteed income as well. And we really very intentionally created the panel to not really talk about sort of, is it good, is it bad, is it going to have, it's really, the train's kind of left the station, executive order, we're still waiting for this guidance that, is supposed to have come out. But how is the industry coming together to enable this to happen in a responsible way? And I think that's what's really important. So we'll hear from our panelists this afternoon about that. It's very interesting. I opened up Ignites yesterday. I don't know how many of you get Ignites. I'm not I'm not pushing Ignites. But I opened it up, and the first thing I saw was, we want you to vote, have private credit blow-ups doomed the 401k alts campaign. So this is going to be just a continuing conversation as the market evolves and things happen. But I do believe the industry can come together in a responsible way to make this happen, because it feels like it's going to happen.
And do you see that sort of the private markets are starting to become, or will have to become, more transparent in order to get these type of dollars?
Yeah, I remember I read some article where someone said, if private markets are everywhere, aren't they public markets then? So I don't know. So I think it'll be interesting to see, again, as what happens with transparency, what happens with liquidity, as these markets evolve and they become more broadly available. Do they stay kind of the way they are? Or, is there daily valuation and things like that? So I feel like the whole industry is going to evolve around sort of this happening.
Well, let's talk about almost the flip of private assets in 401k, which would be Social Security, right? You're stable, hopefully. But people are really concerned about, is it going to be there? Is it going to go over the cliff? If it goes over the cliff, how long will it go over the cliff? With all that kind of uncertainty, how should people be thinking about Social Security benefits? Are they going to be there for them?
I am so excited about the panel we have this afternoon. I can't wait for you to hear what these folks have to say. They are very passionate and thoughtful about ways forwards for Social Security, because I think right now everyone feels very nervous. The numbers come out, the trust fund's going to be insolvent, what's going to happen to my benefits? And you can see these numbers from our confidence survey just go up every year as there's more and more uncertainty. So I'm excited to hopefully really start the dialogue about how we start to solve this. What's the approach? What's the process? And hopefully more, really more to come on this. But I do think people are very nervous and are kind of acting around it to make sure that they're able to get what they think they should.
Shifting the culture and the tone from the deep topic. If we could call up the next slide. With people having to save on their own more, especially with Social Security being uncertain, is saving becoming more cool now?
I think 401ks are very cool. So just so you know, I actually, it was a CNBC article that somehow came across my desk about the quarter zip and a 401k mullet. And I was like, what is going on? I was very excited, so I started tracking it down, and I couldn't, it was so funny that it was CNBC, but then I saw this Vogue article about, the hottest guys have the 401k mullet. I'm not sure what a 401k mullet is, but here's how it's described. It's business-like in the front and like party in the back. So it's very fun, and the rapper T-Pain is the one who started it. He posted this picture of himself, and if you go online and look at other Instagram posts of this guy, he is like all over the place and like disco. I mean, it's crazy. And there he is with his quarter zip and his 401k mullet. And truly, the story really is that the 401k has become a symbol of maturity, of like sophistication. And one of the articles that sort of picked this up said, they said, what used to be boring, the 401k, is unattainable and therefore sexy. So I think that's very cool. but it does kind of suggest, and then there was something else in the article. There was a woman who was quoted saying, like, I would never date anyone that doesn't have a 401k. Like, what? Why would I? So anyway, I think it's just fun. Like, we wanted to end on something fun for you, so let's not take ourselves too seriously.
And then if we come back here in 5 years, do you think we'll have made progress?
I do think we will. I think between what was passed in Secure already, that's, you know, started, going to start, like, again, the savers, there's things that have already been passed that are going to go in place. I think there's, you know, so much buzz and proposals and interesting things about, you know, private employer provided plans and coverage. And I really think in 5 years, we will be in a very different place. We'll have early wealth building and more people saving for retirement, and hopefully,
And it'll be cool.
And it's going to be cool. Absolutely.
Well, you have a great panels coming up, so
Thank you so much.
We'll get to it. Thank you.
Okay. I want to call up my good friend and colleague, Jason Jagatic from Fidelity. Jason is going to share. Jason's going to share some hot off the press Fidelity research about the 11 trends shaping the future of plan design. So over to you. Yeah.
All right, so I think the thing I just learned is I don't have a mullet, and clearly I think I met the criteria for not being one of the hottest guys in the category. But anyway, thank you for having me here today. Really honored to present some fresh data for you all today. And so the theme of this presentation is the theme of pushing through uncertainty. So one of the fun parts of my job, and I think I have one of the funnest jobs at my company, is I get to interact a ton with our clients. We've got thousands and thousands of clients. I get to work with the teams that engage with those clients. And then I've got also teams of researchers and try to pull all that information together. And what I'd say over the last few periods, over the last couple of years, what we've seen is we've seen this and sort of the shift in some of the employer sentiment, where we definitely saw coming out of the pandemic a lot of burnout and a lot of tension. And we definitely still see that trend overall. But then we saw, going back to late last year, there was a lot of talk about, hey, there's so much uncertainty. I don't know what to do. Can you help us navigate a trend? And then really what we're starting to see now is people just starting to take action, and they're really starting to push through that uncertainty and saying, okay, uncertainty's here, we just got to deal with it. Again, not everyone, not all the time, but it was just an interesting trend. So as part of that, I thought I would share some data from our new report, and that'll highlight some of that information and set a good baseline as we talk about some of the innovation and other activities later today. Make sense? Great. Okay, so before we get into that, I'm going to start with a story and maybe a little bit of a question. So I'm going to ask the room here, can anyone identify where this photo was taken? And don't say from a drone or from the top of a cliff, but can anyone identify this? Yeah, it's a bit of a trick question. Let me give you a hint. If I now show you this photo, can you tell me where this photo was taken? Right, so this is the Golden Gate Bridge in San Francisco. And the reason I show you this photo is I think the story of the building of the bridge is actually a really interesting one. I'm a middle-aged dad, so that means I watch a lot of documentaries and that sort of thing now, right? But when you look at the story of the Golden Gate Bridge, it was built in the 30s, and at that time, the city of San Francisco was facing this interesting inflection point. It had gone through massive growth, and in the previous 30 years, the population had grown 85%, but they were starting to be constrained. They've got water on 3 sides. You know, there's no real way to grow unless you literally build a bridge to the mainland and for the future. But the problem is there was a lot of uncertainty, and it was a tricky situation. So more specifically, if you've ever been out there, the winds can be ridiculous, and they can topple even the most impressive structures. The water is deep. A bridge had never been built to that level of depth before. And then getting the capital to do this work was really tricky because the Great Depression was there, right? So it was a really tough situation, and there was a lot of uncertainty for city leaders. So the interesting thing here is that the leaders chose to act anyway. There was a ton of uncertainty in the situation. There was a lot of things that no one had ever done before. But they said, let's go, we got to do this, we need to move forward. And as part of that moving forward, once they started taking action, they invented things along the way. They invented a new suspension cable. They knew safety practices and some really cutting edge engineering capabilities. So, the reason I like this story is the fact that they took action that really ended up creating clarity and opportunity. And it was a really tricky situation, but they found a path forward. They created their momentum that fueled the innovation. And I think the retirement industry is actually in a really similar spot today. So, I think, to bring that analogy to our space, I think we're in a situation where we've got this massive population that's making that transition from accumulation to decumulation, and we've never quite seen it at these levels without DB plans to the same level that we saw before. The situation is more complex for them, not just environmental complexity, but there's a growth in the number of products and options, and people have more expectations of personalization and specialized services. And then lastly, and I think this room's a great example of this, is it's a really complicated space. There are numerous stakeholders, public, private, different angles, and so it's important that you bring all of those together. So there's definitely a lot of complexity, but that also breeds opportunity. So again, Jason Jagatic, I lead our workplace strategic research and thought leadership team at Fidelity. We have the pleasure of serving about 50 million Americans and about 30,000 clients. And so some of the data that I'm going to show you here, comes from a statistically relevant sample size in most cases. This is the report that I'll be pulling information from. I'll show the QR code again at the end if you want to download it there. And I'm not going to go through every single trend today, just because there's so much information and so much detail in there, but I'm going to focus on 4 things. So one, I'll talk about some of the trends that we're seeing around participants and participant engagement, talk about overall balances that we're seeing in retirement plans, what we're seeing in terms of withdrawal activity, and then investments and broader benefits trends. Make sense? Great, okay. And I'm going to stay on time. So that's the other piece. So in terms of overall engagement, what we're seeing is, I'll start with auto-enrollment, right? This is a key tenet of the retirement system. And what we're seeing, what the data shows us is that almost half of plans now offer auto-enrollment. That number goes up dramatically as you get to the larger size plans, but this is across the overall population, and that data continues to grow. So over the last 15 years, that's gone up about 25 percentage points, and with Secure 2.0, we expect that to continue to grow, obviously, because it is a requirement for new plans to offer auto-enrollment. And then, one of the things that we'll often talk to employers is, even if you choose not to offer auto solutions, you really should be thinking about different ways of reducing the friction for your employees to get them saving for retirement. So again, not everyone needs the solution, but there are still ways of thinking about reducing that friction. So that participation story is part of the story, but another piece to it is engagement. And so we always want to know that people are participating, but how active are they? And so our definition of engagement for this research is listed here on the left-hand side. So at a high level, we think of people who are unengaged. You're not calling us, you're not checking your balance, you're not doing anything over the last year. You're engaged if you've checked balances, called, done some basic transactional stuff, and then you're highly engaged when you're doing deeper planning, more sophisticated, and interacting with us more. So why do I call that out, and what's interesting there? So we then take a look at, okay, what does that impact to how engaged are auto-enrolled populations versus those that choose to enroll or who proactively enroll? And so here's some of the data that shows that. And not surprising, those who are auto-enrolled aren't participating or aren't as engaged at the same levels in aggregate over time, which makes sense because if you've actively chosen to participate, you tend to be more, more intentional, more specific with your needs. But again, what I would remind you here is this data is on average across the overall population. And so as we segment this further, we see engagement rates or unengagement rates drop extensively as people get closer to retirement and as their assets and financial picture grows in complexity. And then the other note I would also make here is more engagement is good generally, but it's not just about activity, right? So the solutions that we have in this space are auto solutions for a reason. They're good for most people much of the time. And so you don't necessarily want everyone day trading in their accounts and engaging all the time. So there is a balance here, but just wanted to highlight that. Okay, so now what's interesting here is participation's good, engagement is what we're striving for, and when you can when you can bridge those two things together, I think that's where you get some interesting facts. So a couple of data points as well is that for the average balance for employees that are highly engaged, excuse me, that are highly engaged is 2.5 times higher than the average balance for engaged clients is 2.5 times that of unengaged. And engaged employees are 3 times as likely to have significant emergency savings, at least 3 months worth of emergency savings. So we see goodness overall in this data. Okay. Again, you'll be able to see all of this in the report at the end. I just want to give you a taste today. And speaking of a taste, I see Barb's bringing me some water to save me, so thank you. Great, thanks, Barb. So the next piece here, and I'll shout for 1 second. The next piece here is overall balances and contribution trends. And so there's some discussion about this earlier as well, but what are we seeing in the data in terms of are Americans saving? How much are they saving? What are the high-level trends? So what this chart shows us is a few things. So the top line in green shows the average that an American is saving towards retirement, or really toward what an average Fidelity participant is saving on our platform. And so the average contribution rate is 14.2%. Excuse me 1 second. Not pretty. Another data point why I'm not part of the hottest guys category. But so the data point here is 14.2% is actually a pretty good savings rate. Our guidance generally is 15% between employer and employee contributions is what we historically suggest to Americans. And this is at an all-time high. We're really seeing the benefit of I think, the Pension Protection Act and many of these systems. Auto-enrollment, auto-increase programs are really continuing to drive that up. That participation rate goes up for people who are older and more tenured. Again, auto-increase programs tend to help in that way. And about 2/3 of the savings come from the employee and about 1/3 from the employer. So both of those play a significant role. And then when we look at our tax-exempt clients, so those who are in 403Bs, 457 plans, we do see lower overall numbers, which again isn't surprising just because still in many of these plans, DB often plays more of a role, and it's just a bit of a different structure, and auto-enrollment isn't always an option there. Okay, so here's a common data point that people love to understand, or sort of what we're seeing on our platform as well. And this is what are other employers doing, and what are the key trends. And so on this slide is a breakdown of match rates and what are the most common match rates that we see on our platform. And so about 8 out of 10 employers are using ones that fit within a safe harbor plan. And so I think that's a really key point here. It really highlights the importance to give employers guidance, certainty, clarity in terms of what they can and can't do in this space, because I think no one wants to be in a position where they're facing litigation or operating outside of the rules of the law. So we see a really powerful feature there. And then Roth adoption. This is also, continues to be a hot topic here. In terms of overall Roth adoption, we're seeing that about 95% of plans are offering a Roth 401k plan. Again, Secure 2.0 has helped to drive some of that growth. And the people that use Roth overall, we're seeing about a 17.5% adoption rate of Roth, but that goes up it's much higher for those who are engaged in our platform versus those who are unengaged. So far, so good. A lot of data. You ready for the quiz at the end? No, there's no quiz this time. This time, maybe next time. Okay, so then now let's take a look at some of our withdrawal data and a couple of things to highlight here. This was touched on a bit earlier, I think, on the panel as well. So overall, we have seen an increase in hardship withdrawals, and this takes us up to pre-pandemic levels overall. So we saw a bit of a dip, and then we saw an increase. About 3/4 of those withdrawals are under $2,000, and also about 3/4 of those are driven primarily for housing, medical costs, and education, right? So those are some of the key drivers there. But I think one of the interesting points is that if you do not, as an employee, if you do not have adequate emergency savings, you're 5 times as likely to take a hardship withdrawal, right? So it really shows the importance of having that secure foundation. So this chart, I think, is also an interesting chart, and it talks about withdrawals overall in terms of what we're seeing on our platform. And so let me explain this one a bit because there's a lot going on. But overall, if you take a look at the green line on the bottom, the lower one, what this is telling us is overall we are seeing an increase in withdrawal activity from 401k plans over time. However, what the dark green line says is the average transaction amount is coming down. And then the blue line at the bottom says money out is relatively flat, right? So I think this has been a really common area of conversation with employers where they're saying, hey, I think we're seeing a lot of excess activity in terms of our 401k plans. What does that mean? And at least thus far in the data, like some of these provisions are still new and we'll continue to track this, and this isn't predictive. But what we're seeing right now is that the money out is relatively flat. So what that also suggests to us is this is improving accessibility. So instead of taking one large lump sum, people might be taking the money in smaller chunks as they need it. Okay, section 4. The last section before we wrap. You still with me? All right, good. My voice is coming back. Oh, look, I just jinxed myself. But anyway, okay. So here we go in terms of, we'll flip it a little bit and take a look at investment plans, investment plan design, funds, and funds that, the information that the fund lineups and things that are of interest to investment committees overall. And so I'd say one of the trends that we've been tracking over the last number of years, this data goes back 10 years, is the trend of simplification of plan designs. Overall, we've seen a trend where employers have been shrinking the number of investment options in their plan design for a number of reasons. 1, to gain economies of scale, 2, to simplify the user experience. There are a number of reasons, but we saw this longer term trend, and that's what this data shows us. And it also shows us that it's magnified at the small end of the market and in the large end of the market based on plan size. So that's what the x-axis is, the size of the plan, and then it's the number of options 2015 to 2025. And so those have been decreasing, steadily decreasing as people have tried to consolidate, as employers have consolidated their plans and made things simpler. However, that we may be at an inflection point here. I think some of our survey data is suggesting that employers are actually looking to start to add more options again. And thought that was an interesting trend. We're not seeing it necessarily in all the record-kept data yet, so that's something we're going to be looking at over the course of this year. But again, when speaking to employers, what we hear on this front is, yeah, we shrunk things down, but our workforce has changed. They have different needs. The economy's changed. We didn't really have a good solution for inflation before, so let's add that in. People want more personalization. We're looking to provide more personalized managed accounts, and we need more building blocks to create more personalized strategies. So we may be at an inflection point there, which is something we're going to watch. And then, you can't talk about retirement without talking about target date funds. And there's a little bit of discussion in the last panel about, it was more on the HSA side, but if people are people sitting just in cash, and what actions are they taking, or are they taking actions or not realizing if they're invested or not? And that was a big concern of ours in the retirement space, still is always. We want to make sure that people are operating intentionally. And when we look back in 2014 on this data, what we saw there is a large percentage of our population was either 100% in cash or 100% in cash or short-term instruments, or 100% in equity. That could be right for some people, right? And people are complicated, they have complex situations, but it is a watch area that we look for that are they doing this intentionally or not? Or do they know, do they have the appropriate education? And so that's a measure that we track. And so what we're finding is that back in 2014, about almost 15% were in that situation where they were at an extreme position, and that's come down to 8.3%. So maybe a 40% or so drop in that data, which suggests that target date funds with their auto allocation adjustments and the auto enrollment solutions are really helping to get people into the right solutions and into appropriate asset allocation trends, giving more of the population more of that diversification that we often recommend. Okay, and then the last slide for data before you all download the report and take a look at it online is, we also had this conversation about, do retirement savings and other solutions, do they crowd each other out? And what happens if you provide employees with too many benefits? Do you overwhelm them? So I'll caveat this to say this is Fidelity data of customers that have Fidelity products on our platform, right? But what we find is we see an overall lift for people who have multi-product and multi-capability solutions. So if you have multiple benefits, for example, you also have, we're working with you to provide an HSA or your equity comp or emergency savings solutions. We end up seeing a lift in participation rates, engagement rates, and overall we see healthier savings behaviors. And so we attribute some of that to the fact that through a more integrated experience, you've got more touch points that reinforce engagement with the users. So we don't quite see that crowding out in this data here. All right, so that's the data. Ran out of time for the quiz, but just to make sure, sort of to connect some of the dots here. Have to throw in a pun if you know me. And so as we look to bridge into the next phase of retirement, a few things, a few takeaways that I hope you've got from this so far is, one, it's really the importance of balancing short-term and long-term for savers. I didn't go as deep into that into this presentation, but we see that really as a really interesting opportunity with Secure 2.0 through emergency savings and student debt provisions, how you can engage people on their short-term needs while also helping them for their long-term is a really powerful combination. Two, the importance of safe harbors and clear guidance. The less risk, the less litigation risk you can provide to an employer, the better, and it just helps them with the overall adoption. Automatic solutions are a great start. They really help people take action. They really drive positive behaviors in general and what we're seeing overall. But you also want to make sure that those are personalizable, right? So they're a good place to start, and it's better to take some action versus no action. But as people's needs change or as they have different preferences, you want to make sure that you can support that. Again, the continued public-private partnership, I just think, presents a really unique opportunity in this space. And then lastly, people are more than just their money. And so we're looking at the data, we're looking at the information here, but you have to think about them holistically to encourage the appropriate behaviors and to make them succeed. So that's a little bit of my story for today, and thank you for the time. I'll be around for questions during the breaks if you have any, but please download the report. I get paid per click. No, kidding. So I'll be up in the corner clicking after this. But anyway, thank you.
So we're going to be talking about innovation this morning. Hi, David. And obviously there's a lot going on in the retirement industry, which is great. And we've got 4 great firms that, as Barb said, have really been innovating. Rather than me introduce them, we're going to have each of them introduce themselves, their organization, and kind of the thesis behind what they're doing. So let's start with Dario.
Okay, let's switch mics.
Switch mics again.
So Dario Fusato, I'm the co-founder and CEO of Sably. At Sably, we are building the financial infrastructure for longevity protection. What does that mean? Well, you know, the problem that we are all facing, that retirement accounts and the financial infrastructure retirement accounts does not sustain very well longevity. Longevity risk is the risk of outliving your retirement savings. So we are coming out with a new category. We call it longevity benefit. It's a financial instrument designed to protect people from longevity risk. Our objective, our aim is to launch within the workplace benefit as a new pillar, a longevity benefit that is provided in parallel alongside retirement plans and health benefits.
Very good. Abdul?
Thank you, Jeff. Appreciate it. Good morning, everybody. Thank you so much for joining us today. My name is Abdul Al-Assad. I'm the co-founder and CEO of Basic Capital. I want to thank EBRI and the Milken Institute for giving us the opportunity to share with you today what we're building. We're solving the earlier problem that Dario is trying to solve. So Dario is trying to build a deaccumulation product that helps people hedge the risk of outlasting their lifetime savings. Our goal at Basic Capital is to help people accumulate savings throughout their life. And we're doing that via building a new mechanism called the retirement mortgage, where we enable people to finance a basket of assets, a diversified portfolio of stocks and bonds, just like they can finance a home or a car or education. The core thesis here is that asset ownership and private saving is the most important thing a person can have in order to not rely on Social Security, in order to have a meaningful nest egg when they reach retirement. And the problem with savings is that it takes a really long time to accumulate wealth. So what we have built is a mechanism where people can front load their lifetime savings and invest it in the market and hold it for 30 years. So when they reach retirement they have a bigger base to retire on, similar to buying a house, where instead of saving your entire life to buy a house, you buy the house first and you pay it over your lifetime. We pioneered this mechanism. We're a 401k record keeper, and we're now the fastest growing company in the category. And I'm excited to share more about what we're doing.
Yeah, thanks, Abdul. Elizabeth?
Good morning, everybody. Elizabeth Heffernan with Micruity. I head up our partnerships and consulting strategy. And we're a technology firm dedicated to simplifying retirement income. We kind of bridge both the accumulation and the savings arenas, the decumulation arena. We were founded by our CEO, Trevor Gary, back in 2017, and he had been working in the pension space, mostly in the closing and terminating pensions. And he had this really significant concern about what are all of these just average people gonna do? And so his initial inspiration from that was to help them be able to buy small bits of annuity over time, hence the name, micro annuity, Micruity. I find that I have to explain that a lot, so I'm giving you the heads up, Micruity. So, like a lot of founders, he's looking for ways to pitch his idea, and he goes to Vegas, to InsurTech. And in talking there, he meets a number of individuals, he's Canadian, that say, that's a great idea, but you need to come help the US in the defined contribution space, because there's a lot of folks with similar ideas, a lot of insurance companies, asset managers, trying to pitch the same thing, but there's a big disconnect in how that can work in traditional record keepers. And so we really think that you could come focus there and make a lot of progress and help with that disconnect. So we'll talk a little bit more about those disconnects and how we're simplifying retirement income as we get further into the discussion.
Thanks, Elizabeth. And lastly, David.
Yeah, hi. Thanks again for having us. So I'm David Ramirez, co-founder and CEO of Forasol. And maybe the best way to think about us is we're a retirement technology research lab. We've been around for about 10 years. Myself and my co-founders, we all were the team that designed and developed the Financial Engines Managed Account Program and later extended it to provide retirement income. But around 10 years ago, I began to really understand the retirement gap that we all talk about. And now it was kind of surprising because at Financial Engines, we worked mostly with Fortune 100 companies, and these were great plans, super low cost, a ton of personalized help. Then we look at the small, mid-sized market. What we see is that the costs are 3 to 4 times more expensive. Participants aren't using it if it's available, and most companies weren't even offering a 401k because of the administrative and compliance burdens. And so at Forasol, those are the 3 core areas that we seek to solve. First is by providing a fully automated, not just payroll integration, but 316 fiduciary so that any employer, regardless of size, can ensure with a guarantee that their plan is going to be run in a compliant fashion. To drive higher participation, it's really been around providing personalized communications to employees that when rolled out, generate about 90% participation and 8% savings rates. And lastly, expand engagement by going beyond the traditional 401k investments to include other asset classes, like alternative asset classes, private equity, venture capital, and cryptocurrency.
I told that the mic works. That's great. And I promise you were not going to be on an episode of Shark Tank. So that is number 1 or number 2. You kind of touched on in your thesis what was maybe lacking in the marketplace. Let me ask you, and we'll start with David. How does your innovation benefit the plan participant, the end user, the consumer?
Yeah, so first off, you're not a plan participant unless your company offers a 401k plan. Our first core offering is called Forasol 401k. And essentially, it allows the employer to set up a 401k, launch it in the matter of minutes, and it does that by making it super easy for the employer to integrate with their payroll system. So we support over 500 payroll integrations and combine that full scope 316 fiduciary. But for participants, it's really about speaking to them via the modalities that they're accustomed to. So our communications are, of course, we're going to send out the summary plan description when you're eligible, but we send out Dave, your virtual advisor, who can ask you what's important to the participant and then make it super and easy for them, leveraging behavioral science to sign up for the 401k. And then continue to engage them by providing particularly younger employees access to asset classes in a prudent fashion that they're excited about. And so for us, offering the ability for participants to invest in cryptocurrency, a small portion of their account, less than 5%, was one of the keys that we saw that resulted in higher participation, higher savings rate, and higher utilization of Roth.
Yeah, well, we're going to talk about cryptocurrency in a few minutes, but Elizabeth, I want to transition to you. How does what MyCruity does really benefit the end user, that participant in the qualified plan?
Yeah, so there's a number of ways that the solutions that we're supporting, so we're not actually creating solutions. Really the focus is how do we bring these really strong, innovative solutions that are coming to market from both insurers and asset managers and make it easier for record keepers to be able to support those products without having to do a bunch of tech development on their side. And at the end of the day, the key is that these solutions are designed to help a participant really have a very strong engagement. I love, Jason's topic of engagement. Like when you look at the research, most participants, especially average participants, think their target date fund is going to turn into income. But most of the time, it doesn't. And so then they get to the retirement and they're like, what do I do? So the solutions that we're supporting actually will allow a participant to not only understand the solution, model what income could look like, but make elections and end up with money in their bank account that they can spend. So we take, and that is all uniquely positioned based on the particular product. So it's not a general planning and education tool that says this is what you could expect. This is what you will get. And then going through that election process, capturing all of the information that an insurer needs, which by the way is very different than what some record keepers have, right? When I, prior to joining MyCruity, I was at Fidelity, and my running joke was that I was in the Heisman chair, right? Somebody would say, it's super easy, you just have to do this, and I'd be like, ugh, yeah, record-keeping platforms don't do that. Like, record-keeping platforms might have spousal information, but they don't have to have spousal information. But an insurer who wants to issue a joint annuity has to actually know who that person is, when they were born. How are they going to do that? So the design here is to supplement, complement things that the solutions need without putting all that burden on record keepers. So at the end of the day, as a retiree, I get a check in my bank account that I can go spend.
And Abdul, we're going to talk about the retirement mortgage concept in a second, but tell us about the end user and how they benefit from basic capital.
Yeah, of course. Listen, we solve the single most important problem when it comes to building wealth, which is the lack of capital to invest. Right? If you take a step back and just try to think about what we're trying, like what are we all in this room trying to do? We're trying to get to a point where everybody have enough private savings so they're no longer dependent on the government and they're no longer dependent on their relatives and loved ones, right? And in order to build wealth, you need three things. You need access, and that's what For Us All and Invest Well and Human Interest and all these record keepers are solving. Access is really important. Largely solved problem. You can set up a 401k plan in 5 minutes now automatically. Two, you need education. That's what MyCruity is doing, educating the participant about, hey, here is how much money you have. Here is what does that mean in terms of a lifetime income. And then you need capital. The vast majority of Americans do not have the capital to invest, to save. Take a step back. Think about the numbers. The median income in America is $79,000. The median cost of living in America is $100,000. That means everybody is living about 20K short, month to month. Everybody in this room relates to this problem. People don't save, not because people do not invest, not because they are ignorant or stupid. That's perhaps like one of the reasons. Education is important, don't get me wrong. But people genuinely lack the means to buy assets. And our radical proposal at Basic Capital, and we can dig into this deeper later, is we're going to give you the financial resources you need to have more money in the market at an earlier stage in your life, pay it off over time, so by the time you reach retirement age, you have more money in the market. That is our core value proposition to the participant, is that it takes money to make money, and we give you the financial resources to have greater participation in financial markets at an earlier age.
And Dario, you talked about a new asset class for participants, but tell us how that's going to benefit participants. What does it mean to their independence, their financial security?
So, by the way, this is a fantastic question. And I really like what Abdul just mentioned. But honestly, coming from the other side of the world, I would say that when it comes to growing wealth and securing their retirements, millions of people, starting from myself, fear that they will not have enough. The fear of becoming a financial burden on their children or their family, of not transferring enough wealth. And the entire industry is being focused on income. It's being focused on how can I make sure I have enough money, okay? And the entire ecosystem is focused on mitigating what you guys called expert accumulation. The reality, at least my personal reality and the people surrounding me, is that we need protection. Meaning that I want to make sure that if I'm a good American, I save, I have a regular life, I will not run out of money no matter what. So we fear, I mean, maybe I'm the only one, but I always felt that, oh my gosh, what's going to happen if I'm going to be like my grandmother that stays in a nursing home for 15 years? What happens if I'm in these machines connected at the hospital for 5? Will it be a financial burden? How do I mitigate the tail risk of this very low frequency, high severity scenario? So that's why we built Sably, which is a longevity protection, is an investment that pays you a large amount of cash upfront later in life, every 5 years starting at 80. And the team over there, maybe, I didn't plan it, but you can share that illustration of the longevity benefit, because to answer your question, sorry, I'm Italian, I speak too long, but how do you benefit, how do you benefit from a financial product that works like that, right? It works like a small investment that you make, typically no more than 5% of your retirement savings or contribution, that kicks in later in life and use longevity pooling to provide exceptional returns compared to the S&P 500. Well, the day that you know that you are 65 or 73, and you know that when you turn 80, you get a big lump sum, let's say $300,000. That lump sum goes on at 85 and then 90 and 95. For the first time, you can spend more money today. First benefit. You can potentially retire earlier, because if you know that your accounts get replenished with cash, not income, cash, protection, you can not only retire early, actually, but we can transfer wealth to your family more easily, because you are less afraid of becoming a liability. Financial advisors, not direct clients, can actually trade and be more aggressively on their traditional retirement accounts, right? Why? Because they can aim and they can accept a higher level of volatility. You guys are super experts. I've never seen such a competent, well, expert audience. Frequency of return risks, right? Everybody's super afraid of frequency of return risks, so they've been 30 years on debt instrument like bonds, right, that have maybe 300 basis points gap against the market. So the entire focus on the industry has been investment and long-term protection that was not very effective. We focused really on the tail risk of becoming a financial burden. If we build a lifeline, you can enable greater lives. Thank you. Sorry, too long.
No, that was great. David, I told you I'd come back to you. I'm very interested to hear about cryptocurrency and how opening a crypto window, digital asset window, correlates to participation, especially amongst younger cohorts.
Yeah, so it was funny. I was talking to some folks last night at a dinner who've been in the industry for years, and their response to the idea of cryptocurrency in the 401k was basically the same response I had when one of our investors and advisors suggested we look at adding it, which is, that is an absolute crazy idea. Do you have any idea of like the fiduciary responsibility that we have in a 401k, whether it's plan sponsors or as advisors? But after blowing them off for 3 quarters, I realized, you know what, this is going to be career limiting if I don't at least placate him and spend some time looking into it. So I did. Now look, I'm a student of Bill Sharp. In my core, I am a incredible adherent to modern portfolio theory. And so the first question that I asked was, well, is there any reason, are these beanie babies, right? And as a technologist, I went deep into the space and, oh my gosh, lo and behold, we've got Walmart who's using blockchain for supply chain management. We have De Beers who's using blockchain to verify the provenance of the diamonds. You look across technology companies and blockchain is ubiquitous. And frankly, most of the largest open blockchain networks there is no stock that you can buy. The only way that you can invest in these technology platforms, which fundamentally are compute platforms, is by buying the cryptocurrency asset, the token. And so, okay, so there's a reason for that. There's a reason for this technology, and there's a reason why investors are buying it. But then I asked myself, I looked at the market, and I saw, at the time, about 2 to 3% of the overall global market portfolio was invested in digital assets. And as a student of Bill Sharp, I kind of asked myself the core question, wait, if I'm going to exclude this asset class, am I taking an active bet? And in fact, you are. And then, given our fiduciary responsibility, I thought, well, if I'm going to take that active bet, I better be damn well sure I know who I'm betting against and what this technology is really about. And so, for that reason alone, we decided to offer cryptocurrency. But of course, it is a highly volatile asset class, and I do not want anybody to lose a material amount of their money. So we structured the program so that employees can invest up to 5% of their account in ongoing contributions into cryptocurrency. And what we found was for those clients that launched it, we saw about a roughly 50% increase in savings rates and a nearly 50% increase in the utilization of Roth. And so given that, you don't have to agree with me that there is a potential benefit for this technology, that it should be included as part of the global market portfolio. No, you can deterministically hold the belief that crypto assets will go to zero. But if allowing participants to invest a small amount in cryptocurrency results in higher participation, higher savings rates, then even if you believe all crypto assets go to zero, participants are likely to be better off.
Abdul, I told you I'd come back to the retirement mortgage. Let's talk about balancing, how it works, but also balancing future debt, someone taking on debt.
Well, we'll come back. Listen, let's kind of try to take a quick listen history here of what happened in the 20th century. In the 20th century, we were terrified in this country that communism was spreading in Europe. And we were worried that in America, we had unmatched levels of wealth inequality very similar to the one we have today. And the public policy was like, okay, these Americans seem to be buying in too much in this idea of public property. How do we promote private property? So we created what arguably is the best financial innovation of the 20th century. And the best financial innovation of the 20th century is the 30-year amortizing loan. Today, 63% of Americans own a home, one of the highest home ownership nations in the world. 2/3 of the American middle class wealth is actually in the form of home equity. Debt is a really powerful tool for ownership. There is an economist from here, from DC, her name's Sarah Woolley. She published a book called American Bonds. And the thesis of the book is that credit has always been a public policy to promote ownership. When we came to this country and wanted more people to be farmers, what did we do? We give them loans to become farmers. And we wanted them to become homeowners. What did we do? We give them loans to buy a home. And we wanted them to become car owners so they can drive to work 20 miles away. We give them loans to buy cars. When education was perceived to be the protected asset before AI, we give them student loans. Credit is just a tool. It can be used for a productive purpose or unproductive purpose. In this country, we send credit cards to people's doors. Just let that sink in for a second. There is $5 trillion of outstanding consumer credit that we use for an unproductive purpose. And our radical thesis at Basic Capital is that just like you can finance a car that loses 30% of its value the moment you drive it outside the parking lot, why can't you, as a plan participant, put 20% down payment, let's say $20,000. Basic Capital will give you $80,000, 30-year amortizing financing at 6%, so it's lower than the mortgage rate. And now you went from having 20K in your 401k balance to 100K. Duration financing, no mark to market, no margin calls, just like a house. And the benefit of starting with 100K versus 20K on a retirement outcome over 30 years is massive. Massive. Every retirement problem we're talking about, not having enough to save, annuities, lifetime income, social security, all this jujitsu that we're doing in this country is because of a very simple fact. Americans do not own enough of the market. 50% of Americans are assetless. 40% of them are asset light with an average balance of $27,000. And the top 10% own all the assets in America. And if you can buy now, pay later a Coachella ticket, and you can buy now, pay later a house, and you can buy now, pay later virtually anything, why not buy now, pay later the 60-40 retirement portfolio? The only way to solve the retirement crisis is actually to make people dependent on themselves and to have a large nest egg. But we all know it takes money to make money. So I genuinely believe if like you can, Social Security, you want to solve that problem, you know, you can cut benefits, you can increase taxes, highly politically unpopular. But the only way to create a long-term solution for Social Security and wealth inequality in America is for everybody to have enough money to retire on. So our retirement mortgage idea comes inside the 401k. You get non-mark-to-market financing to buy diversified professionally managed asset, S&P 500, bond funds. You can decide to go 100% equities. You can decide to go 60-40, 80-20, whatever you want. And you pay off this financing over your lifetime. And the benefit is you get more money working in the market for you at an earlier age.
Elizabeth, I want to talk to you about lifetime income. How do you simplify the delivery and remove the friction points for lifetime income? Because that's an important part. You've got to be able to educate, communicate, and get people to actually select the product.
Yeah, so I think, you know, the interesting thing about what Abdul is saying is like some of these solutions require a lot more data or information to track at the individual participant level than traditional record keeping does, right? A traditional record keeper and accumulating value doesn't care how old you are, right? It doesn't matter if somebody is, you know, 18 and then 38 and 48. If they all put $100 in today, it's going to have the same value in the same investment of, you know, shares times price. And as we looked at some of these solutions, they needed a little bit more data in order for those values to be tracked. And so that was one of sort of the first big disconnects when I talk about like that Heisman chair was like, oh, can you just, you know, track every single person's value differently based on $100, based on their date of birth and not their just shares times price. And so the technology that we're using is to say, well, let's not put that burden on a record keeper to build out. We can do that tracking and that value, and then we can connect that information to the record keeping system. So we're taking new technology or, you know, connecting an insurer's technology with the record keeper's technology to remove that friction, but deliver the right information to the participant so they can see not only potentially a market value, which is what they generally see today, but they can also see an income value. And that income value may be growing over time. And so they're seeing that. One of the ways we do that, again, is to say, given today's technology, we can combine, without it feeling like a huge disconnect, the participant experience. So several of the solutions that we support today on multiple record keepers, participant starts out in the traditional record keeper user experience, but when they click learn more, they are moved into a microsite that is super highly focused and customized to that solution, all without the record keeper having to build all that technology. And so I think this ability to deliver really personalized, highly customized connectivity without putting the burden all on one part of the ecosystem is super important. And what we're seeing is that when participants can go in and see that sort of personalized modeling, and then they have the ability to actually act. So, you know, there's a lot of times where we have like a planning tool and somebody gets information and then it's like, okay, go figure out how to put it into place on your own. In the solutions that we're supporting, they actually can make the elections. We're doing straight through processing so that when the participant is done and they've done their signature, they've done spousal consent, they've done all of this digitally, we're sending an executable transaction. And so that really simplifies the participant's ability to see that paycheck show up. Depending on the solution, that might be an irrevocable decision, but a lot of the solutions that we are supporting actually pair not guaranteed types of solutions that have, you know, some irrevocability with non-guaranteed solutions that people can start, stop, change their mind. So the other thing that that personalization does is give people the ability to make decisions and then adjust over time as things change in their household, as they, you know, change what they're doing in retirement. Maybe their expenses go up, maybe their expenses go down, but we give them a lot of flexibility.
This next question is really going to be directed to Abdul and David. David, I'm going to start with you. Why? There's a lot of great record-keeping platforms out there. I'm a reform record keeper. Why was it necessary, instead of retrofitting, to create a new record-keeping platform?
Yeah, so I think when we started Forasol, originally it was, well, let's not create a record-keeping layer, because I was never a record keeper, but I realized, like, no, that seems like a really tough business, right? As a SaaS product, it has some of the lowest EBITDA margins of any SaaS product you could possibly imagine, right? EBITDA margins are somewhere in the 5 to 8% range, whereas a good SaaS company should be somewhere in the 80 to 90% range. So, like, let's stay away from that. But what we quickly realized was, even though our ultimate goal is, we always see ourselves as a lab, to do the type of innovation that we wanted to do, both on the participant experience and on the administrative and compliance oversight, we needed to actually own the entire experience. And so that's why we originally launched the Forasol 401k, was to have this platform where we could really push the envelope on both communications, access to investment, and integrations. And I think now, and shortly after that, we began to use that as the incubator for the new ideas, which can now be actually leveraged and layered on top of all of the major 401k platforms. So today, we support over 1,500 different combinations of record keepers and payroll systems.
We have a much simpler answer. We tried. And the existing record keepers said, no way. We came in and we said, hey guys, we really believe the new frontier is asset financing. Consumers in America finance consumption, which is a really bad thing. You shouldn't consume on credit. Corporations, on the other hand, finance investments. When private equity firms want to acquire a company, they buy it with debt. When a company wants to make a big investment in a plant or equipment, they finance it with debt. Consumers should use credit for a productive purpose, not unproductive purpose. So we built the retirement mortgage and we went to the existing record keepers. Many of them are in this room. And we said, hello, can we sell our retirement mortgage via you? And they said, no, we don't care. And I don't know why that is the case. Perhaps, you know, they did not believe in the vision. Perhaps, you know, big companies move too slowly. So as we were exploring this space, we looked at it and we're like, okay, well, like, what is the net promoter score of somebody's record keeper? Like, is this particularly like a, and I do not want to get into the details of that. And we're like, okay, well, there is a real opportunity here. We want to distribute this product. We can either go distribute it via the existing platforms. We'll be happy to partner with any. Yeah. And if they do not want to distribute it, we're serious about the mission of Universal Basic Capital. Our company's name is Basic Capital, after Universal Basic Capital. Not Universal Basic Income, which is a flow, Universal Basic Capital, which is a stock. In this country, there was once an idea called 40 acres and a mule, where we wanted every American not to be reliant on a flow from the government, but to have a 40 acres and a mule. When we were agrarian society and cotton was the commodity, that made sense. We're no longer an agrarian society. Our today's version of 40 acres and a mule is $100,000 in the stock market. And us and our investors are serious and intense about making every American a capitalist, an owner of capital. So when we went out to distribute via the existing platforms, they were not as interested. Perhaps we were too bold for them. So we said, fine, we'll build our own record keeper. And as we're building our own record keeper, we saw a million opportunity to innovate. And we saw a million opportunity to be more of service to the plan sponsor, and more of service to the employee, and more of service to the entire ecosystem. But ultimately, the way I see the future of this is Basic Capital will have a standalone 401k record-keeping business where we have a direct relationship with the plan sponsor, the plan participant. But sooner or later, the distribution of this product will be far beyond our own record-keeping platform. And I can see us partnering with other record keepers to do this.
Yeah. So we've got about 10 minutes left. I have more questions, but I'm sure that this panel has piqued interest. Does anyone have any questions in the audience that they want to raise? I could be like Phil Donahue and come out and help. If anyone remembers Phil Donahue. There's a question in the back. Can you just repeat the question?
Of course.
For the audience?
The question is, how do you do underwriting? You're giving people financing. How do you underwrite them? How do you decide what is the interest rate? What happens if somebody goes delinquent? How do you foreclose, etc.? Well, we do not underwrite the individual. Our financing is non-recourse. So the two core features we have is non-recourse, so you are not the borrower, and it's non-mark-to-market. The three best ideas of the 20th century is the mortgage. We talked about one. The second is the limited liability company, because it enabled people to protect themselves. And the third is the index fund, Jack Bogle, because it's simplified investing. I'm sorry, what's your name? Jason, when you are a customer of Basic Capital, in your 401k, we open a limited liability company in Delaware called Basic Capital for Jason. And that LLC sits in your 401k. And when you put $20,000 in the LLC, we give the LLC $80,000. And that $80,000 is secured by the assets of the LLC. So you, Jason, are not personally liable. You could lose your $20,000, but your losses are capped there. So our underwriting model, it depends on the assets. If you go 100% equities, the cost of borrowing is something like S plus 225, which is 6.25. If you go 100% bonds, it's something like S plus 150, which is 5.5%. So we underwrite the underlying assets. Just like you can buy a house on a ski mountain, or a house on the beach, or a house in Columbus, Ohio, or a house in New York City, we give you the financing, we let you choose the asset. We only allow diversified professionally managed assets like the S&P 500, MSCI, NASDAQ, etc. And we underwrite you based on the volatility of the underlying asset. You are not personally liable for that. So when it comes to consumer credit, why is consumer credit a highly problematic topic in America? It's because the person is personally liable. And you could ruin your life borrowing money to consume. And what we're trying to do is let people finance assets instead of finance consumption. And do that on a limited liability way, using long-term duration financing with no mark-to-market. And to do that in a simple, streamlined way in a wrapper that encourages long-term investments rather than short-term speculation.
We got a question. I'm going to do Phil Donahue or Sally Jesse Raphael.
You're a little more like Oprah, actually. But so in the spirit of transparency, could each of you explain how your organizations get paid and what the specific fee amounts are?
David, do you want to go?
Yeah, so it really depends on the specific product that we're offering. So for the For Us All 401k, super simple, transparent. It's a $8 or $6 a month per participant, $120 base fee, and a depending on the degree of fiduciary help that they want, determines if they want just a 338, 316, if they want the whole thing. Generally, we're able to deliver that in less than 50 basis points on assets all in, including the investment fee. Other plan sponsors may just want the payroll integration. They want to stay with Vanguard, but they're using a payroll company that doesn't integrate with it. Great. If all you want is just payroll integration, no compliance support, then that's $50 a month. if you want to add a 316 fiduciary that guarantees that that payroll integration is not just passing data back and forth, but guaranteeing that it's going to be compliant, and you want somebody like For Us All to hold the liability if there's a mistake, well, then that's 15 basis points.
Elizabeth?
Yeah, so our structure is a little different because we're providing services to large institutions, so asset managers, insurers, and record keepers. So we are a SaaS platform, and that fee structure will also vary depending on the services they're using. So in some cases, we are really just a data layer between, say, a record keeper and an insurer that has a program. In some instances, we're doing this very robust user experience. We may be doing tracking and storage of participants that have made elections. So those levels of services will drive what is the SaaS fee. But typically, the bulk of the structure is on the product manufacturers, insurers, asset managers, managed account providers, who have, the most economic benefit for the service that's being delivered. And then we're connecting that with the distribution houses.
Abdul?
We manufacture our own products, and we have a record-keeping business. On the record-keeping side of things, our fees are anywhere from 25 basis points all the way down to 0. So we work with plan sponsors to reduce the fees on the 401k as much as possible. On the manufactured product side, we have a managed account business where we charge 50 basis points on. And then for the retirement mortgage, you pay the financing cost, which is based on the risk of your portfolio, anywhere between S plus 150 to S plus 225. So 5.5% to 6.25% on financing cost, and there is a servicing fee associated with that. If you choose to not invest in the retirement mortgage, by the way, only 60% of our plan participants who are on our platform choose to invest in the retirement mortgage. The other 40% are buying traditional target date funds. And of those that choose to participate in the retirement mortgage, they usually put 30% of their savings or of their 401k savings into this LLC that we talked about, into the retirement mortgage. So it's an entirely optional feature. A lot of employees come in, they're like, listen, I'm on the older side. I just want to buy a target date fund. Some of them say, I want to go into the brokerage window and buy a single name stock. They can do that. They want to go into the crypto window and buy cryptocurrency. They can do that. But 60% of them say, I would like to have more investing power. And for those that do, they go into the LLC and they pay a servicing fee and a financing fee.
And lastly, Dario.
Yeah, we are a very low-cost solution. We charge 50 basis points on the fund. There is an additional upside we take only on the portion of the return that is on top of the S&P 500, which we call longevity bonus. For employers specifically, depending on the size of the contract, we may have a per person, per month fees of up to a couple of dollars, maybe $3. But that includes a lot of education and training of people to understand the basic of the financial system. So I think we are probably the lowest, one of the most efficient way to protect yourself against longevity risk. And the compounding cost of high fees in investments that have a time horizon of maybe 20, 30, 40 years can be very massive. And we are part of the industry. And so our interest, especially at the beginning for 2026, is to lock in clients with those low-cost contracts that will likely go up at least on the per employee per month, not the management fees.
I'm told I'm the last question. Exactly, Greg. Thank you. First of all, thank you for explaining what you do. Me and others in the room fully understand and get it. But I'm sure when you go out to the market, and this is for anyone that wants to answer, when you go out to the market, to the clients, you get some pushback, some objections. I'd love to hear what one or two of those have been when you've presented to the industry and how you've overcome them.
Okay. I'm happy to start here.
Thanks.
We get two types of feedback from two different types of people. The plan participant is pulling the product from our hand. The average American is really struggling to save. I hope this experience is relatable to many in the room. It was for me. I do not come from wealth. I'm not particularly well off. And I was working at Goldman Sachs. I was making good money. And I was putting in every paycheck like a good citizen. And I did the math. I was making at that time 100K a year. I was fresh out of college. And I was living in New York. So the most I could save was 1%, which is 1,000, which means it would take me 100 years to be able to have 1 year worth of income. And then I have to go back to work. This problem is incredibly relatable. The idea that Americans cannot afford to do something, and for some reason, the financial sector in this country decided to give them the ability to finance consumption, but not to finance assets. So plan participants love our product. Sponsors, on the other hand, are fairly and rightfully so, have reservation. They're like, Abdul is really credit the solution. And I think the challenge that Basic Capital face is that we need to shift the American psyche from thinking about a credit as a negative thing or as a thing to finance superfluous consumption to credit as a powerful tool for ownership. And I think that's a big challenge. It's a behavior challenge, but people usually think of credit as a negative thing. But we really believe credit can be a very positive thing. It unlocked home ownership, it unlocked education for so many people, and it has the potential to unlock capital ownership for so many people. But it's purely psychological. Oh, credit sounds risky, even though the structure itself has the appropriate buffers in it.
Yeah, we've got 30 seconds. I'm getting the hook.
Nothing. I had the opposite experience. I received so many calls. Actually, last week, we had Fortune 500 employers that are partnering with us, large distribution players, insurance companies, and asset managers. It's been the work of the past 3 years, so knocking at the doors of you all, and thank you for your availability of hosting us today. Thank you.
Thanks very much.
Thank you.
Hey, thank you, Craig. Good morning, everybody. Morning, everybody. How we doing? All right. I'm Rich Linton with Empower. I am thrilled to be moderating this session, Optimizing Retirement Accounts. We're going to talk about a lot of the accounts that you see on the screen. I have a distinguished panel with me to help me do that. Thank you to EBRI and to the Milken Institute for hosting today's session and giving us this chance to talk about this really important topic. Before I introduce the panel and allow them to introduce themselves, let me just set up a couple things. We got two themes today. Money leaving the retirement system and some of the causes and some of the things we can do to try and manage and prevent that. And then participant education and account aggregation and how those capabilities help improve how individual savers, working Americans actually manage their financial life. So just a quick commentary here. Today's savers, as you can see on the screen, there's more accounts than ever that they have. 401ks, HSAs, Roth, IRA, lost accounts. There's portability systems to help people move from one account to another. It is a challenging world if you're the individual. The more accounts, although those are all great savings opportunities, it can create stress in the financial life of any individual. And the more accounts, the more stress. So some of the things we're going to talk about today are how can we help people manage that stress? What are some of the tools we have? What are some of the capabilities we have to help improve and manage that stress? Empower's rolling out a survey this week, and I just wanted to highlight a couple of things from it. The survey is called Clarity is the New Currency. So just a couple of stats that I thought were important. Nearly 3 in 5 working Americans manage 4 or more financial accounts, investment accounts. 11% of American workers have 10 or more. 57% say financial disorganization is a significant cause of stress. And 50% say consolidating financial information would actually help reduce their stress. So the conclusion is workers don't think about accounts. They have one financial life. We in the industry might see it as many, many account types, and there's all kinds of regulations that drive why those account types exist. It's not how the customers we serve think about it. They think about it in simple terms. I have a financial life. How can organizations help me improve, help me manage, keep organized my financial life? So with that, let's jump into the program, and I am thrilled to have 3 distinguished panelists with me today. So I'm going to allow them each to introduce themselves, and then we'll get into some questions. So Romy, let me start with you.
Thank you very much. It's a pleasure to be here with you this morning. I am Romy Savova. I am the founder and CEO of Pension B. And I'd like to actually start with my own retirement account, which led me to create Pension B as a company. I had recently left a job. It was my second job. And I had this retirement account, and I knew I wanted to move it to, frankly, anyone who would take it. And I encountered so many difficulties. Providers who wanted me to get a financial advisor. The account was worth $30,000, so no financial advisor wanted to take me on. I left my name on a couple of websites, and no one called me back. I finally kept looking and looking and looking and found a platform who made me fill out a lot of paperwork, get on the phone, and finally my money made it over after all of that. I had to go to the post office, and they showed me this menu of thousands of different investment options. And if I didn't pick one, I'd be sitting in cash. So I picked one, and the money promptly went down as the market was going up. And I realized that for me, having worked in financial services, if I found this problem so difficult to navigate, what must it be like for people who didn't work in financial services? And so Pension B was born to help individuals in this modern working experience to have a better IRA, to have a better account, to have a place where they can move their 401ks easily. And we offer that service to individuals who can roll over to us directly. We offer the service to employers through small balance rollovers, also known as force outs, and we offer it at the point of plan termination when individuals are in flux, their money is being moved about, they're changing jobs, maybe their company is being bought. We believe they deserve a really good solution. We offer them a modern digital experience, and we offer them a personal beekeeper. So that's a person who is there to help you to answer any questions that you may have about your accounts while all of this change is going on around you. And we believe that's the way to serve consumers. And I'm excited to be here today. I'll be sharing some of the numbers behind these problems, these personal experiences that so many of us have.
That's great. I know you've got some fresh research. Looking forward to hearing about that. Debbie?
Good morning, everyone. My name is Debbie Moorman, and I serve as the head of health and benefits for Inspira Financial. And at Inspira Financial, most of us know us from the retirement space because we're a company that's a leader in automatic rollover and have been in the business as a formerly Millennium Trust. But 4 years ago, we acquired 5 different companies in the health and benefits space, and we are now a full-service provider of everything from HSAs to all the other acronyms you can think of. FSAs, dependent care accounts, ESAs, LSAs, you name it, we offer it to employers. We're both a software as a service provider, partnering with a lot of different administrators, payroll providers, health plans, but also selling direct to employers and offering through the employee ecosystem. My background is prior to joining Inspira last year to lead our health and benefits business, I spent over 30 years in the health and benefits business, most recently 10 years with Willis Towers Watson, leading our health and benefits practice for North America. So my experience is not in the retirement world, it's in the health and benefits world, but when we talk about the conversion of health and wealth with health savings accounts, it's a really interesting time. And so we'll have some interesting conversation about this amazing vehicle, which is the health savings account, but all the confusion that comes as a result of the myriad of accounts. And one of the areas where the reason I joined Inspira is I've spent 30 years with employers trying to help them educate their employees, think strategically about how to have a healthier and more planful workforce, helping them plan for retirement. And while the HSA is an incredible vehicle for that, when you're in an environment where in the highest healthcare trend in 10 years and expected to go higher, medical debt, affordability, and when you think about AI and the coming wonderful excitement about healthcare innovation, it comes at a significant cost and has an impact. So I think this is a really interesting tipping point time. And our opportunity at Inspira, I like to say we're a 40-year-old billion-dollar startup, because we're committed to disrupting the industry. We've invested about $100 million to create a whole new portfolio and platform to disrupt the account space and really use AI and education in a new and different way to help people really navigate all of this confusion and sea of sameness, and hopefully bring forward the actual promise of what consumer-driven healthcare, when it came to the forefront with high deductible health plans 20 years ago, it wasn't just about saving money for employers, although it has, and extending the employer benefit landscape, but it really was about how do we introduce consumerism in healthcare? How do we help people navigate and take a more active role? I'm a little older than Romy, but my own personal healthcare story is if you grew up in the healthcare world when I did, it wasn't uncommon that your employer offered 10, 15, 20 different HMOs and different kinds of health plans, and you could have a $15 baby. You had a copay, and all the rest was just taken care of. Well, the reality is it's not a $15 baby, and most people have no idea how much healthcare costs. So the idea of consumer-driven healthcare 20 years ago was if we could introduce an opportunity for people to take an active role in how they spend their money, then they would be more conscientious and help with cost and save through a vehicle like HSA. The problem is we didn't have transparency of how much things cost, and we still aren't there. And the technology really didn't support helping people make educated decisions. And we're just on the tipping point of being able to do that. So excited for the conversation. Thanks for having me.
Thanks, Debbie. Appreciate it. Jason?
Thanks. Thanks for having me here. I also wanted to thank the folks in the audience and online for being here when you could be playing hooky today, watching the college basketball tournament, which starts in about 40 minutes.
Who's your team?
Well, it's certainly not my alma mater, Cornell, but yeah, I think Duke's looking pretty good this year, but that's my own personal opinion. But I'm Jason Herman. I'm the head of partnerships and business development at SecureSave. We're a workplace emergency savings program. We use automation, ease of use, and employer incentives to get folks saving for emergencies and supporting their unexpected expenses. Similarly, we actually were just acquired 3 months ago by HSA Bank, so our footprint looks a little bit like my friend Debbie over here and Inspira, so we're now kind of an ecosystem of saving and spending solutions more broadly. But excited to be here today. A lot of data and case studies to share on how emergency savings plays into this retirement optimization conversation.
Thanks, Jason. I might actually start with you. So one of the ways that money leaves the retirement system is for unexpected expenses, taking loans, withdrawals. You heard hardship data earlier today to cover unexpected expenses. For your clients that have emergency savings, how do you see that playing out?
Yeah, thanks for that. Yeah, a lot of data. Jason and Barb, they both mentioned the recent news cycle that we've seen. 6% of folks are taking hardship withdrawals. I believe that was Vanguard data. Interesting to note, healthcare expenses is always in the top 3, so I'm sure you'll hear us address that across the next 40 minutes. But also, the median amount, $1,900 in the Vanguard study. I think Jason mentioned $2,000, almost three quarters of those. So, I think the reason I bring that up is that these are amounts I think that employers and sponsors can help their employees support to save for those types of emergencies. I mean, these are not large dollar amounts that we're seeing coming out of the plan. So I think this is a great opportunity. Specifically with our customer base, we're definitely seeing a connection between the users who are participating in our emergency savings account and the higher probability of those leaving their money in the plan. There's a lot of data out there, and in true EBRI-Milken fashion, I'm going to just throw a lot at you guys. We also have a case study I'll quickly mention as well, but there are folks like Voya. They've come out with some research that said those who don't have enough emergency savings are 13 times as likely to take a hardship withdrawal and 3 times as likely to take a plan loan. You have folks at the BlackRock, ESI, and DeCia who say that those who do have an adequate emergency savings amount take hardship withdrawals half the amount of time, right? So these are real numbers, real data, and we're seeing this with our book of business. What actually excites me is looking at the other side of that equation. When you look at retirement plan behavior, the contribution and the participation side of that equation. We're seeing some really great data in terms of the emergency savings, the support emergency savings has on participation in retirement plans, and in the amount people are contributing. So SecureSave, we came out with our own study. We're seeing 92% of our users are either increasing or maintaining their retirement contributions over the course of the last 12 months. A third of those are actually increasing. Vanguard came out with some data that said for folks who have $2,000 in emergency savings, they're putting in, on average, 2.2% more of their income into retirement accounts if they're, they feel good about their emergency savings situation. That dovetails into a case study that Commonwealth did on one of our customers. They're a large healthcare provider. Their participation from their employees is about 75% in the emergency savings program that we built for them. And the folks in the ESA versus not in the ESA are contributing 13% more often into their retirement account than the ones who aren't. And this is an auto-enrolled population. So that to me is even a little bit more impressive. We're also seeing from that case study, higher average account balances, lower leakage from the program. And, I think Jason mentioned cannibalization earlier, right? And, I think a lot of this data in our experience is showing that, not only is ESAs not cannibalizing money from HSAs or retirement account, they're actually supporting people in contributing more and more often to their retirement account. And I think there's a little bit of, behavioral psychology in that. When, we talk to our users and take some surveys, obviously people who feel secure about their short term are more likely to invest in their long term. But also when people establish that habit of saving over 1 year, 2 years, 3 years, they're much more inclined to continue that into whatever that next best vehicle is for them, whether it be retirement, whether it be HSAs or 529. So a lot of great data out there, and I know it's promising.
It's very promising. I mean, the fact that when they're using an emergency savings account, savers are really rethinking their perception of what the retirement account is for. They're starting to think more longer term and stay committed to that and not use it as a rainy day type fund. So that's great. Romy, let me, if you don't mind, turn to you and let's just talk for a minute. The other big way that money comes out of retirement plans is leakage with job changers. And there was an EBRI study just in the last few months that said that by the time someone is 45, they've likely had 10 different jobs in their career. So that creates a lot of churn, creates a lot of risk for leakage. Talk to me about that. How does Pension be, looking at that as an opportunity to help individuals?
Yeah, absolutely. The reality is that we lead very modern working lives. And so 10 accounts, 12 accounts is really not uncommon at all. The average job tenure is probably 2 to 4 years. And so we have to think about the retirement system from the perspective of a very, very mobile workforce. And what does that mean from a retirement account perspective? Well, it likely means that you as an individual working in the system are going to accumulate many, many small accounts. And it's really important that the system addresses the way that these small accounts ultimately come together to create a bigger account for that individual to retire from. And so we started seeing a lot of these really small accounts coming through our direct-to-consumer business. They were maybe $100, $2,000, $5,000, and we wondered, how are these accounts getting created? What is happening to them along the way? And so we did a piece of research with EBRI to look at automatic rollovers. So this is small accounts under $7,000 that are automatically forced out when the participant leaves the job. And from the employer's perspective, it makes good sense. You don't want these older accounts hanging around. The participant has moved on. They may have become a missing participant. But a lot of them end up in destinations that are really problematic. And so we looked at 3 particular areas that we thought were worth thinking about. The first one is, of course, fees. And because we are talking about small accounts here, seemingly innocuous fees of $30 per year or $50 per year on an account that's worth $200 or $2,000 is really quite a high amount. And a lot of employers don't think about it from this perspective because they're used to seeing fees expressed in percentage terms. So we think it's really important to pay attention to the fees because that's a form of leakage, excessive fee charging. We also looked at the investments within automatic rollover IRAs, and we found that a lot of them are basically sitting in cash parking lots. These are accounts that pay 0.5% of interest when the prevailing interest rate is maybe 3 or 4%, when T-bills are available to preserve capital over time. And so with that kind of investment strategy, that account has no hope of growing. And layer on top excessive fees, the direction is basically all the way to the bottom, to 0. And then finally, there's participant engagement. And of course, a lot of individuals who are automatically forced out are not even aware that this is happening to them because they're busy, maybe they didn't open a letter that arrived in the post, maybe they've moved homes. And so we found that after 3 years, 75% of those accounts are still languishing in these cash-like parking lots. And so fast forward that over 12 different jobs, and the net effect of not being invested, not having the right fee structure across these small accounts is that the typical person will be $90,000 worse off over their whole career. And that's a huge number just because, well, the median savings of the average person are probably about $90,000 as well.
And you're helping those individuals sort of knit that lineage of
Yes.
accounts together?
Absolutely. In our individual business line, we help individuals to consolidate these accounts easily, often with the help of a beekeeper. And in our automatic rollover business, we don't charge fixed dollar fees. We invest participants' money in actual investments that yield return. And of course, we help them to stay engaged through an app so they can make decisions about their future and make sure that they're not, $90,000 worse off.
That's great. Thank you. Debbie, I know Inspire also has an inactive account, if you will, type offering. You want to spend a few minutes just talking about how you all think about it, try and help individuals in this situation?
Yes, I was just going to compliment Romy because I think it's just such an important topic and concept. And if you parallel in our business and our automatic rollover business, similarly, we have a mission to help connect people with their money because they have, to your point, they have people on average have multiple accounts in lots of places, and it's very similar in the health savings account environment. In fact, if I just asked each of you to raise your hand, how many of you even have a health savings account? You don't have to raise your hand if you don't want to, but and if you have more than one, I know I do, and I can't tell you how often I speak at sessions like this when I ask very accomplished executives about their health savings account, and always somebody says, I totally forgot I have that health savings account. I totally forgot about it because they change jobs and it tends to be a smaller dollar amount than their 401k. But if you think about the $160 billion that's invested today in health savings accounts, only 10 to 20%, depending on how you do the math, is invested. The rest is sitting in cash. And that's because that's great for the HSA administrators, but not so great for the individual, especially when you think about that the average couple needs $400,000 in savings to pay for health care in retirement, and the average person has less than $10,000 put away for their health care expenses in retirement. And if you add to it some of the research about the acceleration of health technology, potentially leading to wonderful advances from a longevity perspective, as our life expectancy grows, it has significant implications not only to the workforce, but to healthcare costs, et cetera. But the average person has at least 3 health savings accounts. The number of unfunded accounts, meaning that they have access to an account, but they're not yet participating in it, is on the rise. And so the opportunity, one of the big pieces of our technology, the excitement about our new configurable technology platform that we launched a couple of years ago, is the opportunity to help make it so much simpler to connect people to their variety of health savings accounts, which all the majority are coming through their various employers. But keep in mind, a health savings account, if you have a qualified underlying health account, you can also purchase it through your wealth advisor, through your bank. There's lots of places that people can get their health savings accounts. And so it's a matter of making it easy for people to know that they have them. How do you connect them together? And then educating them about the value of investing, which there are spenders and there are savers when it comes to health savings accounts. I was joking with folks at my table that I'm that person in the CVS when I see you pull out your health savings account to buy Tylenol. I just want to tackle you and say, wait a minute, you're buying a Coca-Cola. I live in Atlanta. A Coca-Cola and a Tylenol. If you can afford that Coca-Cola, I know you can afford that Tylenol. Do not use your health savings account. But employees think of it as almost like a gift card that they have to use. And over 25% of employees still, on average in our survey data, think it's a use it or lose it account. So I know we're going to talk about education, but helping people connect to their money is a big mission of Inspira. And we're excited that now we have technological capabilities that'll make it a lot simpler.
So you're personally solving the HSA usage problem, one customer, one consumer at a time.
That's
okay.
right. CVS is my
Just wanna
client
make sure
also,
I
so
got
they're
that
probably
right.
like, what are you doing?
So just one other organization, just for the audience, I'm sure many in the room are familiar with it, but one other organization that helps with leakage is the Portability Services Network. It's a consortium of record keepers that have come together, and they try and match individuals who have left a 401k behind and started a new 401k somewhere else. We go through the retirement clearinghouse to find those matches and create those opportunities. So I think that's just another great way the industry's trying to come together and really reduce leakage for the entire industry. All right, let's move on to the second topic. And Jason, maybe I'll come back to you. So participant education, aggregation, you know, if you look at Empower's numbers, when individuals aggregate and have a horizontal view, a clear view of their financial life, they're more likely to save more. They'll save more than 10% in that scenario. That's obviously a positive thing. Let's talk about emergency savings and being able to see that alongside all of your other financial accounts. How does that improve how the customer behaves in your world?
Yeah, that's a great question. I think when Secure 2.0 was passed, I think there was a lot of that thinking around, wouldn't it be great to have emergency savings within the 401k plan? Record keepers could administer it. People could see all this in the same place. It could come out of the employer's paycheck, employee's paycheck in the same manner. But obviously I think with what I've seen and what I think I've heard some of the record keepers see, like right now, I think there's a little bit of hesitancy to start, adopting these in-plan PLESA accounts. I think there's clearly a problem that we've just been talking about for the whole day, that leakage is real, right? So I think philosophically also, do plan sponsors really want, that emergency savings bucket within the retirement construct? But what I would also say is that in the spirit, of Secure 2.0 and creating the in-plan account, the focus on emergency savings has really, taken off. I mean, the fact that there's a lot more attention on it, to be clear, like Secure Save is focused on the out-of-plan emergency savings account. But what we've realized is that, we're trying to treat a specific issue that employers are having. So we know we're a point solution, and how do we create the, how do we connect the dots, to your point, Rich, with other platforms? And what we've learned is we really live in this ecosystem world now, right? So a lot of technology companies, a lot of newer platforms, to create an API or to do an SSO, to be able to work together with other platforms and integrate with other experiences, that is almost table stakes when you start talking to employers and distribution partners. For example, Secure Save works with several record keepers and financial wellness platforms where the employee can see their emergency savings balance next to their retirement balance, or within the construct of a financial wellness assessment. And in addition, they can also enroll in the emergency savings account, right? So yes, you're seeing these accounts aggregated, and you're seeing the employees can make better decisions because everything's there. And ultimately, we're seeing a lot of uptake when our product is distributed through a third party, right? Because people are making better decisions.
Sure.
And frankly, one thing we heard from in the December EBRI event, and Greg, on your panel, AI is going to be playing a really big role. And, how do you connect the dots for the participant? Whether it's disparate platforms or one platform, making people aware of what benefits they have, what accounts they have, and then ultimately guiding them into the next best decision.
No question, AI will play a big role in that bringing together of that financial ecosystem. Romy, you obviously are dealing with a lot of hypermobile customers. How do you encourage your customer base and others to just think about, do you know where everything you have is? What's your approach to that?
Absolutely. So we manage approximately $10 billion on behalf of around 300,000 customers. And we always learn from them as well what works. And I would say the good old-fashioned way of opening that drawer and pulling out the paperwork and actually having a look at the documents that you have saved is really important. And so that's the first protocol. We also tell our customers to use some of the government services that are available, whether it's the DOL Lost and Found database, or whether it's the Pension B employer record keeper matching service, where we match your employer to your likely record keeper based on the filings that the employer has made. So there are a lot of tools out there, and if you've lost an account, I think $90,000 is worth a strong incentive to try and get on top of it.
Absolutely. All right, I'm going to ask Debbie one more question, then we'll open it up for the audience if the audience has questions for the panel. Debbie, let's talk about HSAs for a second. And you heard Barbara at the opening throw a stat out there. She mentioned more than 90%. I think the stat's 96% of HSA users would like to understand the solution better. Talk to me about how you all are helping in trying to understand how people can best optimize HSA.
Well, in the broader landscape of employee benefits, and that includes retirement, education and confusion is just an age-old problem. We were smiling, Pete and I were smiling when we said, we need more education. We've spent billions of dollars and countless hours trying to educate employees about a very complex system. And in the health and benefits world, it's interesting because health savings accounts are one of the best, if not the best, tax vehicle we have. Now, granted, there are caps on how much you can put in an HSA, but the fact that you have the only triple tax-free opportunity for people to save for retirement expenses. I already mentioned that the average couple will need $400,000 in set aside to pay for healthcare expenses. That's on top of what you get through Medicare and other things. That's long-term care, a lot of those things, and it will only extend as life expectancy extends. So it's a tremendous opportunity and vehicle. Now, the blessing and the curse is that health savings accounts are naturally attached to the health side of the benefit plan. Why? Because you have to have a high deductible health plan. The intent of consumer-driven health was we're going to put in high deductibles that make you pay attention, and we're going to give you a vehicle to save for the future. Now, so it makes sense that they would be linked together. But as a result, it becomes more in your top of mind as a spending type of vehicle, a spending account, more than a saving account. And the connection to retirement is often lost because they've got a flexible spending account, they've got a dependent care account, they may have a health reimbursement account, and they also have this health savings account vehicle, which many employers do seed, and that's terrific, but the education piece is really, really important. Part of what we're excited about at Inspira from a technology perspective is we have finally entered the era. If you have a modern technology platform to be able to do the personalized communication, the nudges that you need to say, hey, Debbie, when you're enrolling in your benefits, and keep in mind that the average American spends 30 minutes, that's it, in making their enrollment decisions when they're enrolling in benefits, and over 50% regret their decisions. But they only spent 30 minutes. So a lot of the time and energy is spent by employers, which is the largest audience that's educating people today for that one point in time event where you're going to have your employees spend 30 minutes and they're choosing everything from their medical plan to how much money they might want to put into their health savings account. Can they come in mid-year and put money in their health savings account? Yes. But how many of them are thinking about that? So that point in time education, which has been around forever, is still the primary way that people are trying to educate their employees, and it does not work. So importantly, with a modern technology platform, we're all about how do we know about you, pull all the information together, because we have information around not only what health plan you have, but what were your medical claims. We also have information about where you spend your money. It's all through the secure information we have about each person. So how do we say, hey, Debbie, based on your spending patterns, here's the configuration of benefits, not just how much should go in your HSA or your FSA, but based on everything, here are the benefits you should probably enroll in. Here's what we'd recommend putting into your accounts. And then in those point in time moments, say, hey, before you go spend that HSA, do you know that you have a free benefit over here offered by your employer? The average employer offers more than 20 point solutions. More than 20. So there's the main health plan and their main 401k, and then there's 18 other plus, and some of them are more than 40. So you can only imagine why the average employee can't remember what they have or how to use it or when to use it. So the exciting part is the technology to be able to do gentle nudges, make it configurable at the employer level so they can turn it off or on if they don't want their people, and individuals have the right to turn it off and on as well. But we're just on the verge of that. That's why Inspira spent $100 million to upgrade all of our technology over the last 3 years. But in our particular part of the world, 80% of the accounts that are offered through health plans are offered through 2 legacy platforms. They have different names on the door, but they're using the same underlying technology that does not have the capabilities I'm talking about. So we're in an industry that's ripe for disruption, and we're excited about that. But you can imagine why it's very confusing, because I bet all of you are sitting there thinking, gosh, I don't even know what I have and what I'm doing, so, and you're experts in the industry. So it's even more challenging for the average worker out there.
Excellent. Thank you so much. You want to add something, Jason?
Yeah,
Yep.
and we have a little bit of extra time. So I wanted to, I 100% agree with everything Debbie said. I did want to provide an example of when education does work, right? And when things kind of come together. And, there's so many variables here, the employer participation, the platform they're in. But this is an example. And, we mentioned HSA Bank acquiring SecureSave. What's the connection between HSAs and ESAs? So something we heard recently from one of our users in a webinar, I thought really kind of painted the picture well. This is a parent whose child had a bad third-degree burn. I don't know exactly how they got it, but they wound up having to treat the child at a specialty hospital, which was not around the block. It was several hours away from their house. So, number one, they had to miss multiple days of work. So they missed a few shifts. So that's income lost. Then they had to spend a night in a hotel, right? Right. So both of those things outside of the hospital stay are not covered, right, in the HSA. But because of the employer and the education that they received, they had enough money in their ESA to cover those expenses that were not, attributable to the HSA. And it sounded like from the story that I heard that all the expenses wound up being paid through those both accounts, and they didn't have to go into their 401k plan or take a loan. So I just want to share that as opportunity. I think this could work, right? If all those kind of pieces of the puzzles come together. So
No, I think that's great. It's a great ad. Thank you so much. All right, let me just turn to the audience real quick and see if there are questions. I see one there in the middle of there should be a mic coming your way. There you go.
There. Oh, okay. Thanks. Question for you, Jason. In the EBRI Financial Wellbeing Employer Survey, we saw that ESAs was the financial well-being benefit that employers most said that they either are offering or would like to offer. But right behind that, not too far behind that, was a hardship assistance program. Can you talk about how the two potentially work together? And also, second part, do you ever see employers say, hey, we already offer a hardship assistance program. Why do we need to offer an ESA?
Those are great questions, and this is my worst nightmare, having Rodney ask me a question on a panel. So I've known Rodney a long time, but great questions. So at the end of the day, yes, there's 20 vendors that companies work with, but I do feel that in a lot of situations they each serve their purpose, right? So hardship relief funds, they've been around a lot longer than emergency savings accounts and programs. And we do come into contact with a lot of companies who do that. And I think what they wind up seeing is that those relief funds are great. They really help people out in a time of need, but they're really only helping out a very specific subset of the population. Maybe 1%, 2%, 3%. So what we've been finding is that those companies see the value in saying, all right, well, maybe I can allocate a little bit of that budget to promote an emergency savings program account so that we can help people build that muscle of savings so that when they do have an unexpected expense, they could tap into that account and not necessarily take away from maybe some folks who really need access to that hardship fund. So in our view, we work with several organizations that come to mind that have both. I think a lot of some hesitancy and obstacles are more around the point about, do I have 20 vendors? What's my headspace? Do I have resources and budget? Those are the obstacles I feel like we come up against, but I do see them playing well together in the sand.
Was there a question up front?
It's kind of a question and a comment. We're talking about HSAs. I have a lot of friends who say, I can't have an HSA. I don't want a high deductible plan. I can't afford those costs. My monthly medications are too high. So they have a flexible spending account, but I don't think there's an answer for that, right? I mean, that's sort of my question. So it's a challenge for many people. So we're saying this is a great thing to have, but a lot of people are saying, I can't afford that insurance.
That's right. So you're correct in that in order to qualify for a health savings account, you have to be in a qualified medical plan, which is a high deductible plan. And the reality is it is still the most common type of health plan offered by employers. There are a number of other alternatives so if you don't have one, you can't have it. So that's the bottom line. There are opportunities to leverage other types of accounts that you talked about to be able to pay for health expenses in a pre-tax environment, but they do have different rules around them because they're not portable, and then you can't roll them over and save. Health reimbursement account you can roll over, but notional, et cetera, flexible spending accounts, you have to use it or lose it. So that's where there has been discussion at the national level about opportunities to expand access to save for future healthcare expenses. And I think the other important thing in looking at health plan options is that while high deductibles are affordability is a real challenge because we are in the highest medical trend environment we've been in 10 years as it's approached high single digits, often in double digits, and that's only expected to increase if you look at all the studies and surveys going forward. So affordability is a real issue. So that's why the complement of you have emergency savings opportunities, you have other ways to bundle things together, and that's in a way that makes the whole ecosystem work better together. But there are certainly limitations. And even if you have a high deductible health plan, you're limited in how much you can put in a health savings account because of the triple tax-free benefit.
All right, thank you. Thank you for the questions. All right, lightning round. Give each panelist 30 seconds, most important message on optimizing your retirement account.
Pay attention to your automatic rollovers and make sure that they're going to a good destination.
If you have access to a health savings account, max it out. Know that at a certain age, you have some catch-up opportunities. Don't spend it on Tylenol in the CVS.
Because she'll find you.
If you can, it is, you know, it's compounded, it's triple tax free, it's the best tax benefit we have, but consolidate your funds and invest them.
So my message is to employers and their partners is do something, right? Survey your employees, find out what's kind of the obstacle, the roadblock in this whole conversation. Run a pilot, do something. There's so much great data that we shared and you've heard all day. So you know, with all this double-digit % increase in healthcare, like get something good out there and do something for your employees.
Excellent. Thank you all. I think you all heard it. Whoop, sorry, one second. I think you all heard it. Like, leakage is real, but there's a lot of great solutions to help make sure we can actually work against the powers of leakage. And 2, disorganization and the scattering of your accounts is a real problem. It creates stress. And again, there are solutions to help that. And all of you in the room that have the ability to improve that, impact that, it will make a big difference in the lives of savers and American workers. I'd love to thank the panelists very much. All right, now you can applaud. All right, thank you.
I'm Craig Copeland. I'm the Director of Wealth Benefits Research here at EBRI. Obviously, I focus on retirement and financial well-being. Today, I want to really kind of release kind of a first look at this new studies, new data that we're using to really find out more about what people are doing and how they're investing their dollars. So what we're doing is actually taking credit data and linking it to 401k plan participant data so we can find out how people's credit status impacts what they're doing in the 401k plan. So this is really, we know that intuitively you can think, well, how people's finances are, it's going to impact what they're doing. And you know, Barb's session brought it up this morning about, is it a spending problem or is it an income problem? Well, I think when we go through the data today, it's a both problem. So we'll get through that. But really, this idea of really thinking about what's going on has been started with this research that we've done with JP Morgan Asset Management, I was going to give a shout out to Michael Conrath, and he left now, and Sharon Carson most recently. Where we focused on spending, linking with their banking data to see how they were spending, and they also had a little bit of credit card data on there. But we wanted to go the next step further and find the whole credit history. So Bridget Bearden from EBRI was instrumental in getting us contract with TransUnion to be able to get the full credit history data from their credit bureau and their credit scores that we're going to be looking at today. So that's going to really allow us to link and really find out how individuals' current credit status and an ability to look at it over a longitudinal basis and how that impacts what's going on in the 401k plan. So, as I said, we'll be doing both cross-sectional analysis and longitudinal analysis in these different things. We're going to be focusing on contribution rates and the incidence of plan loans. So the first thing we have is credit scores. And as we know from credit scores, they go from 300 to 850 is the standard credit score. I want to break this out and really show that there is a very big distribution in credit scores, even if your salary level is different. This is the interquartile range, which means it's the middle 50%. The white number is the median, and then the 25th percentile and 70th percentile are the above and below the bars. And you can see that it does become more narrow as the income goes up, and as the age goes up, it becomes more narrow. But still remember that there is 25% of the people that are somewhere. I will say that there was no one in our sample. Remember, this isn't a population. This is of the participants that we have linked. No one in the less than 45,000 did reach 850, but no one in 100,000 was at 300, but we did have people in the 300s. So there is a wide range beyond the interquartile range of people and their financial scores and what they have. So it really does. There is less of a problem for higher income people, but it's still an issue with their credit status and what they're doing in a 401k plan. So that kind of gives you the range of what we do and see that it's widely distributed across all incomes and ages. Now, let's look at what happens when we have different credit scores in that thing. One thing I want to be clear about, this is the credit score at the end of the year, and this is the contributions that were over that entire year of that. This is particularly looking at 2023, and we can see as the credit score goes up, left to right, whether you're at prime, you have an average contribution of about 5.4%. You're at super prime, you're at 10.2%. I hope I said subprime at the 5.4. Super prime, meaning you're at that above a level of 781 or higher, up to 850. Your average contribution, not yours, but those in the sample were 10.2%, and the median was 8%. This is only the employee portion. This does not include the employer portion. So this is just the employee contribution rate, which looks lower than when Jason was putting both contribution rates together this morning. So we do see that there's clear correlation between the credit score and what people are contributing in a 401k plan. Now, we go to the next step on the other side, taking money out, or at least taking a loan, not taking money out, but taking a loan, and we can see that you kind of see the opposite direction. As the credit score increases, there is a much lower likelihood of that individual having an outstanding loan from their plan. You can see it was 35% for those with really low credit, 300 to 600, and once you get to the super prime people at 781 plus, only 5.7% were taking or had an outstanding loan. So again, very strong correlation between that. So, but if we're really trying to design programs, we want to see some type of indicators of what is changing this credit score. One of the big things that change credit scores is credit card utilization, the percentage of your credit limit that you have outstanding at any point in time or when they take the report. Again, this will be the amount that they have in the last month of the year, and we'll have balances and loans outstanding based on the end of the year. And you can see a similar expectation or distribution of the credit card utilization. So if 10% is meaning that you only have 10% outstanding balance of your credit limit. So those are the people that have better credit because they're using less of their available credit. Whereas you get to the top where people have 90%, that means they're pushing it, that they're almost using their full credit amount already. They have outstanding balance. And you see, even as you go up the income scale, you do see a lot of people with less than 10%, regardless of the income level. You get more at the really high level for lower income people. You see more. You see the double digits for those with less than 100,000. When you get to 100,000 plus, only about 5%. But there still is 5% of people with an annual income of $100,000 or more that are almost using up their entire credit limit that they have available. So that really shows that there's distribution. There does more, but you do see plenty of people that have the much higher credit card use. And you see the same type of thing as age. Those in the 60s plus do seem to be a little bit better. But in general, from 20s through 50s, there's pretty similar distributions in the credit card utilization. So to me, this clearly is an issue that it's not just an income problem. It is people that are spending beyond, because there are plenty of people at the different income levels that are able to have really good financial scores and have really low use of their credit cards. So that is one indicator. Now, we see the distribution. You wouldn't expect, and we will see that you get the same type of similar results, except the axis is a little bit different because the better situation obviously is on the lower side this time. So you see the higher average contributions when you have low credit card usage for your outstanding balance, and when it goes up to the higher. So you got to kind of go from almost 10% down to 5.7%. Kind of the same thing that you saw with credit scores, went from about 5% for the really low up to 10% for those with the really high. So you see the same type of thing that comes through in the credit card. So a credit card really that's really a good indicator. If you can control your credit card, you're going to have a better financial score, and it looks like you have better ability to be able to contribute to your 401k plan. Again, we see that with now taking a plan loan. What's the percentage of those with outstanding loan by the credit card utilization? Down here where you have very low credit card utilization, you only have about less than 10% in credit card utilization. You have less than 10% of people have an outstanding loan from their plan. When you get out to those that are up there using almost all of their credit limit, you see that it's almost not quite 50%, but 44%. You're getting up there pretty high, those that have an outstanding balance. So if they're using a lot of their credit card, it looks like now they need to go to their plan loan for their needs to spend, to cover whatever expenses they may have. Now, that was all point in time. Now there's going to be really interesting things to look at what happens over time to credit scores or to other issues as people play out. So one of the things that we wanted to look at was we have 3 different years here, 21 through 23. So we have a starting point in 21. Then we look at what is going on in 22. Did they take a new loan where they did not have a loan in 2021? That is the first category on the left. The second category is they took another loan in 22 already having a loan. So they built to their loan, outstanding loan balances in that next year. Or the third one, the third category over from the left, is those that had just had an outstanding balance but did not take a new loan in 2022. And then in the far right is those that didn't take a loan at any point or don't have an outstanding loan. So you can see how the credit card, and as you see the no plan loan is, you see the credit scores increasing. Because in general, credit scores will increase. Because if you hold everything else constant except for your age, your credit score should go up because your age of your accounts go up, which gives you a boost in your credit score. So it's naturally going up if you don't change anything except for your age getting older. Your credit score should go up. But you see the credit score going down for the first 2, both in the year they took the loan and in the next year. But what I think is really kind of encouraging is that third group, where they had the outstanding loan, but they didn't take a loan in 2022, so they're paying their loan down without taking on any more loan. It looks like their credit score is starting to be on the upswing. So it looks like a plan loan could be part of helping people's credit scores improve because they're now in a situation that they're able to handle that expense. Now, there could be, like the other panel, it would be optimal ways that maybe that they have emergency savings account, but if they only have a plan available loan, it looks like they could still be part of a situation where their credit could improve over time. This is just the median in each of these categories. I then wanted to show then the distribution of those that improved, roughly stayed the same, or actually had their credit decrease. And you can see that the group in the far right, even though they had an overall increase, there were still some people without loans that had decreases, but those that stayed the same or had no plan loan or had increases was much larger, so the overall went up. By staying the same here, I mean it was really within 3 points of that credit score. I did 5 and 10. It doesn't really change the relative amounts. The orange bracket got a little bit bigger, but you still see that the most people that had to decrease was those that just took the loan as opposed to those that are taking it for a second time. And then the third group, the ones that have an outstanding loan but didn't take one in 22, have a little bit more that are improving. So there is some ability to show that it's part of an improvement to take a loan. It's not necessarily a bad thing, but it's people that can tide them over that may not have access to other things to be able to take this. So there is then this other interesting, I think, is somewhat confusing. So let me try to go through this carefully. On the left, on the bottom, the x-axis here, this is the change in credit card utilization, meaning it's 2022 score minus what it was in 21. So that means anything that was negative means that it improved. No, okay, gosh. I totally blew this. Now this is all going to make sense if I explain it correctly. It is the change in the credit card utilization, not the credit score. So if you have negative credit utilization, that means the amount of credit you've used has gone up, right? So it is a worse thing. I mean, it's an improvement. And on the right side, it's a worse thing. Okay? Okay. Did I confuse everyone? Because I confused myself. I apologize wholeheartedly. Credit card utilization is the x-axis, right? So that is the amount of their credit limit used. So if it's higher in 22 relative to 21, that means that they are in a worse position in their credit. So that's the people on the right. The people that reduce their credit is on the left. But what is interesting is that those that are making big swings in their credit card utilization are more likely to take a loan That's the V-shaped. Whether they're improving or becoming worse in their credit utilization, they're more likely to have taken a loan. Those that are not are pretty much staying the same within that 3 percentage point change from up or down on what that credit card utilization was. They're less likely to take a loan. So it looks like these people on the left are potentially using their loans to improve their credit card utilization. They're substituting credit card utilization for their planned loan, which could give them a potential to increase their credit score, which could reduce other loans that they may have in the world. The people on the right appear to be those people that are in trouble. They've maxed out, so they've used more and more of the credit, so now they have to go to a planned loan. So really, you can kind of see for what is the planned loan, it is truly part of the people on the left. It looks like it's a solution to improving their situation by taking on debt that's probably more favorable than potential 30% credit card interest rate and pay something around 6%, 5%, 7%, whatever from a planned loan to help improve themselves, whereas those that are in the last resort are on the right. So hopefully after I spent a minute messing up, we are on here and understand that people are moving. The people that are moving are the ones that are more likely to take a loan. But the one thing I wanted to show between the orange and purple bars, not purple, orange, colorblind too today, we could see that still those that took the loan were more likely to have more credit card usage within those changes in the credit card utilization. Okay, so which carried through for the story earlier. So even whether improving or taking on more credit, it's still the people that have higher overall credit utilization in those movements that are taking the planned loans. So that kind of follows through with what we showed before, that there is that strong correlation between higher credit card usage and taking on a 401k plan loan. And one last thing, mortgage delinquencies. So we looked at what happened in the last 4 months of delinquency. Basically, they have a question that's in their last report. When was your last mortgage delinquency? What month, or most recent one, I should say, month did it occur? So if it was a 0, that means it happened in December. If it went up 1, 2, 3, then it went back as far as 2022. So those that had the most recent mortgage delinquencies in the last 4 months of 2022 were far more likely to take a loan than those that had it longer ago or who never had it on the far right. You can see that it's almost a little over 4 times much more likely to take a planned loan if you have delinquency in the last 4 months as opposed to those that did not have a delinquency on their mortgage. And then it's somewhere in the middle for those that had a longer period of delinquency. The one thing that was interesting, though, is that it really didn't seem to impact the change in contribution rates. We had to see, to be considered changing or reducing your contribution rates, it had to decrease by more than 1 percentage point. So it looks like seems to be a considerable amount of stickiness in that contribution rate. Particularly, some of these plans could also be in a situation where they have auto escalation. So on that, but this is the percentage that reduced it. But that doesn't seem to be as big a factor as opposed to taking a planned loan to fill in that particular situation, which I think is a positive sign. However, the one thing that is kind of interesting as well is those that aren't facing or haven't faced a delinquency, you see a very similar number in the percentage of people that took a decrease in their retirement contributions. So that really says there's a lot of things more going on, that there is more things that are going on, why people are making these decisions. And that's why we wanted to look at the whole plethora of credit data to really hone in on there, because really what we want to do with financial well-being products or vendors or programs is to find out where can we address these issues and really find out what things should we really emphasize in those programs, because ultimately we want to increase their finances so they can increase their retirement accumulations. Therefore, they'll be able to have a better retirement, they'll feel more secure, and then that's where we're going on. So really digging down into this is really the big thing that we want to do. Since I'm the only thing now from keeping from lunch, and we're at a minute because I messed up 2 minutes, we can, I'm willing to answer any questions whatsoever afterwards, but I would like to release everyone else out for lunch. Remember, we'll be back at 1 o'clock, so please enjoy your lunch.
Okay, we can go ahead and let's launch our afternoon program. My name is Leslie Muller, and I am a Senior Research Associate at EBRI. And I'm going to be talking about generational wealth today. So, thanks, Bridget. Let's get a little motivation. Why do we care about generational wealth? Well, what I'm going to do is I'm going to look at the millennial generation, Gen X, and baby boomers, all at the same ages, and look at their wealth, assets, and debt. And so wealth is a key indicator of financial security and retirement readiness. So these differences, we know, matter, for how each generation is investing, what they're investing in, what their debt looks like. This matters for policymakers, for retirement plan sponsors, and financial service industry. So this research hopefully is going to better inform policy, benefit design, and financial well-being decisions. Okay, so an overview of the study. Now, this is a snapshot in time study. Now, EBRI had done a study like this using the 2019 Survey of Consumer Finances. So I am updating that study with the 2022 survey, which is what I'm going to be using for the millennials. So we have the millennial generation, Gen X, and the baby boomers is who I'm going to be comparing today. So I am using, as I said, the SCF, which is fielded every 3 years, and I'm looking at each generation at between ages 27 and 41. Okay, so this is a snapshot in time analysis. So the baby boomers were that age and appeared in the 1989 SCF. The Gen X was the 2007, and then the 2022, we've got almost the full millennial generation in there. Absent, we still have 26-year-olds, but to make sure the bands were equal, I cut that to 27 because Gen X in the 2007 didn't have 26-year-olds. Now, one thing to note is that the results I'm going to present are all in 2022 dollars. Okay, so they've been adjusted for inflation. Now, again, I just want to note that these results are a snapshot in time, and we know that economic factors, asset prices, these can all affect asset values, what you're holding, and so I'm not trying to predict the trajectory that millennials are on or Gen X is on, but rather just to show kind of where they are with respect to the other generations. Okay, so let's start with, pretty broadly, with just median net worth, assets, and debt. So the purple bars are the millennials, the orange are Gen X, and the blue are baby boomers. So on the left, we see net worth. So we can see that millennials are actually ahead in net worth at about $98,000. Now, this may be surprising in the sense of before the pandemic, most of the results showed that the millennials were indeed behind. But we have seen a run-up in asset prices. The stock market was up and down, but overall has benefited the millennials as well as the higher home values. Now, that doesn't necessarily mean that millennials own homes at a higher rate, because they don't, but those that do have higher values. So higher net worth, is that because assets are higher, because debt is lower? Well, it looks like it's a little bit of both. So we have the millennials slightly higher assets at about $259,000. Remember, these are medians, to $253 for Gen X, but they also have lower total debt. Now, I know when we think of, what are some of the challenges with the millennial generation, it's student debt. So this is not student debt. Student debt is in here, and we'll get to that soon. But this is going to be total debt. And they do have a lower median in total debt. Okay, so if we then look at the distribution of median net worth, we've got the distributions by income quartile. So you can see on the left, that's going to be your first quartile. So we're talking in about $30,000 a year. The fourth quartile is about $125,000 to $135,000 a year. And we can see that in all of the quartiles, the millennials do have higher medians. However, we see the greatest jump in probably that fourth quartile, and even the second quartile, we've got basically a doubling of the median. So we don't see any quartile necessarily losing here, but we do see kind of a heavier upper tail. Okay, so now I want to look at a couple of specific assets. So first, before I look at medians, I want to look at, well, what % of each generation owns these specific assets? So starting on the left with account-based retirement. So account-based retirement in this survey, we're looking at defined contribution plans, IRAs, both in and out of DC retirement plans, basically. So anything that's account-based. So we do see that the millennials have the highest rate of ownership at 60% versus 54 and 42. Now, there's one caveat here that we have to remember, right? And we know that in 1989 with the baby boomers, a lot of them had defined benefit plans. And so did, to some degree, Gen X, much more than the millennials. And so we have to keep that, keep that in mind. This measure of wealth does not include defined benefit wealth, okay? Okay, what about stocks? So when I'm talking about stocks, I'm talking about stocks within retirement plans and outside of retirement plans. We're including mutual funds, direct brokerage, and then the stocks that are going to be in account-based retirement plans. And again, we see the millennials have a higher ownership rate. Probably a lot of this is due to the fact that they have a higher ownership rate of account-based plans. But it's also been shown that they have been starting to invest in stocks earlier than other generations at an earlier age. So then let's look at, finally, home ownership. So here's where we see that millennials are behind. Now, they're not terribly behind at all with respect to the baby boomers, right? It's basically the same. So we've got 55% versus 56%. But we do see a 5 percentage point difference from Gen X. Now let's look at the median values for those asset categories. Oh, and I just wanted to mention these are given asset ownership. Okay, so given that they own the asset, what are the median balances? Account-based retirement, millennials are ahead there. Stocks, ahead by a little bit. We don't see a large difference there. Home equity, quite a bit higher. Now, why might that be? Well, millennials we know have lower home ownership. Housing prices had gone up quite a bit, and so those that can afford to own a home are going to be higher income. They're going to be buying the higher value homes. And then finally, with respect to assets, median retirement account balances by income quartile. And we do see here that, again, over on the right tail of the distribution, we have the millennials lead by quite a lot with respect to Gen X and the baby boomers. Okay, so let's finish up with debt. Ownership of select debt. So I'm going to look at credit card debt, student debt, and then debt secured by the primary residence. So credit card debt is basically equal as far as ownership goes. About half of each generation in this age band held credit card debt. Student debt. Okay, so here's where we see where millennials, a lot of them, more of them hold student debt than both of the other generations. So 40% of millennials hold student debt, or held student debt, I should say, in 2022. And then looking at the debt secured by the primary residence, we see that millennials are slightly lower with debt than the other two generations. Okay, so let's look at the values. Let's look at student debt. So millennials don't have a much higher level of student debt than Gen X. However, we have to remember that 40% versus 26% for Gen X, 40% of the millennials have debt. So, even though the median value isn't that much higher, the holding of debt is much higher for the millennials. And then looking at median student debt by income quartile. So what we're seeing here is the millennials have more student debt primarily in the first quartile, so the lowest income quartile, and also the upper quartile. And so why might that be? Well, we know that in the first quartile we have a income constrained. Students are going to need to borrow money. I mean, that is I think pretty intuitive. In the fourth quarter or the fourth quartile, we have much more educated people who are probably going for higher degrees. Okay, so they're not just getting an undergraduate degree, they're going on for their master's or their PhD and incurring more debt. Okay, so what are some of the main takeaways of this research, and also what am I looking to do in the future? Between the ages of 27 and 41, millennials had the highest net worth in total assets and the lowest total debt. They were the most likely to hold retirement accounts and had the highest median value, but were less likely to own homes. And then while millennials only had a slightly higher median level of student debt than Gen X, they were much more likely to have it. Okay, so and then this debt was distributed more in the first quartile and the fourth quartile, the highest quartile. So what does this lead to with respect to future research? Well, again, given this is a snapshot in time, there are other ways that we can look at sort of these generational differences that I haven't explored yet. So this is something for future research. I am also hoping the next SCF hopefully will come out soon. That would be the 2025, so then we can get another snapshot of how the millennials are doing. Okay. Any questions? Yes, Rodney?
Wait for Mike. There we go. Okay. Fascinating, the comparison, Leslie, and what it made me think about, more of a comment, is the great wealth transfer that everyone's talking about right now. And what we find is that from that same skiff, American households hold about $150 trillion in wealth. But over half of that, 85 trillion, is owned by baby boomers. So I'm wondering, because it seems like millennials are on a trajectory to surpass that, will we see another great wealth transfer happen when millennials get into the ages where baby boomers are, is what I'm thinking. Okay,
so, well, first of all, I think it's hard to say sort of what trajectory millennials are on right now, right? I mean, if you look back at before the pandemic, it didn't look good for them. And there are certain reasons as to, or we had talked about higher asset prices and also housing values as to why they then are doing better now in 2022. So yes, I mean, it's certainly possible to see that happening in the future. Again, I want to get more into and dig into sort of the behavior of the millennials, right? Because this is not getting at, we know some things about millennials, right? We know that they marry later, they have children later, and we know that they started to invest earlier. But to kind of say, well, these results are generational specific, I can't really say that. So I kind of want to dig in a little more to kind of answer questions like that. Other questions? Yes?
Are you starting to see anything from a Gen Z perspective? I noticed that wasn't listed. And also from the asset side, are you seeing anything from the quartile perspective? So the earlier conversation around the K-shaped economy. So how are you seeing that from a quartile perspective across generations when it comes to asset?
Yes, that's a very good point. I don't have data, a lot of data on Gen Z, because of it's 2022. And so they're going to be getting out of college, just starting work. Hopefully in 2025, the 2025 survey, I can look more into Gen Z a little bit more. So I guess I can't really give you an answer to that, given my research. Yes.
In terms of the Gen X housing story, is that principally a matter of kind of Gen X being the prime generation or the prime cohort that was exposed to the housing crash? Would you, just in terms of the kind of the overtime trajectory there?
As far as it being 2007, is that what is that because that's when the survey was? Is that what you're?
Well, yes, and also just the sort of life cycle effects of presumably when Gen Z was buying houses, which presumably would have been right in the run up to the GFC, as opposed to the millennials who are presumably the ones who are buying houses are buying that in the aftermath where asset prices were a little different.
Right. So they were able to have higher home ownership. Is that what you're?
Oh no, I actually meant in terms of the value of their homes. I was a little surprised to see the difference in the asset price, the overall asset prices there, and I was wondering if it was because Gen X took such a hit in the GFC, and then the millennials kind of bought the dip.
Yeah, it's probably a little bit of both, right? Because I think just seeing that the millennials having such high home equity, and then you look at the fact that they have lower home ownership, is kind of telling you that there are certain people that can buy these homes versus back when Gen X, there were more that could afford the homes. Yes. Okay. We all set? Okay. Great. Well, thank you very much.
Thank you, Leslie. That was very interesting. And we actually had a panel at our global conference on the financial headwinds faced by Gen Z and millennials, which got a lot of attention. So we've been looking into Gen Z as well. So please join me in welcoming the panel focused on the financial security of women, designing for equity, advancing industry advice and products for women's retirement. So I'm going to start out with just a little background for a couple of minutes, and then we'll get into a discussion. So today we'll be discussing, as you know, the unique challenges women face in securing their financial futures, which are somewhat different than those of men. Things like caregiving penalties, we're calling it, how women talk or don't talk about finance, issues of longevity, women living single lives for long periods of time, and much more. So I'm happy to have the great panel of experts here who will highlight their experience in hearing from women, interacting with them directly, many of them, and conducting some research and financial education. So we'll dive into how we can evolve from a sort of one-size-fits-all approach to intentionally designing savings that help women, savings models, and reaching out to women and things that women can do themselves. So a couple of statistics, Prudential's research, hope I'm citing it correctly, I did look it up. Pulse of the American Retiree found that at age 55, the average woman had about $50,000 saved, and the average man had $157,000. So that's quite a disparity. That's 1/3 difference. Our report that we issued early on, the Shifting the Retirement Paradigm report, quoted some research by Edward Jones saying that 58% of men reported saving retirement,
and only 41% of women did. So sorry about my voice, just losing it. But various firms, as you know, have been reporting on women probably having lower confidence. We can touch upon that in finance than men. That's not the case across the board, and I didn't really want to present this as, you know, women don't know as much as men, because often some of these issues are going to apply to both men and women. But we certainly see earnings gaps. And lastly, I'll say that Edward Jones, in their 4 pillars of a new retirement, which we cited in our report, noted they gathered information and data on women and from between, actually working women, I'm sorry, between 23 and 65 are working full time. On average, at least back in 2023, they found that they would earn about $469,000 less than men. Accounting for race, black women would earn about $705,000 less than men. Hispanic women would earn $869,000 less than men. So that's significant. And so we'll sort of dig into talking about women and also ways that the industry can maybe modify some things to help them and what women can do. Love to have the panel introduce themselves. And so Judy, why don't you go ahead and introduce yourself and tell us a little bit about what you do.
Well, thank you, Cheryl. Hi, everyone. My name is Judy Herbst. I'm the Executive Director of Savvy Ladies. And it really is my privilege here to introduce many of you to what Savvy Ladies is all about. We're a nonprofit. We were founded in 2003 by Stacey Francis, a financial executive who started her own firm because she saw the need to empower women with financial education, to give them a safe place to build confidence so they could ask their financial question. Fast forward to where we are today. I joined the organization initially as a volunteer and helping them with their marketing and PR, and we launched the Savvy Ladies Free Financial Helpline as a digital app. So we became very digital savvy, and we built a platform where women now are finding us from across the U.S., across all ages, with all questions, and they have a financial concern. And they're asking their question online in our app, the Savvy Ladies Free Financial Helpline, and they're being connected with a community of pro bono financial advisors. We have over 300 advisors, CFPs, CDFAs, CPAs as well. There's always tax questions as well. We work with organizations like the CFP board, the FFP board, who send us referrals. So we become the place where women are seeking expert advice for their financial question. And with that, since the app launched in March 2023, we have seen over 7,000 women submit questions to the helpline. And we are seeing right now, this year, a 14% increase year to date. So that means we're seeing over 200 women each month. And we're on a trajectory to hit 5,000 women on an annual basis who are submitting their financial questions. So we have amazing data. And what we're seeing is confidence. Cheryl, it really is confidence that I'm so excited to share some of that data with you today.
Good afternoon. I'm Marina Batliwala. I'm a senior investment consultant at Mercer Investment Consulting. I'm based in Los Angeles. I advise pension plans, defined contribution plans, endowments, and foundations. Completely separately to my work at Mercer, I launched a podcast a couple of years ago called Banking on Girls, which aims to address the gender financial literacy gap and the gender financial confidence gap, so that women can hear other women talking about money in very plain terms.
Thank you.
Thank you. I'm Cindy Hounsel. I'm the president and founder of Wiser. I don't know how many people know about us. My story has long been told. I've had a frozen benefit back in the 90s, and I had no idea what that meant, and I came to Washington, and I tried to find out, and I'm still trying to find out what that meant. So. Anyway, I'm pleased to be here on the panel, but my connection to financial planners are mainly, I provide, well, not just me, but our organization provides education. We go with a lot of employers who are employing caregivers and teach them about financial planning and what they should be looking for and helping people with. So it's a pretty complicated area. Our big project is the National Resource Center on Women in Retirement, and I'm glad that one of our partners is here, Hector. Raise your hand, from the CFPB. And also the area agencies on aging are one of our big partners. And the United States Administration on Aging cooperates on that project. So we travel around the country, we talk to a lot of people about aging issues and the cost of caregiving and where we're going to get caregiving and how not everyone is going to be able to age in place without caregivers. So it's a big issue, and I'm pleased to be here. So thank you.
Thank you, Cheryl, and everyone joining this session today, both in person and I guess streaming-wise. It's really a pleasure to be here. I'm Melanie Mortimer, president of the SIFMA Foundation. We are focused on increasing access for individuals of all backgrounds to prepare for their financial lives through resources, tools, and programs that really reach across the spectrum and across the country to create opportunities for accessing capital markets, investing, wealth creation, and wealth building opportunities, regardless of zip code and background. We collaborate with educators, with industry, with SIFMA and its member firms, and I'm glad to see Lisa Blyer here today, who is really on the expert side of industry. It is all of those financial professionals that we deploy into classrooms, community centers, and group discussions to ensure that real-world financial insights and current and accessible tools are becoming part of the normal day-to-day conversation for so many families and individuals. We work with 25,000 women and 400,000 girls per year through our programs, in addition to reaching a broad swath of both genders and mostly younger ages, but increasingly all ages, with a cumulative number of about 23 million at this point. We've been around almost 50 years doing this work and have much more to do. We really believe that financial and investor education is a must and that it must start early, because the sooner you begin, the greater opportunity for those long-term compounding returns for young people. Nowadays, our financial lives begin very young. Consider if you have children or you know children, what they're doing most of the time, they're on their phones. A click of a button is potentially a major consumer purchase. There are online resources that aren't always beneficial to their credit, to their financial lives. They don't even realize that they're building it at that time. And so early intervention gives them an opportunity not just to understand the choices that are coming to them, but also how to navigate those choices. And not just for the sake of being able to deposit more money in the piggy bank, but actually to fight inflation and let those dollars begin to work for them through compounding, through long-term planning, through interest, and a variety of other very basic economic fundamentals that I'm sure you all are aware of, but sometimes need to be broken down into basic conversation with young people. And when we start early, that's really when the benefits are the most pronounced, especially for girls, where it's quite nuanced as they build their financial lives, which is what we're going to hear about from everyone here today. And so at the foundation, knowing that only 8 of 10 parents, or I should say 2 of 10 parents, feel equipped to teach their children about personal finance and investing. And most states still don't have a full graduation requirement that's been implemented around personal finance. It's really not okay for this to be up to chance. And we are doing everything that we can to ensure that it is actually embedded in the curriculum, embedded in subjects at schools, embedded in community centers, embedded in libraries, and in family conversations through easy access and turnkey tools. Thank you.
Thanks. And I didn't mention, but we wanted to hold this panel because we've started a Women's Financial Security Initiative. Barb is a member, and the cool thing that I often bring up is the fact that we've had 2 events at Gloria Steinem's home. I was fortunate enough to lead a talking circle with Gloria that Barb joined, Cindy joined. We also had a dinner that Marina and Melanie joined, a women's financial empowerment dinner 6 months later. So if anyone's interested in it, it's called Gloria's Foundation. She's still raising money to save, to maintain her home as a gathering place for women. She's 91. I thought to just quickly add a couple of quotes from Gloria because they're so inspirational. And there's a piece that we wrote called Our Afternoon with Gloria Steinem. She just said sort of some of the obvious things, right? She's been fighting for equal pay because we kind of glossed over that. Women don't earn as much as men on balance still. You know, she said, I want to see women paid equally and treated with respect in all ways. Not a surprise from Gloria. And the most common quote that we often hear from Gloria is, we'll never solve the feminization of power until we solve the masculinity of wealth. So that's sort of a powerful take from her, and we really enjoyed these gatherings. But let's sort of dig into first what's going on with women, where they are, what some of you have learned, and then we'll get into some things that the industry can do. So we want to make sure we get to that industry piece as well. But Judy, you started talking a little about free advice and sort of highlight some of what the women are seeking. I think you touched upon it, but you talked about them, you know, talking about building legacies, that you're answering a helpline, and what are the women learning? And you also mentioned some learnings about Latino women that were interesting, that new things you're hearing, right?
Yeah, absolutely. So helpline, women are coming to us. There's this growing cohort. The increase is coming from the 25 to 34-year-olds, and they are very interested in building. In wealth building. So while we hear in the industry the wealth transfer, the clients that are coming to us are earning typically under $75,000. So these are low, moderate income women who have a career, they're starting out, and I think it is a very proactive that they are actually motivated to come. But they're coming to the Savvy Ladies Helpline. Couple reasons, and this I think is very eye-opening. We're unbiased, we're neutral, we're not soliciting, we're not selling, we're listening. The volunteers are listening to the women, and it's a two-way street, it's a dialogue. We enable the women to identify their category. There's 12 categories, so they self-select. Investing is a top one, career, family finances. And when we put family finances, it was single women, it was many Latina women, Black and African American women recognized family financiers because they're building money, not just for themselves, but for their family. And when we started being culturally sensitive to the needs and listening to the women and the reason they're coming, they're still asking questions, how to build wealth, but it came under family finances. We then were able to produce and create workshops that resonated much better with the audience. And so we've been able to outreach to a far growing segment of women who are seeking to build wealth. And what we're seeing is many Latina women are coming to us that are first generation, that are really inquiring about what do I do with my 401k? We talked about it in the last panel. The Roth IRAs, the IRAs, they understand that the money's going in there and I can open up an account so quickly online, but then what? And that's when they're coming to Savvy Ladies. And what we're giving them is clarity. We're giving them options because the volunteers are sharing and explaining and going through that transparency of understand these are your choices to make the best choice for you on your journey. Like, let's be transparent with those fees and transactions and explaining in layman's terms. And I had a quote I just wanted to share real quickly. I thought it was very telling, is that a woman said to us, I was given clarity and understanding of the choices for me to make. And then we had another client say, I just had the most uplifting and wonderful, empowering session with a volunteer. So those are the words we want to hear. So as we talk about education, it is about listening to the clients. It is about uplifting and empowering. And how do we do that? And I loved that Melanie talked about group conversations, because we find that we have money circles and it's mother-daughter circles because the women are saying, I wish I had this for my daughters. So can we bring money conversations into the classroom is really powerful.
And I think we'll have each of you make a few comments, and then we'll kind of move into, we want to make sure we get to things that are happening that can change in the industry. But Marina, you've been talking to women. You have some learnings from hosting the Banking on Girls podcast, and give us a few of those takeaways quickly, and I'll have Cindy and Melanie give a few quick takeaways, and then we'll move into the next part.
Sure, happy to share some of my personal views that I've learned from my podcast. You know, I've interviewed so many incredible women, including Judy, Melanie, and Cheryl here on the podcast. But what I've learned is that many very professionally accomplished women say they wish they had started earlier. And that's a stark finding for me because it's regardless of socioeconomic level. It's across the board. I had a Fortune 500 CEO say she'd wish she'd started earlier. I've had a Fortune 500, a different Fortune 500 company CFO say that she wished she'd learned about the stock market earlier. And they talk about it as one of their biggest financial regrets. The other thing I've learned that is a lot of financial literacy points to starting earlier with habits and behaviors and values, which is different to knowledge and numbers. And I've learned that some of those habits and behaviors are formed as early as the age of 7. So as a mother of 3 teenagers, that's a little startling as well.
Yeah, and well, Cindy, you've worked with women for 30 years, and you've been hearing about their challenges, their desires. You mentioned something interesting when we spoke, which was, you know, you felt like, I think, maybe I'm sort of speaking for you, that you've been the most impactful working with women at the lower end of the income spectrum who weren't really connected to finance. So you had highlighted some things about, you know, what they want, pensions, et cetera, and also sometimes they're coming to you with questions where they're not maybe ready for an advisor, right, when you dealt with those women.
Right. A long time before the low-income women are going to be seeking out their financial planner. One of the great things, though, about it is, like, the more you work with these populations of women working 2 jobs, 3 jobs, whatever, and not having any idea what's going to happen to them as a caregiver for their own family. So we do a lot of work with that. We try to get them to have these family care agreements so that one person isn't ending up in poverty because they're taking care of everything and nobody else in the family steps forward. And we've done research with public opinion, with the National Council on Aging, and what we've all found is that there are plenty of benefits that employers could provide if they wanted to, and so we have work on that. I have a great slide, but I thought we weren't supposed to have slides, so I was following all the rules here of what we were supposed to be doing.
I don't know that we imposed really strict rules, but yes, Cindy, you've gathered data for so long, some really interesting data, and a lot of it's going to be on your website, I think. So
anyway, so I have a great slide from public opinion.
Do you?
Well, I don't have it right here, but I can wave it
What is
around
it?
At some point. So.
Okay, yeah, thank you.
So we'll make it available. So.
Thank you.
Yep.
And Melanie, you already highlighted financial education in detail, but you also said something interesting when we spoke, Melanie, which was something along the lines of women are more connected to sort of financial well-being, household financial well-being, not their own retirement, sort of, I think you're saying planning for lots of other people, not themselves. Touch upon that briefly, and then we'll move into some of the big challenges, systemic challenges.
Well, one thing I wanted to talk about was the younger women as well.
Oh, sure, go ahead before Melanie. That was for Melanie, but go ahead, yeah.
So younger women are getting pushed into taking care of their parents.
Yes.
All of a sudden the phone call comes and they have to rush home and take care. And then they find out that they don't know how to do their own thing, and now they're doing like the family's finances.
They're taking care of the family's finances when they haven't really learned about their own. Yeah,
people.
plus caregiving maybe of children as well, which is an issue, and I know EBRI's done some significant research in the caregiving space. Yeah, Melanie, you said a lot about education, but you had that interesting point that I was trying to make on your behalf, but you can make it more eloquently.
I don't know about that, but it's actually really interesting because 79% of women say that they feel really confident about their day-to-day finances, and yet the same percentage will tell you that they don't have a long-term financial plan. And so half of women do not feel confident about retirement. And I read an interesting thing that the women are showing up as the CFO of today. They're paying their bills, they're taking care of budgets and caregiving for the families, but not as often showing up as the CIO of their future, and really not thinking about that next step of investment and retirement decisions, mostly because of structural reasons, like you've shared, Cheryl, but they really don't feel comfortable about retiring on time, and it's driving a greater interest in and demand for financial education. About 8 in 10 women want financial education, and so that gives us a huge opportunity to fill that demand. And what we also know, Cheryl, that I know that you mentioned when we spoke, is that when women become invested, partially because of greater risk aversion, but there is a longer period of time that they stay invested and end up doing better over the long term as a result of that, which I thought was interesting. And when girls are given access to personal finance early on, they're able to build a sort of identity, a financial life and a financial life identity around themselves and what they're learning. And so regardless of any stereotypes that may make them feel shameful or embarrassed if one of the boys in middle school especially about what they're learning and being interested in finance and math and those STEM studies, this is a way for them to normalize it and begin to build confidence in themselves, in their own decision making, in their ability to lead others and share information with them. And when that starts early as a foundation, the long-term impact is really exponential.
And let's talk about some of the challenges. Some of them are systemic, industry-wide. Some of them are just based on women. You know, the caregiving penalty people have often spoken about. Women make up approximately, by some studies, I think there are a variety of studies on this, 60% of caregivers, maybe more. I think I said on the call, I'm an attorney, I've only met one man in my entire life who said he was leaving the workforce to take care of his child. He was at the Department of Justice, and we were all shocked, right? So women are doing that. They're going in and out of the workforce, which we think accounts for them, at least in part, saving less than men. And I know Catherine Collinson, I don't know if she's here, I don't think she is, but her Transamerica research and EBRI has research a lot on caregiving and what we can do. So that's one issue. And more women are going to end up single, right? There's some stats on widowhood, and most women are going to be single for a large part of their lives. And so that's an issue. And also, of course, people refer to the double jeopardy of longevity and lower earnings. On average, women are going to probably live 4 to 7 years longer than men. So thinking about those things, what do we think about the notion of a credit that firms could put forth for caregiving, caregiving catch-up credits? I wanted people to sort of touch base or weigh in on your thoughts on that. And Cindy, you've been thinking about that for years too.
Well, I mean, it's proposed. It just doesn't go.
It doesn't go anywhere.
And it's an out of.
You're not in the mic.
Sorry.
Yeah, go ahead.
Yeah, we're talking about the caregiver credit because of caregivers spend out of pocket $7,200 a year on average, and so there's always room for finding somebody who will, think that the bill will get passed, today, because there's now 73 million caregivers that are unpaid, that are taking care of all the people that need to be taken care of, and it's going to get worse. I'm not about to mention like the people that are no longer available to be doing all of that work. I have a friend in New York whose husband has one of those terrible cancer, brain cancer illnesses, and they have 3 people that do shifts, but they're afraid to come out of their apartment now. So she and her son who are not experts in taking care are trying to do all of this. So there are a lot of stories like that. There's a lot of people that actually need help. And on the brighter side, we could just talk about what people don't know. And what people don't know is that they're supposed to be signed up for Medicare by the time they're 35. 65. I don't know how many people have heard about this, but you get penalized, and you get penalized for the rest of your days if you don't do that correctly. So if you have parents or family, whatever, it's good to know that. The other thing that you'd be amazed that people don't know is that they have to pay Medicare premiums. So these low-income people don't have a clue that coming out of their paycheck is going to be like $160 a month for, for a small benefit anyway, because how would you know that if you don't have any sort of education around any of this? So the problem...
No, go ahead, sorry.
Yeah, no, I was just going to say that, there are all these gotchas that make it worse for people, and they don't know where to find help, so...
And we were thinking also of the caregiver credit penalty, if we want to call it that, of women just coming out of the workforce. In other words, they're not working as long as men. They don't have the opportunity to save as much. So that catch-up notion, I think, is key. And
Cheryl, I wanted to mention that what we're seeing, the women who are coming to Savvy Ladies, so many are coming back into the workforce after, the 55 plus, and sort of career pivots. And I think that is a whole opportunity as you talk about career and that opportunity. There is great opportunity for women going into career pivots at the age of 55 plus. What can firms and companies offer to these women? Because I heard a term the other day, and Melanie, I want to share this with you. It's work optional. It's really not retirement. Many women actually don't want to retire because there is an opportunity to work and be in a community if it's what you really like doing. They want flexibility. And that's what we hear. We did a survey. They want flexibility. And so this idea of career pivots, new career opportunities, so they can afford to pay and care. They want that flexibility, and career pivots are some big opportunities.
And we focused on this as well in some of our research at the Milken Institute, the need for longer working lives. As we live longer, we want people to be able to earn money, particularly if they want to or need to. We think the nature of work is going to change. Is everyone going to have one job? We certainly know people aren't going to, we're hearing stats that they stay in their job for 2 to 4 years. But also people are having multiple jobs. So we need to rethink work and how people earn money. And that's going to be across the board, not just for men and women. And so I actually wrote a piece for ARP's website focused on that, but it was more focused on those in physically demanding jobs, such as a paramedic or a nurse, and can they use AI to transition to a training role? So that's kind of another unique opportunity. We also are seeing, I think Aaron Schum has left, but from Vestwell, he and others, and of course the fintech companies we've been hearing from for over 3 years, really, these tech-enabled platforms, I think, are going to be helpful. It helps people envision their lives. Women in particular want to do that. And we talked a little bit in our discussions about what about advisors working with women and looking at their stages of lives and where they are. So there's an opportunity for advisors to interact differently, which we can touch upon, have you all comment on. And then also these tech-enabled platforms. There was a notion that an AI chatbot may be easier for someone, maybe a man as well, to discuss their finances with, because there's often shame around not saving, right? And so these tech platforms can help with a variety of things, we think, and a lot of firms have those, not just certainly Vestwell. But so what are some of your thoughts on those 2 points? I know, Marina, you're looking, yeah.
Sure. I recently started mother-daughter financial literacy workshops as a development from my podcast. And what I've observed is that women really just want a safe space to talk. They really want to help their daughters take agency over their own financial lives. And I talk a lot about the gender wealth gap, which everyone here is familiar with, but not necessarily everyone out there is familiar with. And they haven't really understood the structural issues which are causing that gender wealth gap, other than maybe the gender pay gap. So that's very enlightening, and I think it helps girls know that this is what they are facing and how they can plan for their futures. And they're also looking for a common language to talk about money and finances with to their daughters.
And Melanie, you talked with us on the call and personally as well on what advisors can do better, what financial firms can do better as they engage with women. I know you have some thoughts about interacting with women, how financial firms can better do that and keep their clients, et cetera.
Well, one thing I think is important for women is to not hear from the advisor that it's too late and there's really nothing that they could do. And there's so much, and that happens a lot, which is why a lot of times it's the male that says that. And so the women then don't want to look for male advisors, but I have a male advisor, so I can say that. So
yeah, there's certainly less women in the industry. I think when I worked at CFA Institute, the number was sort of hovering around 19%, hasn't changed. And Melanie, you had some thoughts on this as well.
I mean, yeah, for us, it always comes back to education at the SIFMA Foundation. But if you look at the proportion of women financial advisors versus men, oftentimes women don't have a choice but to be represented and work with a male financial advisor, which is great. But imagine the kind of trust relationship being reinforced with an identity, if you will, and a depth of understanding, sort of nuanced, internalized understanding of that financial life of being a mother, having kids, being sandwiched in that generation where you're taking care of kids and parents at the same time, maybe leading a single parent household, the majority of which is run by women. But there's such an opportunity here, especially as we talk about the great wealth transfer, because so many women are going to be coming into wealth as a result of this, and building their confidence as much as their understanding of their options is really critical. And trying to do so in line with how they see the world and how they experience the world is also very helpful and provides a competitive advantage. When I was at the Merrill Lynch Foundation, we had a lot of families look at a kind of family conversation around personal finance, whether they were high net worth or struggling to pay the bills. There were so many teachable moments through life experiences. And so advisors began to work with family-based conversations and family-based education. We also, at the SIFMA Foundation, work with tens of thousands of financial professionals every year, and we help deploy you into classrooms and community centers. We provide the materials to make it turnkey, fun, engaging, real world and experiential for the young people you're working with. And then we really advise that if there is capacity as firms, that you look at supporting financial education efforts across the nonprofit space. There are hundreds of organizations, thousands of programs that touch on every aspect of personal finance, whether it's investing or it's compound interest or it's saving and spending or insurance or leadership development within your financial space. So there's so much out there, and I would encourage continued investment in what's there.
I was also going to say, do we think that financial firms, retirement firms, as they build out their platforms, more and more is online, and also individual advisors, perhaps RIAs and other CFPs, should they be looking at something we've advocated for? So should they be looking to work with clients at life stages? I know Aaron has again, not here, has talked about the touch points. Should they be helping people not just plan for retirement, but think about, all right, what stage am I in? Am I in the stage where I'm trying to save for college? How do I compare that to my retirement savings? You know, what is the interaction there? I'm divorced now. What, how do I connect in that way? There's a death of a spouse. So I think there's that opportunity for the industry to pivot to meet people where they are in a more direct way, rather than this ultimate goal of saving for retirement, which is an important goal, but we're not sure if everyone's going to retire in a traditional way as well. But what do we think of sort of that model from the industry and advisors? We think that would be helpful, particularly to women, I think, right?
I think absolutely, Cheryl. I think it's so important that you meet women where they are, how they want to be spoken to. They want to be heard. And I think the biggest takeaway that I can share is when women, we have many men financial advisors who are volunteers, and they are some of our top volunteers. When I started with the helpline, it was very skewed men. As we know, the men are in the industry. I intentionally went out to recruit women volunteers, and so we're a good mix, like 60-40, 60 women now, 40 men, but the top volunteers are men, and they have a story. So it's sharing your own personal story, it's being a good listener, and these make excellent volunteers, and the volunteers want to refer the clients to trusted resources. So there's just so much out there. The clients are going to YouTube, they're listening to podcasts, they're very confused. As we heard today, there's zillions of different acronyms. They don't know what those terms mean. Half the time their employers are not sharing that information, or if they're sharing it, they're not going to the sessions, they're not reading it, they're looking online as they're doing their work or talking on their phone, like they're multitasking. So when they're ready, they have found the Savvy Ladies helpline. So they're motivated. The question is, how do we reach more women? Because when you reach more women intentionally, they are motivated to invest, to learn, to build their financial futures and their legacies. So I actually ask all of you, how do we reach more everyday women where they are? As you said, Cheryl, like meet them where they are. And sometimes it could be on, I'm thinking it's the health, like we talk the health industry. There's so much in the health industry. The women are worried about their heart, their health, their well-being. They're going to the gym, spas. We need to be there with financial tools and education and motivation, and then the tools and education come. But we need the motivation to say that when you're working out, it's helping your heart. Less financial anxiety is better for your health.
And that's sort of interesting because there's research that shows that widowed men do less well than women. And they often go to the doctor because they're married to a woman who makes them go to the doctor, so that happens as well. And some of the other issues that we sort of touched upon, I'm just being cognizant of the time, is the Savers match is out there, and we want to encourage policy changes, or at least the Treasury Department, we're in discussions with them about posting that, highlighting that in some really direct way so that people understand the significance of getting a $2,000 or $1,000 match. That's a change this year. So we think that's a key issue as well. And then, what do we think of spousal IRAs? Is that something that should be happening? That's sort of an interesting notion. Of course, we all agree that we should have auto escalation, auto enrollment. Those things, I think, apply equally to men. When we were talking with Barb, we were noting the same thing, that some of these issues apply to both men and women. But in thinking about women, they're living longer, they have this savings gap, really because they're coming out of the workforce and not being paid as much, to be candid. So I think those are some of the issues that we're thinking about, and then how can the industry match those issues and reach women, as we're saying, where they are, and then also maybe speak to them slightly differently. We have a woman joining us we're doing a piece on the feminization of wealth, and Carrie Carbonaro has written a book, and she's got an award at the Investment News. I was a judge there, and she's the one who stood up on stage and put her arms out really big, and I said, look, I have to meet her, and she just said, all you men in the room, her advisors, I'm going to take all of your clients. You don't know how to talk to women. When they get divorced, you're going to lose them because you never talk to them. And so that's sort of an interesting notion. I don't know how prevalent we think that is, but we do have the issue occasionally of, I have friends who aren't that old who've turned their finances over to a man. So we want to, for any news outlets out there, we want that to be part of the story. Please do not do that, no matter what happens. And not knowing, actually, fortuitously, my next door neighbor, she learned that she was really wealthy when her husband died. She had like tens of millions of dollars, and she was worried about spending, but she turned everything over to him. But I see younger women doing that as well. And so we have a few minutes. I think we'll ask for some takeaways, and I'll make a couple comments. We'll see if we can take some questions. But I would just say, each of you we only have 9 minutes, so if you can each take literally 1 minute, and then we can take questions, or even less than a minute, just one or two takeaways. So we'll go down the line. Go ahead, Marina, start.
Okay, I'm just going to put my Mercer hat on for a minute here. In the last half of 2025, we did an Inside Employees Mind survey. We surveyed over 3,000 men and 3,000 women. And it's really important to understand the lens through which women see things. So we asked them, how has the economy in the last 12 months impacted you? And 41% of the women versus 36% of the men had reduced their discretionary spend due to concerns on the economy. And generally, they were more negative on the economy for 2026.
Yeah, and Judy, Melanie, do you have any sort of high-level takeaway that I think to me, your big takeaway is financial education, but I don't know if you have anything else.
Yeah, I can do the final statement. So I really think early financial literacy can help build a more equitable society. And it's important to remember that when women rise economically, they bring everyone up with them, men, women, and children.
Good, really good point.
Yeah, I worry all the time that there are all these great programs out there in the aging sector that I work in most of the time, but people don't know anything about it, and they're not interested. And the programs that women most rely on are Medicare and Social Security, and people don't know the rules, and there's no way to access that information easily. So I would just hope that that improves, that someone takes it upon themselves to start doing these programs that people really need. So.
And I would just add, this is an all ships rise kind of situation where here we are representing the financial industry, and this industry helps individuals become capable, competent, successful, confident, happy participants in our domestic economy and our global economy. And we are the best equipped to help them learn the tools of the trade. And we are the best equipped to humanize the information for them. And we are the best equipped to go into those schools and inspire young girls to think about becoming a financial advisor, and to inspire those boys to keep supporting the girls to become financial advisors and do well themselves. So I just, encourage everyone here today to think about the role that you can each play in really changing the trajectory for the lives, not just of the women who are going to be part of the great wealth transfer, but the other millions of women who are going to be part of the great wealth building, which is critical, especially for those living in poverty. And with that, I believe we have a great chance of really ensuring that the future of this country and the economy is bright.
I love that. And Cheryl, I'll just add, financial anxiety is real. And the women who come to us that we see on the helpline, those 7,000 plus, the majority of them, close to 70%, have a very high level of financial anxiety. But with just one conversation with a financial professional that answers their specific question at the time they need it, their anxiety level drops and their confidence builds. So what is that big takeaway that we all can take from that is how we empower the women, build confidence, and reduce financial stress. I think how we do that in each of our lives, in our businesses, would be really powerful, because if we can have one more conversation like you have, like each of you have on the board, on the podcast with the women, you're moving that one woman forward.
Yeah, and we already kind of went over some of the structural changes. Certainly the industry has spent decades planning for a linear career path that often doesn't really fit the overall career trajectory that people are in right now, both men and women, as people don't fully retire or work in stages. I also think we've written on lifetime income. We're going to have some more discussions on that. I think that can particularly help women with the longevity issues where they're living longer and may have saved less. So I think that's a key factor as well. So considering those sort of new paths, and I would say our clock stopped long ago, but in any case, maybe we can take one or two questions. I would finally say, as we mentioned, about 70% of women are probably going to outlive their partners. So we want to ensure that they can do so with confidence. So that was the point of the discussion, and maybe we have, are we out of time? I don't know, I can't see the time. All right, so, because it says we have 9 minutes. It said that for quite a while. So, we'll just keep going. We can keep going. But I think we are done. But thanks so much for listening to this. Thanks.
Excited to have Dave Richardson from the TIAA Institute share with us what's happening globally around retirement and longevity. And this will actually really set us up very nicely for the afternoon, where we're going to talk about Social Security, alternative asset, the executive order on alternative assets, and guaranteed income. So it's a perfect setup. So I'm going to turn it over to Dave, and yeah, take it away.
Right. So I've got about 35 slides in 20 minutes, so I'm going to be going really fast. No, I'm just kidding about that. So this is, for those of you that aren't familiar, I'm head of, and haven't met, I'm head of research at the TIAA Institute. We're a corporate think tank within TIAA. We've been around roughly 30 years, and we are basically viewed as kind of an academic research shop within the company. We work a lot on issues related to lifelong financial security, which I'm going to be talking about today. Our other areas of interest are really around kind of organizational effectiveness. Primarily, historically, that's been in the nonprofit sector. You think about healthcare, nonprofit healthcare, of course, higher ed, which is our core market, even public K through 12, but places like Urban, Brookings, other places like that. So my encouragement is if you ever have an idea for research that you think might be worthy of something that the Institute could help you with, please don't hesitate to reach out. And so this right here, what we're doing is we've started moving into a more global perspective on financial security as well. And we're doing this for a lot of reasons, not one of which is that we are expanding our own global presence as through our Nuveen, our asset management arm. And so we started working on this to get a better understanding of how things are in the USA relative to other economies. And we really were interested in this because, and to be candid, is that we were seeing these comparisons come out by various groups that tended to really highly recommend certain economies like the Netherlands, and I'm going to talk about the Netherlands, that I've worked on personally a lot over the last 15 to 20 years of actually helping the Dutch reform their system because it doesn't work anymore, right? It doesn't work for them. I'm going to talk a little bit more about that. But what's the imperative that we see here? And what I'm going to say is that we're kind of in an inflection point in the global economy, right? And it's all due to population aging. This is a huge demographic impact. I know you guys are all familiar with this. The thing I like to remind people is population aging is driven by two things. People are living longer, which on average, we tend to think that that's a good thing, right? What I always tell people that ask me this is like, well, if you give me an extra 10 years in my 20s, I'd really like that. But if you give it to me in my 90s, I'm not so sure, right? Right? So anyway, but people are living longer. And so we have to adjust public policy, retirement, all our expectations, our financial advice, all these other things to kind of account for that. A squeezing of the balloon, globally, people are having a lot fewer kids, right? Which means that some of the structures of these programs that were basically set up under the assumption that you would have birth rates of around 2.5 or higher are no longer sustainable. Now, again, I would argue that lower birth rates are in net a good thing for the global economy and for the global climate. For most of my life, one of the biggest things that we were worried about wasn't actually population decreases, but too many people on the planet. I remember as a kid that movie Soylent Green where what's the guy's name where he finds out that they're eating people, right? Anyway, if you haven't seen it, I hate to be the spoiler there. So anyway, the other things that we find here is that because of this shift in population demographics, we're seeing a lot of things happening right now, right? We're having to devote more and more resources to basically what you, as an economist, you might consider kind of non-productive labor and potential labor in the economy. This makes DB promises very unaffordable, especially if they're being offered through some type of public program. And the counter side of this is DC plans historically have not been set up to really think about income. They've been viewed as an accumulation vehicle. Now, I take a very, very generous view in the U.S. with respect to 401k. I was talking to somebody about this yesterday. Our company, TIA, has been around for 100+ years. We've always offered annuities, and in fact, up until the late 80s, you had to take an annuity when you retired. From that point forward, from 1990 to today, we've offered a full menu of investment options. You can still take annuities, you can take systematic withdrawals, of course you can take your RMDs, you can take interest-only payments. We have a full-blown income menu that kind of matches up as a corollary to what you might think of as an investment menu. And the reason I say that is that that's part of that, the fact that we are a very mature company in offering retirement services. 401k, it's only in the last couple of years that I would even start to consider this to be a mature system, right? Because it was legislation in the late 70s, final regs early 80s. It wasn't until the mid-90s that you had 50% market penetration for 401ks. So we're just now seeing first large cohort of workers who are retiring where 401k was the only thing that they ever really had. And so I think it's just natural, and there's a lot of legislation on this these days, that we start thinking about how do you do this conversion. So for what we're going to do, we do is we have to develop a framework. We develop a very standard kind of what I might call a public finance framework for thinking about this. And I know Gene and others are going to be talking about this. But how do you measure a successful retirement system? Number one, adequacy. It has to do a good job of making sure that people can retire with confidence and dignity. Now, a standard measure that you might think is the 80% rule, right? Is like I need about 80% of my gross pre-tax, pre-retirement income to make it in retirement. And that's actually a very simple calculation in the U.S. All you're doing is taking off that I'm no longer going to be paying into Social Security, so that 7.65% for most people I'm not going to need, and I'm not going to be saving for retirement, which is if you're in that 10 to 15% range and a few other adjustments here, you're very quickly in that. We also measure adequacy from a standpoint of a more fairness one as well. It's like, how does it do in lifting people, making sure that they're not falling into poverty, right? And that's as a minimum for the public side of these programs that we want to do. And the last one I say is where we really got into this, and this is where the Dutch will tell you, is financial sustainability. And this is where we see with the demographic shifts, this is where you're seeing all the pressure right now for most public pay-go systems. They no longer have a large of enough labor force today, and much less in the future, to be able to support the current promises that they're making, right? The last thing I'm going to say is the one thing that we've added to this is plan design, which is the intersection of these other three things. It's like, what is that plan design? Because I know that there's trade-offs. The more I lift the adequacy criteria, the less sustainable the system becomes typically, right? And the harder it becomes to achieve fairness in many ways. So we use that as one metric. The second thing we do is what we noticed in this, and we found this really interesting, is when you see a lot of comparisons, it usually says, well, let's compare Sweden or the Netherlands to the US. Well, the first thing we notice is that structurally, these programs are extremely different. So we do a spectrum on here of what we call countries that we would call individual choice, and economies where they really value the role of the household and the individual into making these choices for themselves. This has historically been countries like the US, Canada, Japan. As you move across this spectrum, we move to what we would call collective choice, where there's a lot more risk pooling that goes on over time, right? You might think about it as like, I'm going to be making a lot more, I'm going to take these decisions out of your hands, and as you might guess, the Netherlands, Switzerland, Chile, some of these other countries put a lot more emphasis on both making mandatory systems, number one, of making people do things, and number two, distributing the risk across folks a lot more as well. So let's get into why this is important, is that people are going to be retired for a long, long time. And this is, again, we have 2 papers on this on our Institute website now. It's tiainstitute.org. If you're interested, you can go up there and you can find all our research papers. And what we're seeing in the last session, which was really, really good, one of the challenges that we know that women face is they tend to be in retirement a lot longer than men, right? And that's partly due to the fact that they have a longer life expectancy, but it's also partly too, if you look at this, in many countries, they're actually retiring at earlier ages than men, right? And so one of the things that you guys reminded me of when I was watching your session is the last time I can remember that the U.S. Congress explicitly addressed women retirement security was in the 2001 tax bill, the big extra tax bill, where there was a section in there explicitly about improving retirement security for women. And what was a big provision in that was catch-up contributions, because it was viewed that women were more likely to have gaps in their work record and needed that extra time and extra capacity to do it. So here's our imperative to do this. And so one way, when you think about sustainability, that countries might handle this is like, we're just going to do age adjust the full retirement age for public systems. And you hear this a lot in the US. I'm very skeptical about this for the US, and I will tell you why. This is why we're interested in doing this. Many of the countries that do this is what I would call, they're so structurally different from a demographic perspective. They're small, fairly homogeneous, compact countries. In fact, I never like to hear comparisons with Sweden, who we have in here, because Sweden as a country is about, population-wise, is roughly about what the size of New York City, right? And so while something might really work well for Sweden, it necessarily won't work for a very large, geographically, economically diverse country like the United States. Again, I can't imagine telling a truck driver or even a school teacher or an RN, something like that, well, you really need to work until age 70 because life expectancy is going up, right? These are very, very difficult jobs that people exit the labor force early. So the other way that you can do this, and this is also part of the discussion that we see right now, is like, well, you just have to contribute more. And we had an interesting discussion at the board meeting yesterday, I thought, is that this works and it doesn't work. What you can see is, and again, you see the Netherlands is a real outlier here. The Netherlands has, wow, they do a great job of providing retirement income, even though they're having to reform the system, but the contribution rates are in excess of 35%. So that comes at a cost, right? Nothing's free here. So every dollar I'm spending on saving for retirement is a dollar I have less for consumption. And again, this comes to the fairness criteria. It can't be a viable solution to say that we're just going to force people to increase their contributions, because there's huge chunks of the society that are lifetime low-income people that basically can't afford it. People that are within poverty, I would argue within 200% of the poverty range, I would never ask them to increase contributions to anything, because by definition they can't consume enough today, right? And why would they ever want to do something like that? So high replacement rates, we typically find that these normally, and you can see this dispersion here, as we move down, and what we're talking about here is that what we want to think is that these public systems, and one of the things that we see a lot, one last thing here on the fairness of it, I really love, this is my favorite slide of everything that we've done here. Basically, this shows you the distribution of the average, somebody that's making half the average income, someone that's making double the average. This actually shows that most good countries are doing a good job. What you really want in a progressive system, and again, when we talk about fairness, we're not talking about equal outcomes. Basically, what we're talking about, it's not necessarily, we want equal treatment of equals more than equal treatment of unequals, right? So, but what you see here is if that light blue dot is way above the other ones, it means that you have a higher replacement rate for low-income people than you do for average and high-income people. And so this basically fits. Again, what you might find is interesting here is the Netherlands, by the structure of their system, they are the least progressive, right? They are a very narrow range of what they can offer and relative to some other countries. And so I think that's a feature of our system that's worked very well over time. I've got another piece of research that I just finished up with a colleague at the Institute, where we looked at public DB systems within the United States, 87 different systems. And without a doubt, what we find there is when you factor in Social Security plus the DB, the lifetime low-income state and public workers are doing really well, right? The median to high, and we're using Social Security measures of this, so we're not talking about really high-income people. I think the high measure is around $130,000 a year. They need supplemental saving. And this is where we're getting with this study, is that these systems just aren't good enough to provide people with what they need, right? And so that you can see, again, some systems do better, some do worse. As people live longer, what we do need is there's a greater need for additional sources of guaranteed income to protect people against longevity and financial risk late in life. So these countries, some do well, some don't not so well. The big thing you can see here is what we've got here is we start splitting this into groups where in countries where you have to, and again, I'm going pretty quick here, you have to convert part of your savings into an annuity. Some or all of it. Those are the ones at the top. The country Switzerland, where it's mandatory to offer it, and so this is where I want to get to the point here, as an in-plan option, right? and then countries that don't really require it being offered through workplace plans. And one of the things we know both from a rational perspective because of high transaction and information costs, and from a behavioral perspective of the path of least resistance and some present bias, that if these things aren't being offered through an employer plan, people are never likely to adapt them. In our system, for example, in this past year, we would estimate that about 35% of our retirees have an annuity as part of their total income draw. And I say that, oh, I got one more slide to get to that, so hold on to that thought. The other thing I say is that, what we're talking about, if you're offering additional lifetime income, how you offer this income, it can be hard or it can be easy. And as I just said, the hardest thing to do, and if you think about this, is you tell someone, and there was a session on this earlier today on the leakage, the whole leakage thing. You tell us, if you want an annuity, what you're going to have to do is cash out of your plan and do it in a way that you're not going to have a big tax bill, and then take that to an insurer and use that to purchase an annuity. And you got to find the insurer on your own and do all these other kind of things. That's what we call the 1-0 imperative, the extensive margin. Do you want an annuity versus not? You've set a real high transactions cost bar and a high information cost bar. It's no surprise that overall annuitization for people in this range are around 5%, right? That you have to really, really want to do it. But as you can see, that some countries do a good job of making it easy to do, some people make it hard to do. And this is where the kind of a surprising finding from our most recent survey that we found is that you can see how high annuitization rate is in the mandatory countries, like TI used to be. It's like, well, it's 100% of the people are annuitizing. It's not if they're annuitizing, it's how they're doing it, right? Are you taking a single life annuity? Are you taking a joint life annuity? Do you have guarantee periods or refund features? Are you doing a fixed versus a variable annuity? People tend to think only in terms of a fixed annuity, but there's a huge variable annuity market in the United States as well, mostly in deferred annuities, but it still is an option and a lot of people use it. What I find is the interesting thing is what we call the integrated systems of Chile and Switzerland. These are countries where employers are required to offer an annuity as an option at retirement. And so what you see here is that you get the same kind of effect. Now, I told you that we're about 35%. When I think about people in TI who are doing this, if I look at people who are younger than the RMD age in some of our data that we would show, if you're below the RMD age, so that doesn't become an effective default for a lot of people, and anybody that's working in this, what you should really worry about these days is that some of our survey research would indicate that many retirees view the RMD as the right way to take money out of the plan, right? From an income perspective, not from a tax perspective. But RMD's tax policy is not retirement security policy. But if I look at people who are not eligible for RMDs, about 55% this past year of our retirees who were under RMD age had an annuity as their first distribution from us, as their first distribution. So it's very similar to this. So what are the key findings here? I'm jumping to the end of this, and you can get a lot more details in the paper. What we're going to argue is, and I think we're moving in this direction in the U.S., which I think is good, is we view the future as hybrid. And I know Mark EBRI was here later, and I wish he was still here because Mark was, I don't think he's here, I don't see him, but Mark and I have talked about a lot this over the ages. The old money purchase pension plan, that's the way you would think about it, right? They're still on the books, you can still offer them. Or the TI system, I would say, is the same as well, is you set up a plan with adequacy of contributions, a good investment menu, and the option to convert part of that income to an annuity in retirement. We're not saying full annuitization like they do in some of these economies, what people want to do. Integration is key, right? We think having in-plan guaranteed income options is key for everything. And then flexibility. I'm very suspicious of people that advocate, for example, for a default annuity in retirement because a lot of reasons. Number one is that it's not the same as a default investment on an investment menu because you have a 90-day rolling liquidity rule with that investment, as many of you know, right? Once I purchase the annuity, it's an irrevocable decision for the most part because either that or you won't have any insurance company that will offer that kind of service to you because it would completely ruin their own surplus measures. So what I'm going to finish on here is just a set of questions for you guys to think about. Many countries that are very, very generous have all these automatic mechanisms for adjusting things. I don't really think, again, my own view is this, is I don't think it really works for the U.S. I think what we need and what I would advocate for Another imperative for in-plan annuities, as we know Social Security reform is coming down the road, is to provide people with an effective hedge against any type of Social Security reform that might reduce their future benefit payments. And having that flexibility in there is it says, I've got this guaranteed income in my investment portfolio that I can pull the switch and convert to guaranteed income if I need to do it. I want to do that kind of hedge versus saying something like, oh, I'm just going to lose that guaranteed income and I'm just going to manage a portfolio of equity and bonds until I'm 95 or 100, however late I live. And one of the things that we find is a challenge for the U.S., again, and I kind of hit this as a theme, was that the U.S. retirement industry is very, very fragmented. Is that people generally consider Section 400 of the Internal Revenue Code to be the most complex thing and unfathomable. That's partly individual choice that I talked about earlier, that we value choices, and that also includes employers. Employers have a lot of choice on the type of plans that they can offer, but harmonization of rules across 401ks, 401as, 403bs, 457, all these IRAs, all these different kind of things, is something that's going to need to occur at some point to encourage that, all these millions of Americans will be able to continue to retire with dignity. And so I'll end it there and take any questions that you guys may have in the 33 seconds that I have left. Okay, 3 minutes. If any questions, I'm happy to answer it. It was either really good or really poor. I never know which one if there are no questions. All right, thanks very much.
So that was, I think, a great segue into the Social Security panel. A great group of folks we have up here. We do have the challenge of beating the mid-afternoon slump. I just saw David Blanchett yawn. It's going to be a challenge, but I think we can surmount it because Social Security is obviously the most exciting policy priority in Washington today, something that a lot of people can get behind. So look, my name's Emerson Sprick. I'm the Director of Retirement and Labor Policy at the Bipartisan Policy Center. For those of you who don't know what BPC is, we focus on policy at the intersection of good evidence-based policy and policy that at least has the possibility of getting bipartisan support. That's a challenge sometimes in today's Washington. Retirement security, though, tends to be an area in which we can make a lot of progress, as we've seen in recent years. So I want our panelists today to introduce themselves, and I want to spend most of the time hearing from them. But I thought to start out, I'd give just a quick overview of the state of play with Social Security today, and then I'll ask my panelists here to take it a step further and talk a little bit about why that matters to folks in the room. So the bottom line is that Social Security's primary trust fund is projected to become depleted in 2032, which, if Congress doesn't do anything, means that all beneficiaries get a 20 to 25% benefit cut. We have been tapping the trust fund that was built up over a few decades of the program's surpluses since 2021. And the annual deficits are now projected to continue for as long as SSA projects, as far as 75 years into the future. There are a lot of reasons that revenue can no longer meet the obligation of current benefits. A lot of reasons related to demographics, to economic changes. But the bottom line is that this is a real challenge that Congress is facing. And it's a different challenge than the one that Congress really effectively addressed the last time it passed a comprehensive reform plan in 1983, when it averted trust fund depletion that was just a few months away. The reason is the long-term shortfall is a lot bigger now, both in dollar amount and as a percentage of taxable income, taxable payroll, which is SSA's preferred metric here. It's a $25 trillion unfunded liability over the next 75 years. And since that gap has gotten so large, and the time we have to address it has gotten so short. We're now facing two problems, essentially. One is the long-term solvency of the program, and two is the short-term trust fund depletion. There is, in my mind, essentially no way that kind of balanced, responsible, politically feasible, to the extent that applies in this policy area, reform package could avert trust fund depletion. So something has to be done about the long term, and separately, in parallel, something has to be done about the short term. So, like I said, and we can start with Wendell. If you could just give a quick background of how you got to this policy area, and then talk a little bit about how you think about why this should be so important to private sector and industry stakeholders.
Well, thank you, Emerson. So for 18 years, I was the budget and health advisor to Speaker, sometimes Leader Nancy Pelosi, and I left the Hill when she stepped down as Speaker, and now I've been at the Brookings Institution for about 3 years. But very early in my career, I was a Ways and Means staffer in 1983. I worked for Dan Rostenkowski on the 1983 Social Security amendments, which have basically lasted for 50 years. And I also worked with a very young staffer to Tip O'Neill at that time, and you've probably heard of him, Jack Lew. That was my introduction to Social Security. I've written a detailed Social Security plan at Brookings, and I'm proud of it because I've gotten 20 former members, 10 Rs and 10 Ds, to basically say that's the place where Congress should start negotiating from. And I think Congress, we are not going to let the trust funds run out of money. I don't think any politician wants to go home and say, I screwed up, I couldn't work with the other party, and therefore you're taking a 23% cut in benefits. So it will get addressed. But it has to be addressed on a bipartisan basis. You cannot do Social Security reform through a reconciliation bill. So both parties have got to work together. And I don't think it's going to happen in this administration. I think it ought to happen in this administration, but I don't believe it will. And whoever we elect as president in 2028 is going to have to deal with this. And because the money is going to run out in the first term, I think that president will say we've got to do it in year one. And I think the way I would do it, I'm not a big fan of fiscal commissions. I would have that president follow George H.W. Bush and say, let's reduce the deficit, let's restore solvency to Social Security, and appoint the 3 money committees, Budget, Ways and Means, Finance, and Approps, and the leadership. So in the 1990 Budget Summit, which I was a staffer at, there was about 22 people, the leadership of the country, sitting around a table, and they basically came up with a $500 billion deficit reduction plan, which would be about $1.3 trillion in today's dollars. They have to do a lot more this next time around. But the point is, I think that's because the two parties are going to have to go over the cliff together, and there's got to be substantial presidential leadership. I'll stop there and
Okay, so I got into this area of research in graduate school. I was, John Chauvin was one of my advisors in grad school, and he's done a lot of work in this area, wrote a book about Social Security, and so he got me interested because it seems like an aging population, like it seemed to me back then that an aging population was one of the biggest policy challenges that we face as a society. And I was really intrigued by the intergenerational aspect, especially to Social Security, the fact that you've got newer generations effectively paying for the retirements of earlier generations, and that creates some interesting forms of redistribution. You know, I will. So why should this? Why is this problem important to the private sector? Well, I would say so. So first of all, Social Security is the biggest source of retirement income for most people. So what you expect to get from Social Security, that's going to influence decisions that you make in all the other areas of your retirement planning. It's going to influence the amount that you choose to put in a 401k. It's going to influence how you take money out of your other retirement wealth. So it's huge. It matters a lot for those other decisions. And I think the other reason that it matters, so I think Emerson was exactly right, that the problem that policymakers are dealing with today is much bigger than in 1983. But the other thing that's different is that the overall federal budget is in much worse shape. And I'll tell you my fear. My fear is that when the trust fund approaches depletion, policymakers there will be a bipartisan agreement to issue more debt, to continue to pay promised benefits without raising taxes. And that's my fear. And that has huge implications for everyone, because the question is going to be, are they going to be able to borrow that significant amount of money? How are bond markets going to react? Because that's then putting us at a risk of a financial crisis, which has huge implications for everyone who has any kind of savings or is trying to plan for retirement. So I'll stop there.
And I just want to add a small piece of context. That borrowing would, to start, amount to about $500 billion a year. And that would go up to $1 trillion a year by mid-century.
Well, hi, I'm Gene Sterling. I've had a long career. Wendell and I are, I think, about the same age, but we've certainly worked together for probably half a century almost. I've worked not just on Social Security, but on health care, like Medicare. I've worked on welfare reform. I've worked on particularly programs for children. We put out a What's Happening in the Children's Budget series at the Urban Institute for I don't know how long. I've been at the Urban Institute most of my career, and the Treasury for a significant part, also at the American Enterprise Institute and the Peterson Foundation and the Brookings Institution for short periods. And over that time, I've come to a conclusion that we have to start thinking about these issues together. And I will try over the course of our dialogue here to prove it to you with numbers. I have a book out that's called Abandoned, and the title of it may tell you how I think it summarizes a lot of our problems. It's how Republicans and Democrats deserted the working class, the young, and the American dream. And you might ask, why am I pulling Social Security into the issue of issues with the working class and the young? It's because if you look at the budget and you look at where it's going, almost all the growth, for some time real growth, certainly over 100% of the growth as a share of GDP, has gone basically to Social Security and healthcare for a long, long time. And what happens is it's squeezing everything else. And the big squeeze is on anything that's promoting upward mobility for the young and for particularly the working class. And I think this is reflected in our political problems. And I think the issues that surround us are big. They're big time. This is not 1983. It's a very different period. Dave already talked about this a bit. And it's not certainly 1940 or when benefits were first paid. And yet there's a lot of features of Social Security that still reflect that view of the world, including some that even reflect the fact that the typical family is a husband working, a wife at home with the children, and so we don't need to worry about how we organize it. So there's all sorts of issues we could get into. I have a handout here. Barbara, maybe you could have somebody distribute them. I'm not sure. You don't really need them for now, but and I've got my email contact on there. I've got my Substack contact. It's all free if you want. The book I've got, if you send me a note, I'll send you a free PDF copy. You don't have to buy it if you want to get that full story. So not to take too much time, I'll just start with one statistic that reflects my sense of how we have to pull all this together. If you look at the budget into the future, in another 10 years, you compare 2036 to 2026, under current law, we expect to raise about $1.5 trillion more in revenues. Those are real dollars. It's all, everything I'm going to say now is and of course of our time here is inflation adjusted. Of that 1.5 trillion, 1.5 trillion goes for increases in Social Security, increases in Medicare, and increases in interest cost, which are also due to the fact that we keep lowering taxes along the way. So those three programs alone, or those three areas, will absorb all the growth in real revenues that you could allocate for things we might want to decide for as a society. And that's putting not only the squeeze on everything else, but it's putting this horrible binder on Congress, because when you create permanent programs with permanent growth rates that can only be changed by getting a type of supermajority, both houses of Congress agreeing with the president, and the politicians say, oh, by the way, I don't mind reneging on a promise I made to you so I can do something else, you've got a real bind. And that's why I think you have to pull, and I'll say this in many other ways, why I think dealing with Social Security over here by itself, you just can't do it anymore. One time you could, you can't now. Thank you.
So appreciate that perspective and you know, getting us into kind of the principles of this. I think I want to start talking about, you know, how you all think about the principles of how to approach reform before getting into some of the details, and then placing this in the broader context of retirement security. Wendell, you know, you mentioned the plan that you recently published at Brookings. It is in many ways an updated version of the kinds of really responsible, balanced packages that have been put forward by think tanks for many years now. Can you talk about the kind of principles that you take into that, thinking about, you know, maybe even in contrast with what Jean said, thinking about how you view Social Security and policymaking around Social Security?
Well, I would begin by saying I think it's got to be a combination of both benefit reductions, no benefit reductions for those currently on the rolls, but benefit reductions for future retirees, and also tax increases. I mean, the tax increases I would most do is raise the taxable max. I mean, all of this needs to be phased in over a period of years, but basically I would double it. I would not take it off, because I think there's many other priorities that we need to fund out of the general revenues. I would not do any general revenue borrowing if I could. I think it's got to be a combination of tax increases and benefit reductions. And we just talked about longevity. One of the factoids I'd like to have you think about for a moment is, if you looked at males born in 1960, this comes from the chief actuary, by definition they turn 62 in 2022. If you're in the bottom quintile of male earners, you live 15 years on average beyond 62. I mean, life expectancy on average. If you're in the top quintile of male earners, you live 25 years more, a 10.3 difference in longevity between bottom quintile and top. That difference for females is about 6 years. So one of the things I do not want to raise the retirement age across the board. I primarily, again, over time, I raise the retirement age at the top and don't at the bottom. I mean, in 1983, we did a 2-year increase in age from 65 to 67. It was phased in over a long period of time. But this time, I would just raise retirement age at the top. I would also increase the number of years in the formula, et cetera. So my point is, it's got to be both benefit reductions and tax increases, and the two parties have got to work together.
Sita, how are you thinking about kind of the best path forward in terms of, you know, starting with principles that members of Congress should be keeping in mind?
Yeah, I mean, I think what Wendell describes is probably the most realistic sort of politically feasible option going forward, is some combination of benefit reductions and tax increases. But I want to address a little bit more the big picture. So I think it's important that we have a public big conversation like about the big picture. So what is Social Security for? Right, so Social Security sometimes gets framed as earned benefits, right? I earned those benefits, I paid in their benefits that I earned. That's not really accurate. Benefits do go up with earnings, but there's a lot of redistribution in the program. The monthly benefit formula is progressive. Family benefits also create lots of redistribution. And maybe most importantly, there's redistribution across generations, where current and past generations combined have paid in far less than they've received, or they're slated to receive. So if there's going to be redistribution in the program, if it's not going to be just an accounts-based program where you get out what you put in plus a rate of return, then we should approach reform by really thinking about and talking about what the redistributive goals of Social Security are. I think a lot of people would actually be surprised by the amount of redistribution there is in the current program. Now, I have personally argued, and would probably still argue, that the main redistributive goal of Social Security should be protection against poverty, right? And in the past, Social Security has been enormously successful at reducing poverty among older people. And I have argued in the past that a flat benefit set at some multiple of the poverty line could virtually eliminate poverty among older people. But that would mean benefit reductions for higher and even middle earners. Now, other people may disagree or have a different vision for what Social Security should look like, and that's okay. But I do think it's really important that we talk about what these alternative visions are, and just be really explicit about what kind of redistribution we think should be happening within the Social Security program.
That redistribution aspect is really important, and it's been built into the fabric of Social Security, obviously. I like to point to these two principles that are somewhat in tension with each other, that Dave Richardson mentioned in his presentation. One is social adequacy, this redistributive aspect and poverty protection aspect, and the other is individual equity, and that is the idea that the amount of benefit, the monthly benefit that you receive in retirement, is closely related to the amount that you paid into the program throughout your career, i.e., your earnings throughout your career. Obviously, it's not a one-to-one relationship. It's not the same as you put money into an investment account and you get out that plus interest. But the rough balance of those principles, I think, has been really quite important in maintaining the nearly universal support that Social Security receives as a federal program. And so, Jean, I think, as you're talking about the way things have changed since this program was created in 1935, how are you thinking about a rebalancing of those priorities, and if there's a risk, either politically or in terms of policy outcomes, in weighting one more than the other?
So when I think of reforms that have worked, and I can't think of very many that have happened over time, I mean, where it start out good, is you have sort of top-down type of ideas where you really want to go. What are your principal objectives? And you have bottom-up, all the things you have to do it efficiently and fairly. So I'm going to call bottom-up here, which has already been mentioned. Actually, Dave mentioned one of them, Sita mentioned one, is sort of equal treatment of equals, horizontal equity, equal justice, whatever you want to call it. There's a lot of examples I can give you about a Social Security totally violates that. One great example is the spousal and survivor benefit, where if you're single, you pay for it and you can't get a single dime. That's not exactly fair. And the big losers, by the way, are single women with children. They're the biggest losers in that whole spousal survivor part of the system. It doesn't make sense. And I think my colleagues would actually agree with me on this. In fact, I agree with most of the things that Sita and Woodall have said. So those are sort of the bottom-up type things. Top-down, I still get to the question of what are we after? I agree with Sita on this issue, and I wrote a piece with Karen Smith, which we called First Things First. Well, let's at a minimum create what we called a wage-indexed minimum poverty level that was wage-indexed, so at least grew as average incomes in the economy grew. I don't think we can keep wage-indexing the whole system because it's way out of balance. And on top of that, it's not only way out of balance with wage indexing and more years of retirement and everything else. It has been scheduled ever since its beginning to grow on a per capita basis faster than per capita income. And so now we have statistics, which I run from CBO, which says that if you ask who are in the bottom 20% of the income distribution, it turns out your probability of being there if you're elderly being defined by being over age 65, you have an 11% probability. If you're a family with children, not excluding the elderly ones, your probability of being in that bottom group is 25%. And if you're in a family without children but non-elderly, your probability in there is 18%. So what has happened in terms of this enormous shift in the problems we had in 1940 when the elderly were by far the poorest part of the population today, where by some measures they're now the richest part, is that we've got a dilemma because Social Security and Medicare, and I'll get to this in a minute, but Social Security and Medicare are all pay-as-you-go systems. So we could talk about wage replacement and Social Security, but it's a pay-as-you-go system. Your money went out to pay for your parents. And I can't determine just from that how much you should be entitled to get from your kids. And if you want to think about it, think about the birth rate falling to zero and everybody being over 65. How much are the people under 65 going to be able to contribute for that population? Well, hardly anything. Well, when the birth rate falls from 4 to 1 down towards about 2.5 to 1 and maybe towards 2 to 1, you've got an enormous shift going on. And you not only have to figure out replacement wages with respect to what you want to give people relative to before tax income, but their after-tax income, because all of a sudden, if you have to have the non-elderly contributing a 40% replacement wage to the elderly, well, then they'd each have to contribute at 2 to 1, they'd have to contribute 20% of their income. And now add in Medicare. Now all of a sudden the replacement rate isn't 40% or 30% or whatever it comes out, it's doubles that because Medicare is now, in terms of lifetime benefits, equally expensive, provides as much as does Social Security. So now maybe the replacement rate, if you count that, is 60 or 80%. Now if I require the non-elderly to keep it there, and let's take the exaggerated case, this is beyond where we're at, but if it goes to 80%, and the non-elderly have to contribute 40%, well, they've only got 60% left, replacing the 80% for the elderly. And so you've got this enormous shift you have to take care of. And I don't see how you can solve the Social Security problem until we can come to some agreement is in aggregate. We can discuss how you distribute it later, but in aggregate, how much do you want to shift from younger populations to older populations that are now richer? If you can't decide that big issue, and that includes Medicare, it includes SSI and everything else, you can't decide that, I can't get the numbers to work.
To put some specific numbers to what Gene was saying, the maximum benefit that someone can receive right now from Social Security in 2026, a worker can receive is north of $62,000 a year. If there's a worker who earns the taxable maximum for 35 years of their career, which in 2026 is about $185,000, folks who have had the capacity to save throughout their career, that person will receive $62,000 per year this year in Social Security benefits. And if they have a spouse who've never worked, that household will receive north of $93,000 per year from Social Security. I think that prompts very reasonable questions about whether benefits, particularly for higher earners, should be recalibrated somewhat. Sita, I know you mentioned much flatter benefits, potentially even a flat benefit. Do you want to add anything there?
So yeah, I mean, you talk about these high levels of benefits that people earning the taxable max can get, and yeah, moving to a flatter benefit would reduce those benefits that these tax max earners would receive.
Yeah.
Yeah.
Wendell, how are you thinking about that? Potential recalibration, whether that's an attractive design feature.
Well, I guess I think the Social Security program, along with the employer savings plans that you are all invested in, that's the right mix. I don't think we should be changing our wage replacement program. I mean, it's a lower wage replacement for higher workers as opposed to low wage workers. So, and if you go to a flatter benefit, and I know some of my colleagues are talking about that, then how do you justify a 12.4% tax all the way up to 186,000? So there's a balance here between taxes paid and benefits received. And I think clearly Social Security needs to be tweaked, and I'd urge you to go to the Brookings website and look under my name, and you can. So I think we can keep our current system, the current benefit structure. It's got to be tweaked. Like I said, we got to raise the retirement age, we got to raise taxable max and do some things. But with those changes, I think we can make Social Security solvent. And because if we go to a flatter benefit, then I think the employer system is going to have to do more. And I question whether that's right. I mean, I think we've got, our system is working pretty well right now. It needs tweaking, but it doesn't need fundamental change. The elderly poverty rate, once you adjust for the underreporting in the Census Bureau, et cetera, is only 6%. You can take that down to around 1% by making some changes to the SSI program and by lowering Medicare premiums for low-income elderly. I mean, right now, for someone at 150% of poverty, we are demanding almost $3,000 next year in Medicare premiums. Under the ACA, with the premiums extended, we didn't, the premium level for a low-income person in the marketplace at 150% of poverty is 0. So if you just did a few things by lowering Medicare premiums at the bottom and restructuring SSI just a little bit, you can lower the poverty rate all the way down to 1%. And I don't want to change Social Security to make it more poverty focused.
Okay, I'll channel some of what Gene said to maybe challenge you a little bit. Is the right approach here getting the senior poverty rate down from 6% to 1%, rather than getting the youth poverty rate down from, Gene, what, 15% to 11%?
My measure wasn't really the poverty rate, it was who's in the bottom quintile.
Got it.
Yeah, I mean, I think we can solve child poverty by doing something about the child tax credit, et cetera, et cetera. So, but my point is, I don't think we should be changing Social Security to make it more poverty focused. I think we can do that outside the system. I think the current system is working pretty well. And if you make big changes in the structure of Social Security, it's going to have implications for employer savings programs, et cetera. So I think the current mix is right, and we've got to tweak it, and the two parties are going to have to work together to get that done.
This is what I like to see. Gene and Sita both excited to jump in and start arguing. We've got 13 minutes and 41 seconds to argue, and I'm really looking forward to this. Sita, I want to go to you first, and then Gene, I'll definitely give you time to respond.
Sure, I would concur that yes, the employer system would then have to do more, right? People, these higher earners who have their benefits reduced will have to do more saving on their own. And this is why there needs to be like a phase-in period where you're not reducing benefits for people who are currently receiving them or even close to receiving them. But yeah, these higher earners would then have to save more via the employer system. And I would argue that is the appropriate place to have an earnings-related benefit, because you're putting in a proportion of your earnings and then getting out what you put in plus a return. Right? So yeah, I guess I am advocating a more radical change. Although there are gradual versions of this, right? You can just flatten the benefit a little bit without going to a completely flat benefit. Yeah.
Actually, I think the three of us are actually pretty much agreed that we want to do a fair amount on the poverty level, but it's not actually that expensive to do. You know, we may have some disagreement whether you do it in Social Security or SSI. My problem with doing it in Supplemental Security Income, which is a welfare-based program, you got to go in and measure it. Social workers don't like to do it. That was part of the reason that actually Franklin Roosevelt wanted to adopt Social Security in the first place, is he didn't want to have all these state-level income-tested programs. And in the history of Social Security, we've never solved poverty for the people that really aren't on Social Security, which are more likely to be women than men. We never solved that. So I have some problems relying on these other systems. But that's mainly a question of who finances it. Do you finance the general revenues, or do you finance out of a Social Security tax? It's not the objective. I think on the objective, the three of us are agreed. We need to do a lot to solve that problem, and it really doesn't, in the grand scheme of things, cost that much. The big increases in cost are the wage indexing of the system over time for everybody, the increase in the number of years of retirement, which doesn't make a lot of difference 1-2 years, makes a lot of difference when you go out 75 years. In fact, just the failure to index for longevity in the system, at least at one point, a few years ago when I talked to Steve Goss, the chief actuary, if you just simply index so people had the same number of years in retirement, you solved half of the shortfall in the 75th year. Not in all the years till you get there. So it's a big issue long term to do that. But let me give you another statistic here, and then I'll stop again. Is if I look at lifetime benefits, Social Security and Medicare, right now I've done these numbers for years. It's about $1.3 million in 2026 dollars. About $1.3 million goes to a couple that retired, average income couple that retired in 2020. That's double the amount that was given to the average income couple that retired in the late 70s. That number doubles again from 1.3 to about 2.6 million for late millennials. And that number goes up again for 50, 60, 70% for the youngest of my grandchildren, who are promised under the current system about $4 to $5 million in Social Security and Medicare benefits. Lifetime benefits, that's 2% discounted rate is what you need a bank earning 2% real to be able to pay the bill. That's creates all the problems in the system. I don't know how much we can do for the people above a minimum in Social Security until I can figure out what's left over. Because if I don't have any money to pay for all the programs for the non-elderly, and I've got to put all this money into health care, and I don't solve those problems at the same time, I don't know how to reach agreement with Window and CETA on how much we can provide for everybody above some minimum. I say, first things first, let's do what we really need to do, at least deal with the poverty issue. Yes, I want to provide some replacement wage above that. I agree to that, but I can't get there until I decide I'm going to cut out a lot of this automatic growth in the system so that over time I can build in the possibilities for needs in the population that I think are more important.
I'll agree with Gene on one thing, and that is our health system does need more reforming than I think our wage replacement and Social Security and SSI, et cetera. I mean, our healthcare costs, and the thing I'm most proud of when I talked to the speaker was we got negotiation done. Democrats have been trying to do that for a long time, and we got it done in 2021, and it's worked. But we have a long further to go. But I disagree. I mean, I think the proof is in the pudding. I mean, I've written a plan, and I've gotten 20 former members to say it's the right place, and it does solve the Social Security problem. I mean, it's going to make the elderly, the high-income people wait longer to get retired if they want full benefits, et cetera. So there are changes that are made, again, both on the benefit side and on the tax side. And, we can get there, I think. But I agree with Gene. We've got a lot further to go on how to resolve our Medicare, the cost of health in this country. So the proof is in the pudding. You can go look at the plan, et cetera, and I think that's the place to start.
So look at Wendell's plan, look at Gene's blog, and look on SSRN for CETA's work. Yeah. So I've got a ton of questions. I could keep going for the remaining time, but I wanted to stop and see if anyone in the audience had any questions for the panelists, because we're here for you. Yeah, please.
So one thing that's been mentioned is the notion of either eliminating or increasing the current income cap, particularly at higher levels of income. I don't know if this would raise the concern that types of income might then be incentivized to be shifted. Would be curious as to what people think about better integrating capital gains, for example, as a funding mechanism into Social Security.
I don't think that's a wise idea. I mean, I think it's we have a payroll tax on wages. I believe in progressive taxation, but I think there's things outside, and to me there is some lid we got to worry about in terms of how much income we provide to elderly, and that's why I have benefit reductions in the plan that I've written, et cetera. So, but I don't want to go to other forms of taxation. I mean, we have a lot of problems in this country. I mean, this year, I'll agree with Sita, $1.9 trillion is what CBO is estimating the deficit is in this year. And that has got to be tackled with, and we can change capital gains rate to take care of general revenue problems, not the Social Security problem.
I mean, the question I always have about those kinds of tax increases is, would they be linked to benefits? Because that's always under the current system, you pay tax on income up to the tax max, and then that's what gets counted to determine your benefits, right? So there is, this link, right? Even though there's lots of redistribution in addition to that. So my question would always be, if you're going to raise the tax max, do you then also raise the amount that gets put into determining benefits? If you start taxing capital gains, would that again go into your benefit calculation? So I'm not any plan that improves Social Security's finances, I think I'd sign off on, but I think that would be my concern about those types of things.
My simple answer is that in my ideal, a fiscal commission would deal with all these issues together, and then you can do a lot of things maybe you should do on the tax side, or you think you should do, whatever they are, in terms of what the overall system, and let it go into general revenues, and you solve the problem that way. I think I don't really have that much to disagree with either our colleagues. The issue I have not with what Lyndall does, which is sort of bottom up, how we're going to add everything to get it to reach something, is I see this as a triage problem. And he's saying, I've got this patient, I know it's got these problems, and it's a big patient, I'm really going to take care of them, but we haven't fully diagnosed what the full objective we want for that patient, and we haven't dealt with how we have to triage all the other parts of the system that are failing. So the more we can pull together and discuss at the same time, we can make a lot of trade-offs. Give you what other trade-off you could make. I keep talking about Social Security and Medicare. If you don't do them together, then you don't know how much money you need in Social Security to help people who are going to go on long-term care, which is also one of the big issues in healthcare. Similarly, you got the opposite problem in long-term care. You don't really know how much to do in long-term care support if you don't know how much money you're going to give to people in Social Security. So the more, it's like cash. Cash was money was one of the great inventions of society because it allowed you to make trade-offs on anything you purchase. So the wider we can make the trade-off considerations, the more we could bring in the types of questions you raise, but without forcing each thing into each little cubbyhole.
So I want to add a couple thoughts, because this is something we've been thinking about a lot at BPC recently. There are a couple concerns with continuing to rely or increasing our reliance on the payroll tax from our perspective. One is that raising the tax max, while almost certainly a good idea, represents a huge marginal tax rate increase on what many people would consider upper middle income households, right? This is, folks making $200,000 to $250,000 a year. Now, you can say what you want about that being upper middle class, but that's a huge 12.4% marginal tax rate increase on a very small subset of houses. The other thing is that payroll taxes are, by definition, create incentives to not hire workers. And at a time where we are, I think, increasingly concerned, or at least keeping an eye on labor market dynamics in terms of AI and reduced dependence on people to do work, that's a real concern. And so, we're thinking about this, whether it's redirecting NIT proceeds or levying, Social Security payroll taxes on pass-through income, or treating all forms of compensation the same by levying payroll taxes on fringe benefits and health insurance. There are a lot of options like that here. But what Sita said is really important. It's, I think, politically going to be very important to be able to tell a story that ties those revenues directly to Social Security.
So when people register for the symposium, both in person and online, we ask them, what topics are you most interested in hearing about? These two panels for this last part of the day were the ones that got the most votes, actually, or the most comments. So I know they're really hot topics, and we're very excited. So I'm going to introduce the panel on enabling the executive order on alternative assets for 401k plans. 401k investors, we have a great panel, so I'm going to turn it over to Bob.
I got it. Thank you. Thank you, Barbara. So before we get going, I'm going to ask each of the panelists to provide just a brief 30-second, 60-second bio. Oliver, we'll start with you.
Okay. Hi, everyone. Great to be here. I'm Oliver Albers. I'm the Chief Product Officer at NASDAQ. And I told the panel I'm going to take a little longer because many of you are probably wondering, like, why is NASDAQ here for this panel? And I started NASDAQ 25 years ago when we were just a U.S. stock exchange. And since then, we've evolved into a global technology company. And, our history is based on, public markets and helping private companies raise capital. But we've also expanded our offering and helping to make private markets more effective and more efficient. And so we're doing a lot on that front that, I think is really exciting as we've seen the recent executive order and just the evolution of private markets being more widespread and democratized. We see a real opportunity around maintaining or improving transparency, liquidity, and integrity across the ecosystem. So with that, I'll turn it over to my next. That was under 60, wasn't it? Huh? It was under 60? Okay.
Thanks. Drew Carrington. Great to be back here and hanging out with everybody again. This is a super fun topic for us at iCapital. iCapital, our business is primarily enabling access for individual investors in private markets. That's been what we've been doing for 13 years. I've been there for all of about 10 months after over 20 years in the institutional defined contribution space. And moving, one of the really interesting things for me has been going from a sort of traditional asset management manufacturing operation into a fintech, where it's all about access and platforms and really kind of thinking through the kinds of questions that we're going to have to answer in the DC space as we look to expand access to private markets for 401k participants.
Chris?
Great. Hopefully this is on. There you go. So my name is Chris Cedar. I've been at Goldman for a little over 20 years. Most of that was actually on a plan sponsor side, so I kind of have a different point of view there, but I spend most of my time as a retirement strategist really thinking through, I would say, I didn't necessarily expect to be thinking through private markets as much as we are today, but spending a lot of time in this space really understanding sort of the ins and outs and the mechanics around how these strategies can work within DC plans, so happy to be here.
So I'm going to try and wrap up with about 5 minutes left so that you all have time for questions and maybe ask the things that we didn't get a chance to ask here. And today we're not here necessarily to debate whether the executive order is a good policy or not. We're here to talk about how the industry is coming together to actually implement the EO. The EO was signed in August of 2025. EPSA has new leadership, and the Retirement Investment Choice Act was introduced just last month. So how does implementation, how does the runway realistically look at this point? Jump ball.
So I think this is an interesting question because on some level, private markets have been in DC plans for actually quite some time. So private real estate has been in target date funds for a long time. There's a number of large market asset managers who have even private equity, private credit in certain funds. So some of this is not necessarily new to the industry. I think what's new is that what we're getting from the Department of Labor and where a lot of the focus is really trying to clarify the rules as it relates to 401k specifically, and really understanding some of the mechanics and how those rules apply in this particular situation. So, I think what we are really kind of focusing on with this new rule that can come out is how does it really apply to the different asset classes? And while I think we're generally looking for something that's a bit more asset neutral, I think the question is, is there really guidance that helps kind of put some finer points on some of the nuances that it relates to these asset classes? But, by and large, ERISA does allow the analysis of these types of strategies. We have seen that in terms of sort of like what does the runway look like. This is the retirement industry. So it's not, I think we measure things in, I can joke and say we measure things in decades, but I'd like to say we measure things in years versus quarters. So we're kind of steady to go as they go, but we're sort of in the early innings of seeing how this plays out.
We measure things in ages as like the Cretaceous age, I think a couple of things about the runway. One that I just want to mention is there's a lot going on in the background right now. Industry's kind of really getting ready to deliver on this promise. And one of the specific things I would say is that a number of changes that have happened over the last several years in the private markets more generally, we're all seeing the headlines on this right now, are making private market assets available to individual investors, and that meant building new kinds of structures. Those structures are part of what are going to sit inside vehicles, DC-friendly vehicles. So I know that's going to raise a bunch of other questions, which I'm sure we're going to get to, but that sort of operational skill that the industry has had to build, the private markets industry has had to build, will be relevant as we get into the putting these into 401k plans.
Yeah, and just from my standpoint, it just never moves as fast as you think it would. Certainly from a regulatory standpoint, whenever there's legislation or regulation involved, it always takes longer. The interesting thing for me, though, is just how kind of slow private markets have evolved from a technology perspective as well. Like our CEO left for a while, went to Carlisle to be the CFO, took them public, and she came back and she's like, wow, private markets are ripe for change. Like, everything's done in Excel, in PDF, in Outlook. And here we are, 15 years later, and everything's still kind of done in PDF, Excel, and Outlook. But I think with some of the democratization we're seeing, the executive order, we'll start seeing more and more platforms and technology solutions come to market to really ease the frictions between investors, both on the institutional LP and GP side, but also when we're thinking about individual engagement, we'll continue to see improvements there.
We have AI now, too.
Yeah, let's not even go there yet.
All right, so the EO puts it plainly, fiduciaries must carefully vet manager capabilities, experience, and effectiveness with alts, and that's a high bar. Vanguard Research recently showed that return dispersion between top and bottom quartile private equity managers is around 13 percentage points versus 4 for large cap public equity. Most plan sponsors don't have private markets expertise in-house. How is the industry organizing itself to give fiduciaries what they need to meet that standard?
Yeah, so I'll start on that. Look, I think that the industry's done a lot in helping defined contribution fiduciaries, plan sponsors, make decisions about new kinds of structures for decades. Think about even the rise of target date funds. When target date funds first came out and were blessed as the qualified default investment alternative, we didn't know how to benchmark those. We didn't know how to compare them to each other. Like really even, all right, how do we think about this? How do they work? And, the industry figured it out, right? We came up with benchmarks, universes, indexes, ways to evaluate target date fund providers. So we're going to see something similar there. I think one thing, I would say everybody focuses on, when we talk about private market assets, everybody focuses on private equity, at least until the last month. The focus on private equity because that's the really sexy one. That's where, the numbers are really big. That's where you get the 13% dispersion between top and bottom quartile. Other asset classes, private real estate, it's not 13 percentage points difference between top and bottom quartile. Infrastructure, it's large, but it's not that large. So we're going to see, part of the answer here is think about multiple asset classes. Part of the answer here is manager diversification. If anything, what's going on right now is we're getting a real-time lesson in the value of manager diversification. So I think we're going to see products evolve that are multi-manager, solutions, either multi-manager, multi-asset, or even multi-manager across a single asset category. And then I think collectively the industry is organizing around providing resources to plan sponsors to help them with these solutions. And whether those resources are OCIO kinds of, outsourced or delegated solutions. You think about MEPs and PEPs. We've got a question later about the Australian design, to the extent that MEPs and PEPs are kind of the US version of Australian superannuation funds. That's another way to incorporate these. So I think that there are going to be solutions. We're not going to just pitch fiduciaries into the deep end and like, oh, good luck picking these managers in a space you've never seen before. The industry knows that we have to meet people where they are and provide them with insight and resources.
Yeah, and I guess what I would add is, I think ERISA already gets this issue, right? A lot of plan sponsors don't necessarily have the expertise. I sat with a committee for quite some time, and evaluating emerging market debt managers is not necessarily the easiest task, right? So what do? We hire investment consultants, we hire expertise, we delegate that level of service, and I think that this is not going to be any different. I would say, obviously, there's some nuances here, like the investment process in the private markets is different than the investment process that you generally see in the public markets. But delegated experts is one of the areas that I think we're going to continue to see, growth in that particular area. But the other area, and this kind of Drew was alluding to this a little bit, which is co-manufactured products. This is sort of a trend that I haven't seen in so many years. Looking at these strategies, obviously you're seeing a lot of partnerships being developed because what that does is that gives managers to kind of bring a best of both of their capabilities with other capabilities and craft solutions like these target date funds that are now blending private and public markets. Like those are making it easier for plan sponsors to sort of pick something that quote unquote is off the shelf, but it's run by a professional manager. There's governance of that asset allocator, and it has really all sort of the structure that you want to know that someone is at the helm who understands these asset classes and can basically construct a portfolio responsibly. And that's really what we want to see the industry evolve to, is responsible allocation of these strategies, not necessarily something where you might see a standalone investment on a plan itself, where an individual is trying to allocate towards private equity. Like that's not necessarily the philosophy. So it's really around these professionally allocated solutions and thinking about where, what I would say an asset allocator or a delegator is in the mix who is very familiar with these strategies.
Well, the other thing that I'll add here is, we're talking about 401k investors here, but you think about kind of the blending of public and private. You've seen a lot of even ETF wrappers have some component of private markets in them, and a lot of partnerships coming to market there. But when you think about like the educational aspect, it really is about putting the right tools and the right data in the hands of the consultants and making it in their existing workflows and making it really easy to communicate with the fiduciaries around what they're investing in, why they should invest in it, how it stacks up. Having a clear audit trail for them as well is hugely important. So, we've built this out through our NASDAQ investment platform on the institutional ecosystem on the public side. And it's just a natural extension of that business to continue to expand into private markets and kind of facilitate that transparency around, manager search, manager diligence, benchmarking, et cetera. And, I think that's an area where a lot of data providers are focused right now as well, is just there are no standardized benchmarks for private markets right now, and there are a lot of different providers out there, and working to make sure we have some consistency and depth in terms of high-level benchmarks, in terms of how the overall asset level in private markets is performing, but all the way down to deal as well, so people can get granular and develop more customized benchmarks as well. We see a large opportunity there.
So just to follow up, do you see the need for the benchmarks coming before the assets are introduced?
Yeah, often yes, and it's also like from a GP perspective, understanding how they position themselves in the market, but yes, before they're produced and having the LP or the advisor or plan sponsor have a clear understanding of what should they expect to get out of this wrapper, out of this sleeve, and making sure that it's what does good actually look like, and are they getting good, are they getting great, or are they getting poor?
Yeah, I was going to say on the benchmark question, going back to the target date introduction, plans adopted target date funds really before we had a lot of benchmarking or universe comparisons. A lot of the products that rolled out early, you know, in the aughts, were they were new. They didn't have the the long track records. We didn't have a lot of comparisons, but they were the right answer, and so people did it anyway. And then we worked our way around. Okay, now how do we evaluate this on an ongoing basis? A big part of that is to your earlier point, is about process and documentation. So you can incorporate these asset classes as long as you have process and documentation, maybe even before you have benchmarks.
You're good, Chris? All right. So my understanding is that there are at least 3 ways to deliver this into a 401k: embed the assets in a default target date fund, offer them through a managed account, or through a standalone option. And so how do you see the industry landing first? Does the right answer differ by plan size and workforce type?
Chime in. So it's an interesting question about which is first, because I don't necessarily know which one will be first. They're actually already firsts out there, right? We've already kind of talked about target dates that have already been using some of these private markets, particularly real estate, for some time. But you're actually seeing quite a bit of progress on all 3 of those channels. So like if I think of the target date fund providers, obviously we know that there's a handful of them that are out there that are building products today that will be in the market in the near future. Managed accounts and advisory managed accounts, Empower's here. I'm surprised they haven't talked about this, but they are also been leading in terms of how to actually bring private markets through managed accounts. So that's another really big area, and that's leading the charge in many cases with a lot of the advisor firms where they already have sophistication in terms of what they're allocating to high net worth clients. They're seeing this as basically an extension, and the managed account provides them a way of providing a similar level of advice, but in a very scalable way to the broad-based population. So can they bring in some of this portfolio sophistication that they're already doing in another part of their business? The standalone options, again, we're having a lot more conversations there with much larger plans. So like if you have a large global equity fund within your portfolio, the question is, does private equity fit somewhere in there? Like if you have a large, white labeled fund that is a core bond strategy, we've done core bond, we've done core plus. This is almost like an angle of, core plus within that context. So does private credit become core plus within there? So really, depending upon where you sit in the market, those 3 channels really are getting a lot of attention, or at least there are analysis and discussions being had about how do these options work in these contexts. A lot of the questions, as Drew mentioned, which is around some of the new vehicles. So whether these evergreen vehicles or different drawdown vehicles, how do they work in the different situations? And just there's a lot of being figured out right now. And so it's sort of an interesting time to be in that product development cycle. But for me, it's really all 3 that I would say are getting traction. They're just kind of getting traction from different audiences.
Yeah, and I think that's exactly right on the all 3. Just so we're clear about standalone, there's very little discussion about just putting private equity directly on a menu where a participant can choose it. So when we talk about standalone, we mean inside an already diversified multi-manager option, like a global equity option, or global credit, core plus, plus. So that's the first thing. Having said that,
Good clarification. I agree with that.
Yeah. Having said that, there is one plan out there, and I'm not giving away any secret sauce here. Diana Wojnowski, when she was at International Paper, actually added a private real estate option directly on the International Paper menu, but with some very interesting guardrails. So there were limits in terms of what a participant could allocate. There were limits once that portion of a participant's account got large. They were capped out. They couldn't add additional assets to it. But it was also incorporated in their managed account option. I mentioned that one because they won an award for that, but 2 because I thought that was really refreshingly honest to say, like, yeah, we're going to put it on the menu and we're going to put limits on it. Because one thing that happens a lot of times is people say, like, well, if we had a standalone option like private equity on a menu, then what about that one participant who puts 100% of their assets in the private equity option? Okay, well, just put a limit on it. You can't do that. Like, we have the ability to do those kinds of things in the 401k system. We don't like to admit it, but, think about company stock, right? We've had limits on company stock now for, 25, 30 years. You go back to was talking about this at lunch. Go back to WorldCom and Enron. Post WorldCom and Enron, company stock in 401k plans, people put limits on it. We could do that again. There isn't anything in the regulation or legislation that says you can't do that. So be open to those kinds of solutions. The other thing I wanted to mention about target date funds and those as the solution, just very briefly. There is a sort of immediate kind of reflexive tendency to say, well, all the money goes into target date funds, so why would you do anything else? And I want to kind of highlight a couple of things. One is while a lot of participants direct their assets into their contributions into target date funds, one thing that's very clear is actually in the Fidelity report that came out we saw earlier this morning. As participants get older, they're less likely to hold 100% of their assets in a target date fund. And in fact, it's linear. In the latest report that they showed, it goes from 90% of participants in their 20s own a single target date fund, and it's below 50% by the time you get to people in their 50s, and then in the 60s and 70s, it goes down even further. The other important thing about that is people in their 50s and 60s, no secret here, we talked about this earlier today as well, people in their 50s and 60s have bigger balances. So while more participants are in target date funds, more dollars are exiting target date funds on the other side, not fully. It just means they're putting their hands on the wheel. We can argue whether or not that's a good idea, but they are. So, and those tend to be larger balance accounts, people with more complicated financial situations, people for whom personalization solutions might make sense. That's why the AMA design, I think, is also useful.
I was going to say target date funds, but I think you just kind of talked me out of it a little bit.
That's fair.
Sorry.
That's okay. So
sorry.
So the executive order names private equity, private debt, real estate, and infrastructure. These all have very different liquidity profiles, fee structures, complexity levels. Which of these do you expect to be the first in, or is it all in?
Yeah, I think from my perspective, if you think of kind of like where this is, like back to the implementation options, which is in these target date funds, which are generally intended to be these diversified asset allocation funds. For that reason, you're really kind of seeing all three of them. So you're looking at basically the role of private equity, which is more growth-oriented, private credit, it's just going to give you more income, and then infrastructure in particular is going to give you more inflation protection. So kind of for me, what we're really seeing is sort of the blend of these asset classes kind of being introduced into these, again, glide path oriented funds. Because I think if you picked one particular fund, you said, okay, maybe let's do inflation. You might look for, if you did an inflation 2.0 fund, you might go, infrastructure, for example. But again, that's not really where sort of the prevailing idea is for some of these initial funds. So you're looking at really what's the best way to enhance a diversified portfolio that kind of includes all three, but it really just includes all three over a glide path. And so that's really, I would say, where the focus is what's the right structure around kind of blending them through someone's, whole savings career.
I mean, from my side, I was thinking private equity just around, the return profile, but also just, the familiar. I think it's easier for many investors to understand, and just as more and more companies are staying private longer, like investors are, very quick to, and there's a lot of demand for access to a lot of the unicorn companies that are out there. We're looking at some of the largest IPOs coming to market over the next few years that we've ever seen, in the history of the world, the largest. And so, I do think that will drive a lot of like end user demand for private equity. But I don't know if you have any thought.
Just one thing where I would say, look, those of you that have heard me talk about this before, it's a little bit of a broken record, but the right answer here is going to be diversified modest allocations to diversified portfolios of private market asset classes and professionally managed solutions. That is the right answer. That is how we're going to deliver better outcomes for participants. And what that portfolio looks like is probably different for a 25-year-old and a 55-year-old. And in particular, So again, going back to some of the earlier comments about sort of how streamlined menus have gotten, we've cut down the number of investment options. Where that's really shown up is the inability of older participants to diversify their portfolio as they're de-risking on the core menu. Because we have lots and lots of equity options on 401k menus, and typically we have cash and bonds. Like, that's kind of it. And that is one of the reasons why diversifying asset classes like real estate, which is already there, or infrastructure or private credit, which are de-risking asset classes, low correlated de-risking asset classes for first principles reasons, not because we're volatility laundering with the NAVs, but for first principles reasons, are different asset classes than what's on offer today. Those move the efficient frontier to the northwest.
Yeah, and I mean, just to that point around efficient frontier, we talk about this a lot. When we look at basically diversified portfolio and when we've modeled portfolios that are the traditional target date funds today with an allocation towards private markets, it does shift that efficient frontier. So again, if I kind of put my former plan sponsor hat on, to me that is a very important data point to understand whether or not we're making sort of the right fiduciary decision and looking at sort of that, the net effect of that risk return portfolio. So something that's really important is to really look at whether that efficient frontier is really improved.
All right, so the questions get a little bit stickier and thornier as we go on here. So EBRI research shows that workers average 10 jobs before age 45. Everyone here qualify for that? Anyone have 10 jobs before age 45? I have. And Vanguard data shows that the median TDF holding period is about 4 years, and 2/3 of plans falling below 5 years. At the same time, EBSA guidance is expected to clarify that daily liquidity is customary but not a regulatory requirement. How do you think about liquidity design in this context, and is the target date fund pooling structure sufficient to manage redemption pressure even in a stress scenario?
Yeah, so I think liquidity, I think this is a really important point, and I think we talk about liquidity in 401k plans often the wrong way. And I think there's a couple of things that we do. One is it's worth remembering, these assets are set aside in a tax preferenced vehicle. There's a penalty if you take the money out. This illiquidity in a 401k plan does not mean somebody can't buy groceries or pay their rent. And even the question about RMDs, we wrote a paper about this back in January. Even the question about RMDs, like whatever story you want to make up about allocations to private market assets, you can't make the exposure there and whether or not that's illiquid a problem for RMDs. For somebody who's 75 when they hit their RMDs, like already we shouldn't have big allocations to private markets for 75-year-olds in their 401k plan anyway. So I think we talk about it in a way that gets really lost. So, and I know Chris got a couple of points about like thinking about it at the plan level, but I want to even think about it one level up at the system level, which is these assets are set aside for long horizon investing, and as people get closer to retirement, one of the things that is very interesting about job tenure data, EBRI also highlights this, job tenures get longer as people get older. So younger workers change jobs more frequently, older workers change jobs less frequently, my own recent experience notwithstanding. I was at my last job for 11 years. But the job tenures get longer, and so and the assets get larger. So the ability of people to bear some degree of illiquidity risk is improved as they get older and further along in their career. But I know you had some other points you wanted to make.
Yeah, I mean, so to me, what I think is interesting about this, and I don't dismiss the liquidity question at all. I actually think that it's really important because, again, by definition, like these are illiquid assets. Like they're intended to be illiquid. You want them to be illiquid. You want that money to stay invested, grow long term. Like the whole point is that these are long term investments, and you capture the value because they are long term investments. So like we want that. What I think is interesting to think about in the 401k context is really kind of how the 401k plan works. And this comes a little bit because I spent some time as on the plan sponsor side for a long time. I also worked at record keepers. 20 years in one place, but I did have 3 jobs before that. I know that looks weird when you look at me, but it's true. So 401k plans at the plan level, like the record keeper level, there's basically a division of services between what the record keeper does and what the custodian does. The record keeper on a daily basis is calculating and tracking basically what all the elections are. So money coming in, money going out, and they will look at that and they will net all of that activity within the record keeping plan before there's any trade that actually goes to the trust. And so the trust is holding the assets at an omnibus level. They hold it at the plan level. They don't know what any individual has. So this is very different than what like an IRA would look like. So because of that, you have, again, just levels of liquidity support that manage basically how the funds actually needs to trade. Because the idea is that the 401k is not trading that money very often. So step one, phase one is the record keeper is really kind of handling all of that activity on a participant level basis. That nets down to one single trade per day into every one of those investment options. Each of those investment options carries about between 1% to 2% cash so that it can handle that daily liquidity. Until recently, we were in a T+2 environment, so you actually always needed to have cash on hand because you couldn't generate cash that day. We've moved into a T1 environment, so that's a little bit different. But then, so the whole point is that, so within there, now I've got, let's say, call it 90% assets that don't change very often. Does it make sense to have some portion of that that is more illiquid? And so that to me is the question that I think plan sponsors need to look at, which is understanding the mechanisms of liquidity. And now as you sort of bring in, like, how do these new investment options that are private but also have a liquidity sleeve within them, again, just thinking about the liquidity layers that exist within plans is going to be really important for us to understand whether or not we can handle the liquidity within a 401k context.
Yeah, I mean, from my standpoint as well, kind of outside of the 401k, making sure you're understanding, are you being compensated for that illiquidity in these instruments as well? But liquidity is a challenge, certainly, outside of 401k as well. Like it's a challenge across private markets altogether when you're thinking about LP liquidity and GP-led liquidity as well. And so we also believe that there's a huge technology solution here rather than going to high-touch advisors for every single thing. There are workflows that are available. We operate a fund secondaries platform that is really end-to-end workflow to understand what's in a fund. We work through price discovery all the way to settlement and clearance. And we think that there are technology solutions also to help this as you're thinking about the GP-LP on the institutional side engagement, and hopefully I think we'll see a lot more of that kind of flow to retail, not necessarily within 401ks, but as more and more of these are democratized longer term. But that requires a whole different level of education and that we're not going to get to.
Yeah, the one I'll leave you with a rhetorical question here, which is we've set aside, whether you're just talking about 401ks or you're talking about the whole DC system, somewhere between 10 and $13 trillion of assets for multi-decade horizons. Multi-decade time horizons for retirement. But we run the entire system on the unspoken premise that we have to be able to liquidate all of it for cash tomorrow. Is that a reasonable way to think about the world?
And there's a cost to that. There's a cost to pretending like we need daily liquidity. And do we want that, or would we rather have a slightly different version of it?
All right, so that's a good segue. We spent a lot of time talking about education today, so I'll refer to this as the last mile problem. 401k plan participants aren't coming to this with a lot of financial sophistication, and if private assets land in their TDF, many won't even know that they own them. So what level of education is necessary? What's realistic to deliver at scale, and who bears responsibility for it? The manager, the record keeper, the fiduciary, the plan sponsor?
Yeah, so I'm going to start, and we heard earlier today, Elizabeth talked about the fact that participants think that their TDF is going to produce income, and they're mostly mistaken on that today. So we already kind of know that. There's a level of expectation about education for individual participants here when we talk about alternative investments that doesn't line up with what we talk about in other with respect to other offerings in the 401k system. For example, target date funds that people think have income stapled to them. So we didn't feel the need to be able to your earlier point, to be able to educate participants on what the proper allocations to emerging market debt and emerging market equity were. We didn't feel compelled to do that. I think it's important to draw a distinction here between disclosure and education. No one is suggesting that we need to make individual participants sophisticated, institutional chief investment officers able to make allocation decisions between subcategories of private equity and private credit inside their own target date fund. No, we're just going to say your target date fund includes additional tools today that are available to you in the wealth market, that are available to your, for many participants, that are available in your defined benefit plan, that are already being used in your pension plan, and none of those tools are available. Again, modest allocation, diversified portfolio, professionally managed solution.
Yeah, I would agree. And, again, I've been doing this for a long time. So I would say that when we started education around 401k plans, we were teaching people what a stock was and what a bond was. And the thought was that they were going to have to figure out how to manage their portfolio. Then target dates came along, and this whole concept of you actually have someone who can manage a portfolio for you. And we no longer do that. But so that doesn't mean that I don't think, so again, I don't think that you're necessarily trying to educate people on what private markets are. I think that you're trying to educate them on how the plan works. And so you have options, obviously your DIY options, your core menu. You want people to understand, those who want to do that, here's how that works. If you have professionally managed options that do include this, I think this becomes part of that discussion. These are the professionally managed options. Here's who's managing the money. Here are the asset classes that are generally in there. If there's liquidity risk, that becomes sort of like a highlight. But you're really basically helping people understand how the menu has been constructed and why some of these options are there versus what is it and what you need to, how would you think about incorporating that into a portfolio? So to me, it's a different type of education. It does go along the line. So to me, disclosure, yes, obviously one, former plan sponsor. I think that you want people to know what's in the plan. That will happen sort of irregardless. But what I think is important as plans evolve, and this kind of goes across the board as we think about retirement income, which is in a follow-up session, plans have to get a little bit more sophisticated than they are today in order to help people close the gap that they have. So whether it's retirement income, whether it's managed accounts, which is more personalized and how to use those personalized services, whether it's inclusion of private markets, these are all slightly more sophisticated options. And really the goal is to help individuals understand how they work and which one makes sense for them so that they can kind of manage their own retirement savings.
I thought your point around not education but disclosure is good. I think it's about transparency of what is in the actual wrapper, what's driving performance. We are in more and more of a self-directed advisory with AI tools at people's fingertips, and they're curious. They're going to want to know what's in their fund and what's driving performance. And so I think that transparency is important.
So Chris, if I hear you correctly, there's disclosure, which is the bare minimum, and then a little bit of education, because disclosure just means I own something, but why do I own it and what is it doing for me is more than disclosure, it seems like.
Yeah, again, all plans have to provide a fact sheet. There's all these aspects that sort of are just core to what you understand about what your under investment options, and whether people read them, understand them, that's sort of one answer. But I would say is kind of, again, coming from a plan sponsor seat, what I want is people to understand the decisions that they're making and making sure that they're making a good decision for themselves. So if you have options that have private markets in there, that should be disclosed. That could be part of, how you're explaining how the plan works and how the plan sponsor has constructed the plan. And they then have the option to choose a different option if that's something that they're comfortable with.
All right, let's spend 2 minutes on this topic here, which is my understanding is that Australia and the UK offer a roadmap that private assets now represent roughly 19% of DC assets in Australia, but those systems are structurally different from the US. What's the single biggest implementation hurdle you think the industry hasn't fully solved yet here in the US?
So we were talking about this earlier. The elephant in the room that we haven't talked about on this panel yet is litigation. I think the biggest implementation hurdle is fear of litigation risk. I don't actually think it's litigation risk. I think it's fear of litigation risk. And I think those are two different things. I think the industry, we're going to have to catch up to what this particular DOL is doing around changing the environment around litigation risk. DOL can't regulate it away. They can't just magically wave a wand and say you can't be sued, but they can change the dynamics. They can change the calculus for plaintiffs' attorneys. They've clearly switched sides. They're writing amicus briefs on behalf of sponsors. The data sharing is switched sides. Like, this is a different environment. Helping plan sponsors understand, process, documentation, and the changing environment around litigation is going to be really, really important.
I will give that number one, and I'll give you that number two in my point of view, which is, I think really is, we're just at a point in time where, again, like the understanding of private markets is just, we're not quite there yet. So for me, industry understanding is really kind of the second piece. There's really two aspects or two types of, clients that we talk to or folks that we talk to. Those who understand this right away, they use private markets, they're ready to go. They're basically like, how does this work within the 401k plan? The vast majority of folks are really trying to understand what private markets are. They have not been, in a typical, vernacular at the Thanksgiving table. Maybe this year will be different. But really, what are they? How have basically the capital markets evolved? We obviously know what the issues are with individuals being able to save. And then how do these things work within 401k plans? So I think panels like this, I think just continuing to have these conversations just to understand whether this is something that, our plan, your plan wants to, to undertake. That is basically the majority of conversations right now, and that will take some time. I think the products will get there. I think that the mechanics within the 401k plan are actually quite suitable for this type of investment, but there is a level of comfort that we need to get over.
Yeah, and I think it's just getting the guidance out there and having some consistency on it over a period of time.
All right, let's open it up to the audience. What questions should we have asked our panel that I didn't ask? Any takers? Wait, we have one. All right. No? No. Not a taker. Stacy? Oh, wait. Okay.
So I'm hoping it's a good question, but I'm curious about fees of these products. We know fees is part of transparency, and just from my own experience, when I've looked at these product types before, the costs have been much different than what normal investment options are in these plans. So do you see that as an obstacle, and how would you think that would affect the...
It is, and I think, by the way, I think it's related. So I think that is it's related to the litigation question. People are worried, if I put something in that's more expensive than what I already had, is that going to make me more or less likely to get sued? I think the executive order gave us a roadmap for how to think about that. I like to, it's a 401k nerd joke, so only, I think it's funny, but it's the first.
That was a good one.
It's the first executive order in American history that used the phrase net risk-adjusted return. And that's what it said, like focus on the impact on the total portfolio return as opposed to the headline fee. That's really important. It's directly in the executive order. We're almost certain to get additional clarity in the regulation around that concept. So moving away from the headline fee number to what's the impact on total portfolio return, risk and return, is going to be, I think, part of how you respond to that fee question.
Yeah, and I completely agree with the question. I think it's an important question. We've done a lot of digging into understanding the fees, but what I want to sort of impress upon you is just the completely different investment process that is taking place in the private markets for the public markets, and why the fee would ultimately be different, and not thinking about it in the context of here's what my public asset allocation fund does versus what something that includes privates. You have to realize that when you're basically investing in the private markets, like you are literally originating all of those investments. Right, like you have to go through a process where you're evaluating hundreds, if not thousands, of investments before you actually commit capital to any particular of those funds. During the period of time that you're investing, there is a value creation process that manager is typically going through, and they have specialist teams who help evaluate operations, technology integration, software integration, all of these aspects. Like they are looking to grow and build these businesses into sort of the next version of themselves. That takes time and effort. And then there's a process where you actually need to sell and harvest that investment in either, whether it goes IPO, whether it goes into a continuation fund, whether it does, some sort of M&A. There's another process there. So this isn't I get to go and buy, Apple on the market exchange because I think it's a great investment. There's a very different investment process that goes in the mix here, and that. By definition, it's intended to be all alpha. Like we're not tending to basically replicate beta within the market, which can be a fairly low cost to get from an exposure point of view. This is an alpha generating process, and there's a different fee structure. I'm not going to tell you what I think the right fee structure is, but just to say that it is going to be different, and we need to understand that.
All right, you each get 15 seconds to talk about anything that we missed or re-emphasizing.
Well, I was there was an SEC panel recently, and I just wanted to highlight this because I felt like it was very kind of apropos in terms of where we are. And the point that Atkins was making was that, private markets are not necessarily without risk. Like there is uncertainty in this market, but the question of there's risk in a lot of the things that we do from an investment point of view. The question is just because there's risk doesn't mean that we should be excluding it. So to me, that really is kind of the question here. We know that there's risk involved in sort of just all investments. This is no different. The question is how do we do so in a responsible way to be able to bring them into the plans, and that very much is the journey that the industry is on.
Yeah, I would just say that do the work. Like go through the exercise, evaluate the asset classes. If you conclude this asset class is not right for my plan right now, that's fine. There's going to be nothing in the order that says you have to include particular private market asset classes. But just because you go do the work or you run across something that's a hurdle, it doesn't mean none of it for anyone ever, right? That has been the sort of reflex in the industry before now. Zero is the answer. Just, the fees are high, so none of it for anyone ever in the 401k system. That is not what fiduciaries are supposed to do. Do the work and then evaluate it and figure out what's right for your participants. And that might be not this asset class right now. It might be exposure, again, modest exposure in diversified portfolio, professionally managed solution.
And I'll just close with transparency. I think there's a huge opportunity and need for the private markets to get more efficient just in terms of valuation and how they communicate with investors. And, I think technology is going to be a big driver of that. And so it'll be fun to be a part of the evolution and as these products continue to expand.
All right, so join me in thanking Oliver, Drew, and Chris for a great panel.
Great job, panel. Thank you so much. And we're going to call up our last panel. So thank you so much, everybody, for hanging in there with us for the day. This is going to be a great panel also. So here we go.
Our panel is focused on the financial challenges of longevity. And I want to thank everyone here for their panel-going longevity and still being here now. I'm Suzanne Woolley. I'm a personal finance writer at Bloomberg News, focusing on retirement. And with we're at peak 65, with so many people turning 65 every day. We're at this point where we have had so much money accumulating in 401ks, and that's been the focus, as we all know. But, as has been said earlier today, not as much focus on how do you turn that pot of money into a sustainable stream of income for what could be like 30, 35 years of your life. So I'm very glad to have this panel here to address this challenge. And I wonder if we could just go, if you guys could introduce yourselves and talk about briefly, what experience brings you to this panel today?
Sure. Hi, everyone. I'm Andrew Stumacher from Alliance Bernstein. For the last 15 years, I've been involved with our custom defined contribution solutions, working with clients on really solving unique problems for them, right? Whether it's a unique set of demographics where they need a target date fund that's very different than what's out there in the marketplace, or there's a desire for more diversification than what's typically seen. The last panel with the inclusion of private assets is one of our capabilities for some of our clients. And there's another maybe bigger need, which is lifetime income, right? Clients who are focused on helping their target date fund get to a point where it can be converted into a sustainable guaranteed income stream. And we've worked with several of those over the years, having had a solution now going on 14 years. So really excited to talk more about that and the work that we do with prospects and clients and consultants and the rest of the industry.
So my name's Sean Klein. I'm the head of retirement research at PIMCO. That includes things like thought leadership. It includes things like product design. I was actually reading proofs this morning. I was telling Barb, we mentioned EBRI prominently in what we do. We use your data to calibrate some of our models. And in that paper, we mentioned you guys in the second paragraph. So I did what I could. But I'm very happy to be here today. This has been an interest of mine since graduate school, where my thesis was on 401k participant behavior and how people trade out of company stock and things of that nature. So hopefully I'll be able to share some of that research with you today.
Hi there, I'm Mike Downing. I'm co-president of Athene. And Athene as a business has been squarely in the middle of trying to close the $4 trillion retirement gap. Originally through our retail market, about 1 out of every 10 annuities sold is an Athene annuity today. And more recently, we've gotten very interested in the 401k space, including acquiring a company, rebranding of Viterra, and really going after what we think is a huge opportunity there. At a personal level, similar to my colleague here, I've been in this a long time. I'm an actuary, pension actuary by training. So I've watched the decline of defined benefit plans and the rise of DC, and it's really interesting 30 years later to see it come full circle, and excited to make it happen.
Hi, I'm Adam Shank. I'm from Milliman. Milliman is an almost 80-year-old actuarial consulting firm, so work with a lot of actuaries on a day-to-day basis. So I'm kind of the black sheep on this panel. I have a little bit of a different angle for this because I've been working with our health actuaries. So health care consulting is over half of our roughly $1.8 billion in revenue. And they have some really unique and interesting data assets, and they put out all these indices, in particular, ones that follow healthcare costs in retirement, healthcare costs for individuals, and then claims data. And so we're working on, I'm actually on the investment side, so I lead our fund services business within our life discipline, but I've partnered with our health actuaries to launch some pretty interesting products, hopefully next month. So we'll be talking about that.
Great, thanks. I wanted to start with just a brief update, maybe from you, Andrew, on where we are right now with products and investments that are well suited for longer lives and people who may well be spending multiple decades in retirement.
Yeah, and I'll start with just a brief, very brief story about my kids. They're getting older. My oldest one is starting to get a heightened awareness of girls. And so, naturally has a lot of questions, right? Where do I meet girls? I'm like, well, buddy, when I was your age, I never met any. So I really can help you with this. He's like, well, kind of like, what could I change, in order to, get them to like me and things like that? I was like, well, ask mommy. She probably has a nice list for you. But the reason I bring this up is you think of where we're at with retirement income, lifetime income is, there's kind of 3 phases to it. One is that heightened awareness, where all the parties that are stakeholders in implementing these types of solutions are becoming aware of the benefits, becoming aware of what's out there, responding to the market need, right? And then that second step is actually how and where to buy. And then that third step is the evolutionary process. What's working, what's not working, what do we need to build, what do we need to adjust, how do we monitor it, right? And so I'll really focus on that first one because, I think awareness is predominantly where we are. People are underestimating their longevity, but we're adapting for them. Participants have their assets in the right place, predominantly target date funds, or at least per Drew, participants are in target date funds. We've got age-appropriate allocations. We've got tools to help them with retirement planning, Social Security optimization strategies, health and long-term care insurance. But if you ask someone a relatively simple question, how many dollars are you going to take out every year in retirement? They'll wildly overestimate. If they actually followed what they answered, they'd run out of money very quickly in retirement. If we actually look at what retirees are taking, they're actually taking a lot less than perhaps we believe they could. They're underspending, they're underestimating. I know EBRI has data that supports that. No one can get it right on their own. Plan sponsors more and more are recognizing that helping their employees tackle the retirement spending dilemma can have significant benefits for their organization. More productive employees because they're less stressed about their finances, about retirement, the ability for the organization to manage their workforce, and also building a reputation as an employer who cares about what's going to happen to the people that leave their firm. Right? That's going to draw in new employees down the road as well. There's also a quantitative way to measure the impact of these types of solutions on the bottom line. It's complex and it's coming. It'll take a little bit more time, but I think that will also help. Two other quick points. Regulators certainly appear supportive. I think we've talked a lot about Secure Act and the other initiatives underway. I think what's most promising is just how responsive our legislators, our regulators, and policymakers have been on this topic. They want to solve it. Lastly, the product manufacturers, we've responded with, as you expect, a variety of offerings, really trying to address all the diverse needs, offer different baskets of benefits to make sure there's something that's right for everyone, and then deliver those in a, in a way. And we've kind of put aside our competitiveness to partner up where necessary to bring that to participants. So I'll pause there.
Okay. I thought maybe before we sort of dig into some of the products and how they're being implemented, maybe Mike, you could talk a little bit about what you think is misunderstood about longevity solutions and guaranteed income products, either from a plan sponsor perspective or a participant perspective.
Yeah, I'll start from a kind of a plan sponsor standpoint. And I think it's less about a lack of misunderstanding, but a fundamental lack of understanding. And what I mean by that is if we go back to the sort of the pairing of outcomes of, the focus in the last 40 years has all been around saving. And where we've kind of forgotten is on the spending side, right? And so when we look at saving, we've accomplished the auto-enrollment, the auto-escalation, that fixed the amount of savings. And then we introduced target date funds, which made it simple. And we look at that and we think it's completely obvious. But it took decades for those innovations to actually come to bear because it took a lot of thinking, watching, and learning to really put those in place. As we get to retirement, I think we really need to look hard at accelerating that learning curve, and plan sponsors and fiduciaries need to take a much harder look and try to accelerate that. And so in terms of better understanding around annuities, I think I put them in 3 buckets. So one is, are annuities fit for purpose for a 401k plan? Absolutely. And I think some of the questions are they liquid? Are they portable? And in terms of how they fit into the plan, and yes, both of those things can be solved. A third dimension is flexibility. Can I turn income on at 60, 65, 70? Yes, you can do all of that with an annuity in terms of that inherent flexibility. The second is starting early. With our Viterra product, the Lifetime Income Builder, we start allocating at age 47 because it's important to start allocating early in that process as you gear up towards age 65 retirement. And the last, I think, fundamental lack of understanding is how powerful annuities can be when they are completely integrated inside a 401k plan. Typically, a safe withdrawal, if you're just sitting on a pile of assets in terms of spending power, is 4% a year. Why do you spend that? Because you have to leave a volatility buffer so you don't run out of money. You integrate annuities, that spending goes from 4 to 6%. That's a 50% pay raise in retirement for retirees that barely have enough to get through. And it's that kind of confidence that I think totally transforms the game in terms of outcome-oriented thinking, which has been the theme in some of the prior panels as well.
I think that's an important point. Right? There's a misconception that annuities mean lack of your money, right? You're giving it up, and there's different methods of being able to provide that income through the use of different types of annuities and riders and things like that. So that's a great point.
I wondered if we could talk about what have we seen in terms of these products, in terms of like retirement outcomes for the products that have been out there for a while. Are there metrics that we can talk about that you could share on how integrating certain products with the plan have improved outcomes or returns or some other general metric for retirement success? Sean?
Sure. Usually you see things like success rates or failure rates to achieve some spending target over a given horizon. I don't love those results. You know, that if you look at success curves, they're very curved, right? So what happens is you might have a better number for solution A in year 20, but a much worse number in year 21, right? And so they're very unstable. We've been doing a lot of work on really three things. One is feasible spending rates. So if you were going to retire for 20 years or 30 years, historically in the United States or any other country, how much could you have spent on a real basis? You mentioned the 4% rule. If you do that work, that's the minimum that you get in the United States. The average is more like 8, and the maximum is more like 12 or 14. So the range is tremendous. The other thing that we like is not the level of spending, but the longevity. So if I'm going to hold spending the same, how much longer can I finance, either at the end of retirement or retiring early even? But I think what's probably most relevant for this room and what I like the most is the other way you could make up for the lack of some of these products is saving more when you're working. And so that can come from employee or employer contributions. So this is equivalent to how much higher match is another way we do it. So to give you an example, this is work that we're doing on, it's close to my employer's heart, the benefits of active fixed income, right? So if we use third-party measures of alpha from fixed income and plug it into a glide path and say, what do we get? It's something like an extra month of real income a year, or a 25 to 30% increase in longevity, or about a 35% increase in employer match required to hit those numbers.
Yeah, I think income is like the easy target almost, right? It's in the name, retirement income. Yes, we should be paying attention to how much income is generated. I feel like there's these other like surprise data points that we've observed over the last 14, 15 years. One of those is just higher returns, right? The magic of having some kind of guaranteed income, especially integrated into a target date, is you can maintain a more growth-oriented, risk-oriented portfolio than you could otherwise, right? Having a 60-40 portfolio for a retiree in a target date fund that doesn't have any kind of income insurance is unheard of, right? Wouldn't be prudent. What happens when volatility spikes? Somebody's going to lose years of spending. But in the case of having some kind of income floor built in, it's, imagine you're at a poker game and how different you'd play if you knew that if you ran out of chips, someone was going to give you more chips to play with, right? You'd probably try to bluff or call every hand. And so it's kind of like that. And so what we've seen is that 60-40 return, and there's no magic here. It's just, right, that equity risk premium has delivered around 2% more net of fees than a typical target date fund benchmark for a retiree, right? Those higher returns, that's one of the metrics that we're looking at. Are we generating more wealth? That's one of the metrics that plan sponsors also really pay attention to. The other one being, to your point about saving, people are saving more when they're engaged with these types of programs. When they can see that translation of their savings into a guaranteed income or monthly income stream, we actually see that their saving rates go up by 1 or 2% on an absolute basis.
Interesting. I wanted to move on to Adam now and talk about, one of the biggest worries that we talk about in sort of any financial longevity conversation is the fear of inflation eating away at your assets. And as we get older, we know that sort of healthcare inflation kicks in, and it's much higher than the CPI inflation that we hear about. So maybe you could talk about how could an investment strategy that seeks to meet the rising cost of healthcare fit into a retirement portfolio? And also, like, where does it belong? Does it belong in a health savings account, in a target date fund, and or a collective investment trusts, in a Roth, or all of them?
Yeah, so, you think about the basic needs of a retiree, right? It's food, shelter, and then healthcare is really third. And the problem, as I've been working with my colleagues, is really staggering. So So we produce, the first way we look at it is for, just people spending money on everyday, healthcare costs for individuals and families with an average employer-sponsored health plan. So we have the Milliman Medical Index, and that came out in 2025 at $35,000 for a family of 4. That's up from $12,000 for that same family of 4 in 2005. That's a 6.1% average annual increase in just providing your family health care, that's employee sponsored. So that's the first problem, is the ongoing inflation of that. The second is just how much you need to retire and pay for health care in retirement. So we produce the Milliman Retiree Health Cost Index. That number in 2025 for a couple that has Medicare, a Medigap policy, which is pretty, unless you want to do Medicare Advantage, it's really stripped down. So Medigap policy, and then Medicare Part D. In order to sustain all of that for your expected lifespan for a couple, it's $588,000. And Leslie went through earlier today the survey of consumer finances. So what does that mean for people retiring? If in that study in 2022 and 2023, the average retirement savings balance for a couple was $600,000. So that's just enough just to cover those medical expenses. But the median was $200,000. And that's the average is skewed up because there's a lot of folks with higher balances. So that means over 50% of the people that are retiring are well short of the amount of money they need just to serve that basic need. So we've been working on this in terms of building a product, but it's, you can think about it as a general strategy that can plug into really any wrapper. We are planning on launching some ETFs just to make it easy for people to see, also reduce friction for certain areas of the market, and those should be launching next month. But essentially what we do is then use our third data resource at Milliman. We call it the Milliman Health Trend Guidelines, and those indices are based on claims data. So we can actually look at trends in the claims data. Trend means utilization plus the inflation of the basket of goods and services for healthcare. And then essentially what we do is try to follow the money. So what claims, the 4 categories of claims are inpatient, outpatient for hospital care, pharmacy, both brand and generic, and then professional services. So what companies, and we're sticking to public markets for now, at least in these products, to keep them liquid. So what companies are benefiting from that inflation or causing the price of those goods and services to increase? We call that the supply chain, that pushes those prices up. And by investing in that basket of equities, that can give you some coverage on, or at least correlate well over time with those forces. But then we do risk management on top of that. So we have a diversifier bucket. Currently, we use gold as a diversifier for that in a dynamic manner paired with the equity. And then we have a treasury strategy, and the treasury strategy is meant to try to keep up with wage inflation, because the wages of the people giving you care also push that, or force behind all these numbers going up. So, but again, I mean, it can fit inside annuity products that have investment guarantees, where this just linked is one of the parts. But I think really what we've taken away is you really need to plan for this and plan early. And to that, on our website, we'll be launching, and there's obviously, this is in financial planning software, but I don't think a lot of people are realizing how much they're going to need for their own personal situation. So our tool will allow you to put in your current age, your age of retirement, your state of retirement, and then your health status, just to keep it simple on a scale of 1 to 4 stars. And then it'll spit out a number and say, this is essentially what, in today's dollars, what you may need to have saved.
And we will all have a heart attack.
Yeah, and we will, and we're not trying to take everybody's money with these products, but yeah, it's just such an important feature, and all these solutions are important to understand to how to grow in the right way, and then draw that down in the right way in retirement.
It's interesting. I wanted to move back to the world of guaranteed income and ask you, Andrew, last year AllianceBernstein got an advisory opinion from the Department of Labor related to the lifetime income solution, to your lifetime income solution for DC plans. Can you tell us a little bit about that opinion, and sort of what were the dynamics driving you to get that opinion, and how have plan fiduciaries reacted to that advisory opinion?
Absolutely. So in essence, the opinion validated that our solution could be used as a QDIA. And that wasn't earth-shattering to us. We always felt that way. Our clients who've adopted it have felt that way. But we really sought it out for 3 reasons. One, the fear of litigation risk is real. We wanted to acknowledge that from some plan sponsors. And if there's doubt as to whether something's allowed, you want to kind of assuage that doubt. The regulations that were existing, and there's been a few over the years from Treasury, IRS addressing the incorporation of deferred annuities like QLACs into target date funds, with a footnote related to GLWBs or guaranteed living benefits like we're using, that kind of said okay, it's going to come soon. And we hadn't heard anything, so just gave a friendly knock, kind of revisit that topic. Spent a lot of time with the DOL who were really experts on the design of our solution, and the opinion, if you haven't read it, does a really nice job of kind of documenting the most important reasons why it's validated as a QDIA, particularly the liquidity availability, because you can get income without giving up your assets. You get guaranteed income without giving up your assets. Which led to the positive view. I think the other piece was the QDIA regs themselves hadn't been updated to include target date funds that incorporate annuities. Again, looking for that gap to be closed. But really, I think the most important reason, which is the third one, which is give a sign to the market that this is something that regulators are behind, that they believe will help to promote better outcomes for participants and inspire more plan sponsors to adopt these types of solutions. To your point, to your question about reception from plan sponsors, it's been wildly positive. It's not the type of thing that's going to drive all those sponsors to go say, okay, we've got to put a solution in place right away. But it's removed a significant objection that we've heard from some of those shops that we were currently in conversation with, or for somewhere we haven't been able to have that conversation because their ERISA counsel has shut it down. We've got the proof that we've got this solution and it works.
I wanted to ask Mike, given that the opinion only applies to the AB product, what other helpful policy, beyond secure safe harbor, would be helpful and ease concerns for plan fiduciaries at embracing these longevity solutions?
Yeah, so I think the bones are there now with Secure 2.0, and it's largely a matter, I think, of interpretive guidance to really help the focus on fiduciaries really honing in on outcomes. And the messages are clear, and I kind of bucket them into 3. I think there's 3 compelling arguments. So I talked a little bit in the opening comments about the $4 trillion retirement gap. And then another aspect is, the concept of integrating annuities inside. You can change your basically your payout from 4 to 6% and guarantee that for life. That's the same as saying my accumulated $1 million portfolio feels like $1.5 million. So just simply taking a savings gap and turning it into an income solution does a huge job in closing the overall retirement shortfall in this country. And to me, that should be a fiduciary get out of jail free card for sure. The second element that I think is also really compelling is think about the retiree population as this sleeping giant of economic power. Income can really completely unlock that economic power, and you can change a huge swath of the economy by turning retirees from being afraid to spend their money to confidence. So that's potentially a huge economic stimulus. And then to kind of harken back to the Social Security panel, which has a lot of challenges, having a private market solution that really takes the burden off Social Security by really encouraging employers to put in guaranteed income helps make a lot of the debate about Social Security a lot better. And so you have three incredibly powerful policy arguments to encourage regulators to continue to put interpretive guidance out to encourage faster adoption.
Sean, I wanted to ask, what are the most important implications for plan sponsors considering adding annuities or other longevity-focused investments to be aware of and focus on, both operationally and from a fiduciary standpoint? Are there certain non-negotiables plan sponsors should insist on?
So that's a very good question. We're working on this question now. We're talking to partners in the insurance space about what a product should look like. So I'm not going to talk about a product, but just at a very high level, there's three things that we care about. Flexibility is one. A level of high and consistent and predictable income is another. And then finally something or some mechanisms or some tools to deal with longevity risk. Flexibility, just to talk a little bit about that, we've talked about healthcare, for example. There's this retirement spending smile. Spending tends to go up as people get older. That's because of healthcare, right? Average healthcare spending goes up, I think $5,000 or $6,000. Depends on what year you pick this. The numbers grow very quickly. The average is much less interesting than the tails. The top percentile numbers for healthcare spending, even at the very beginning of retirement, are in the hundreds of thousands of dollars, and it only goes up from there. And that's per year, out of pocket, net of Medicare. So this is a lot of volatility. If we look at people not spending and they hold onto their assets, this could be why, right? They're worried about a rainy day. You don't know how much you need. So you have to be able to respond to those individual shocks. High and sustained income, we know that people anchor their spending on their income, in part because it helps them preserve those assets. They can afford to spend a little bit more than that, usually, sometimes a lot more than that, as I said. So some income generation that sort of guides them to a safe place that makes sense is useful. And then something to deal with longevity. So those can be explicit guarantees, either just regular annuities, longevity contracts. If you look at the historical data in the US and elsewhere, some of the best things you can do is incorporate more inflation protection. So I talked about the periods where spending was actually at 4%, feasible spending was, those were periods when either the markets drew down or there was high and sustained inflation. So adding inflation protection gets you a lot. Adding duration can get you a lot, right? If rates fall, you still can generate income, even though it's harder to generate income, for example. So there's lots of tools to get you home, and I think it's important that the product is understood and can actually help achieve those objectives.
Anyone else want to weigh in on that?
Yeah, no, it's in terms of just the overall opportunity, I think it's going to be really exciting in terms of, so one of the other aspects that's, I think coming together quickly is, and this Andrew kind of hit on in his opening comments, is the ability for the asset managers, the insurance companies, and the record keepers. They're coming together at a really fast pace, and I think that's going to really quicken a lot of the solutions.
Great. Sean, I wanted to follow up on that to talk about how plan participants are viewing guaranteed income and annuity type, lifetime solution, longevity solutions. Does perception differ if a lifetime income product is part of, say, a variable annuity or something that's part of a target date fund? How does the appeal vary by, I don't know, age, gender, industry? Do we have any info on that?
We do, but it's contradictory. And so what I mean by that is people will give you different answers about how appealing these products are when they're young versus when it actually comes time to buy them. Right? We saw that annuity uptake in an earlier panel was quite low in the United States and elsewhere. It's very hard to go by revealed preference in that world, right? You'd like to say people like this because they buy it. Well, people don't tend to buy these products. We like to think it's not because they don't like them, that there's some other frictions in place. But there's some things we can say, right? I mean, there's the obvious actuarial benefits. If you're not pricing things individually, you have group pricing, but there's differences in mortality that we talked about earlier. So there are certain participants that are going to live longer in a predictable way. Gender was one that we talked about earlier. Income was one. We talked about top and bottom quartile numbers. They get even wider as you go to the furthest percentiles. Difference in top and bottom percentile mortality is something like 17 years. Those numbers are growing now as well. Those are kind of less interesting, right? Because they're kind of fixed. I think that, if you think about different income levels for participants, a low-income participant, again, we had the Social Security panel, they might get a lot of mileage out of their Social Security benefits. It's a progressive benefit, so you want to sort of maximize that. The returns to Social Security deferral will be higher, and then the amount they have to finance is shorter. High-income participants, on the other hand, they might have enough to self-insure. So you could help your heirs with an annuity if you live long enough, for example, but that may be actually less appealing in that core. For the middle income group, it's going to depend on things like, obviously those actuarial concerns, but is there a pension that's available? That'll change how much annuity sizing I want. Those still exist in pockets, right? And putting those things together, it's very idiosyncratic and very individual. I think it's important that people have some flexibility to make those decisions, given how individualized that decision should be.
Yeah, there's a kind of, I put a watch this space, and the space to watch is just the evolution of annuities inside 401k plans, because I think it has the ability to transform annuity adoption and perception of annuities outside of those plans. And the reason I say that is most people who will retire, assuming this takes off in terms of a concept, won't even know they have an annuity. They'll know they have an account value, and they'll know they have guaranteed income. They don't know how it's put together, how it's assembled, similar to a lot of the construct of how DC is today. And I think simplifying those concepts will pour back over into the retail sector, because we'll figure out a way to deliver products in a way that people aren't thinking about products. Annuity is all about pushing products, which makes it hard and complex, as opposed to basic concepts like spending power, income, et cetera.
Amen to that. Completely agree.
When I worked at Money Magazine, annuities were sort of like, it was like verboten. They were seen as like, I don't know, Darth Vader or something. They weren't transparent. You couldn't it wasn't easy to compare them. They were expensive. So there's that reputational angle that is a challenge, I think. Adam, I wanted to ask you. You said the ETFs are coming out in April, I guess?
Hopefully early April, yeah.
Do you have a sense for who are you targeting with that? Like, what will be the appeal? Who's your sort of target customer? And
yeah, so it's essentially it's really bifurcated in terms of, what does the individual need to do versus institutions. So as I mentioned, we've been talking to institutions about an SMA version of this for a while. And so these are health plans, which have the same risk that an individual has, right? The claims are coming, and the health plans cover them just like you need to cover whatever your portion is as an individual. So, but the plans have the ability to reset their rates the next, each year, right? That's how medical contracts work. So, so they just build in the inflation assumption into the premiums, but then the premiums then get passed down to all the participants, right? So that's why. So that in effect is causing some of the inflation. But in any event, those conversations have been pretty interesting, because so far they've just there's a lot of regulations in terms of what they have to hold, especially if they get payments from CMS, for Medicare. But the concept resonates. It's simply, just like Sean talked about, you need things that respond with inflation. And this is a very specific type of inflation because it's governed by a patient to doctor relationship versus, oil is just based on supply and demand. So it's a very complex relationship with inflation. And so we're, again, I talked about the tool. We're trying to make it easy for people to understand where they are in their, for a glide path or target date fund or whatever, based on where you are. You can afford to take more risk in some periods in order to try to outperform inflation, but then you got to ratchet that down over time. And then certainly things like guaranteed income in a through pattern can really help. But getting a precise estimate. And so the company we work with on the tool called HealthView, they actually have a more fully featured tool that they use for financial planners where you can actually check off your disease states if you have specific conditions and see how the numbers change, because that's going to send you down. If you have cancer, the oncology drugs are different than the regular drugs. So we're trying to help people in baby steps to get around this idea of really trying to invest for this specific component of inflation that is really affects your success in retirement.
We're hearing about so much innovation. There's a lot going on with different approaches to longevity solutions and such. But at the heart of it, we have to get participants engaged with the plan. So I just wondered, Mike, if you can talk about, are there approaches you see people taking or that they should be taking? Any behavioral approaches being considered? How do you tackle this problem?
Yeah, this is where I believe technology, especially with the emergence of AI, is going to really transform and make products a lot simpler. And it's going to do it in two ways. One will be invisible to the buyer of the annuity, and that's really all the technology that's needed to make an annuity look and feel like any other asset. So in the DC world, there's a lot of complicated middleware to connect an insurance company to an asset manager to a record keeper, and it's complicated. And with the advent of a lot of it's all coding, and a lot of AI is drastically shrinking the coding time frame from months to days. And what that means is then from an investment standpoint, a lot less dollars of investment will be needed to actually bridge that gap. So that's one. So I think that'll be one aspect. The second is more from just a consumer end user standpoint, like planning software, et cetera. It's all built around assets. It's not built around outcomes. It's built around accumulating a pile of money. If there's an annuity in it, it's just an add-on. Oh, somebody's got an annuity, it sits over here. So imagine connecting all the dots and having an asset tool or a buy recommendation that fully integrates annuities, whether it's a fixed indexed annuity or a simple MYGA, and just embeds that all into a simple buy recognition. What we're seeing with again the AI revolution and evolution is that's going to be a lot easier to do. And I see planning being done in a totally different way in the next couple of years where annuities are completely integrated. That will transform the customer experience.
Are you working at all on a tool of some kind, or?
We're trying, and I'm doing my best to encourage somebody to build it. Because if somebody builds it, it's a saying I have is what's good for the industry is best for Athene, because we're a market leader, and if the industry grows, we grow quite a bit. So it's an open sales pitch for software people to build a better mousetrap for planning.
People could run out and use Claude, co-work. Are there questions in the audience that anyone would like to ask about these products and their future? Or are you all, tapped out after an entire day of retirement information? Okay, well, this has been really wonderful. Thank you all.
That was great. We really appreciate it, and thanks for being in the last panel. Thanks to all of you for hanging in there. Cheryl was just going to give just a couple of closing remarks, and I just want to thank everyone from EBRI and Milken that was involved with putting this together. It takes a village, so thank you.
Well, I often give like takeaways, but I'm only going to do a couple because it's been a long day. You know, we started out with Barb giving us some interesting data. Also, you know, focusing on debt as an issue. Noteworthy to me that some people said savings wasn't a priority now based on their family situation so that was a little disturbing. You know, we're going to be thinking about debt as well. So that was an interesting thing. And also some unexpected debt was often healthcare debt for people. So the 401k mullet, Bridget mentioned this at our Future of Finance Symposium, where she was an excellent speaker, by the way, on a retirement panel. Hadn't heard of that. I still didn't know exactly what she was saying until I saw this. I sort of understand it. But the Milken Institute will be having a Future of Finance Summit each year in March now. It's a new program. And of course, our global conference is May 3rd through 6th in Beverly Hills, leading in a new era. We have an Asia Summit, a Middle East Summit, and more. We wanted to thank the Chamber and EBRI again, and we learned so many different things. It's hard to really go into all of them, so I'm not going to highlight all of the details. I made some notes about all the different areas. I think lifetime income is a thing that's coming up again and again, that we want people to know about it, understand it, and I do agree with the notion of sort of having that pot of money plus the lifetime income is probably going to be optimal for most people. So we're excited about where the industry is going. And I will say on Social Security, I told Barb I was trying to calculate my own benefits at the time while I was watching this, even though I had an account set up. But I thought that the notion that we need a long-term viability fix and a short-term one to make sure people are paid was a key factor, and also that the next president, whoever that may be, trying to cross my, in 2028 will need to deal with this, and it will need to be, I thought, interesting that Wendell said we'll need to have both parties going over the cliff together, and it's very important that that happens. So that's my big takeaway. But thanks so much for joining us. We really appreciate it.